So today I will discuss with you a new chapter, that is share capital and debentures, section 43 to section 72. So total 30 sections we need to discuss in this chapter. And if you look at these sections chart, this chapter is divided into two parts: share capital, debentures. Share capital 43 to 70, debentures 71. So to the both shares and debentures there is a facility called nomination. It's similar to one-person company, but in one-person company nomination is mandatory. For other companies nomination is optional. So what is the highlight of nomination? You know why nomination clause is so important? In the death or incapacity of a member of OPC, nominee becomes member of OPC. In other companies, in the death or incapacity of a member, the legal representative, simply whose name was mentioned in the nomination, letter, so that person will become member of the company. But for other companies nomination is optional, whereas for one person company nomination is mandatory. In OPC you will find nomination in MOA. For other companies you will not find nomination clause. Clear? In MOA. Next one, so share capital 43 to 70, debentures 71. So for both shares and debentures we had a facility called nomination, that is 72. Now coming to share capital 43 to 70, you can see here basics about shares: issue of shares, transfer of shares. So I classified share capital provisions into three parts: basics, issue, transfer. Under basics, it is very important to know about kinds of share capital. We are having two kinds of share capital. One is equity and second one is preference. So kinds of share capital 43. What is the nature of a share? 44. Numbering of shares 45. All these three elements you will find in one document called share certificate, that is section 46. So whether it is an equity share or a preference share. Next one, how many number of shares we are holding and what is the number of, what is the numbering of shares we are holding. So all these elements you will find in a document called a share certificate, that is 46. By holding this share certificate, you will have some rights and you will also have some obligations. Coming to the rights, yes, you are entitled to voting at general meeting. You are entitled to voting through postal ballot. And sometimes these rights can be varied. So coming to voting, section 47, variation of rights 48. Sir, what obligations I will get because of holding share certificate? Calls on shares. If you are holding partly paid up shares, whenever company is making calls on shares, then you are liable to pay call amount. And sometimes you may deposit extra amount. What is required? If you deposit more than call amount, we call it as calls in advance, section 50. On calls in advance, whether company is liable to pay dividend or not, we'll see in section 51. So basics, kinds, nature, numbering, these three you will find in share certificate. Holding this share certificate, member will get rights and member will also get obligations. Under rights you can see voting variation. Under obligations you can see calls on shares, calls in advance, dividends. Clear? So basics completed. Next, issue. Company may issue shares at a premium. 52. Company is prohibited from issuing shares at discount. 53. But there is one exception called sweat equity, section 54. And next one is issue and redemption of preference shares, that is section 55. So with respect to issue, only 3 points: premium, discount, preference. Premium 52, discount, prohibition 53, exception sweat equity 54. Next one, preference shares, section 55. Now these shares are transferable, section 56. In case of personation, what is the punishment? Section 57 will discuss. Now section 57 says about punishment for personation of securities. Personation. Clear? Personation, this point is already there in prospectus chapter. And one more time, personation is there in share capital. So what is that personation? I will discuss with you in section 57. Next one, appeal, section 58. Last one, rectification, 59. So transfer at par. So what is the point? Transfer at par. Transfer is all about section 56. Par means P stands for personation, 57. A stands for appeal, 58. R stands for rectification, 59. Clear? So 3 parts completed: basics, issue, transfer. Now this capital, coming to the capital clause in MOA, we need to publish the capital amounts: authorized share capital, subscribed share capital, paid up share capital. We need to publish these 3 amounts. That is section 60, publication of capital. And this capital can be altered in 5 ways. How many ways? 5 ways. That is section 61. So if you increase your share capital, if you increase your capital clause, if you increase the amount mentioned in the capital clause, then that amount you can utilize for issuing the shares. That issue is classified into 2 types. For money, if you are issuing shares, that will come under further issue, that is rights issue, section 62. Without money, you are issuing shares for not for money. That means bonus issue, section 63. Clear? Both the cases company has to communicate with ROC, that is section 64. One more time: capital, publication of capital, section 60, alteration of capital, 61. After alteration, if you want to increase your capital, if you want to increase company's capital by issuing those shares, you can increase the capital. And that issue is of 2 types: issue for money, issue not for money. If it is issue for money, further issue 62. Issue not for money, bonus issue 63. All times communicate with ROC 64. Now coming to reduction, here reduction might be possible for liability of the members as well as reduction of the capital. Reduction of liability 65, reduction of capital you can see section 66. And capital can be reduced through buyback. On buyback we had some restrictions 67, conditions for buyback 68, CRR 69, prohibition of buyback 70. Clear? So total in share capital, how many sections we are having? 30. Divided into 2 parts: share capital, debentures. 43 to 70, 71. Both had a facility called nomination, that is 72. Share capital 3 types, 3 parts: basics, issue, transfer. Basics, kinds, nature, numbering. You will find in share certificate. Holding the share certificate, you get rights, you get obligations. Voting rights, variation of rights. Obligations, calls on shares, calls in advance, dividends. Clear? Next one, issue, 3 points: premium, discount, preference. Premium, no problem, 52. Discount, prohibition, 53. Exception, 54. Preference shares, 55. Coming to transfer, 4 sections we are having in transfer. Transfer at par. Transfer 56. Par, P stands for personation, 57. A stands for appeal, 57. 58. Rectification, 59. And now capital, 2 parts: publication, alteration. Publication 60, alteration 2 types, either increase or reduction. In case of increase, if it is per money, further issue 62. No money, bonus issue 63. Reduction 2 types: liability, capital. Liability 65. Okay, what is 64? Communication with ROC. So 65, reduction of liability. Next one, 66 to 70, it is all about reduction of capital. That is, 66, reduction of capital. Restrictions on purchase of its own securities. That means restrictions on buyback, imagine. 67. Conditions for buyback, 68. CRR, 69. 70. Prohibition on buyback. Can I proceed? Now, in this chapter, it is very important to understand share. What is a share? Share means share in the share capital of a company, and share includes a stock. So what is the definition of share? Share means share in the share capital of a company, and it includes a stock. Suppose a company is having a paid up share capital of 10 crores. You are holding 1 crore. Getting my point? That means your share is 1 crore in this 10 crores. Share means a portion of something. That means portion of share capital, and it includes a stock. Under old scheme, a question was asked on stock versus share. First of all, what is stock, sir? See, stock is a collection or bundle of fully paid up shares. Right now, demat facility is there. If you want, you can transfer 1 share, 2 share, 3 shares. Whatever number you want, you can transfer. But previously, share transfer happened through brokers. If you observe in Lucky Bhaskar movie. So hero used to call a broker, stock broker. And he used to tell, purchase the shares. for 17 lakhs. Sell all the shares. Yes or no? Through phone communication, or through personal communication, they use it to sell the shares, they use it to purchase the shares. So at that time, buying one share, buying 5 shares, it is not that much viable, financially not viable. That's why they introduced a system called lot system. Maybe one lot equal to 100 shares. That means if you want to purchase, minimum you have to purchase 100 shares. If you want to sell, minimum 100 shares you want to sell. Are you getting my point? So in this case what happens, suppose if I have 50 shares, or if I want to purchase 50 shares, I'm having money only for 50 shares, can I purchase one lot of 100 shares? No. And you are holding 100 shares one lot, and you need money, and you are not interested to sell all 100 shares, you want to sell only 50 shares. Can you sell 50 shares? No. That means transferability is affected because of this lot system. To eliminate this problem, companies introduced a system called stock. Stock is nothing but collection or bundle of shares. Like some 1000 shares will be considered as one stock. For example, 1000 shares will be considered as one stock. Generally shares are transferable in numbers, 1 share, 2 share, 3 share, like that. But stock is transferable in percentage, like 5% stock, half stock, 75% stock. So that means if you had money for 50 shares, you can purchase how much stock? 5% stock, because stock is transferable in fractions also. Now tell me, transferability point of view, which is advisable, stock or shares? Come on, tell me, transferability point of view, which is better, stock or shares? Stock. Reason? Shares, you want to transfer 100 shares, you want to purchase 100 shares. But stock, you can transfer 1% stock, you can transfer 5% stock, you can purchase 10% stock. So purely from transferability point of view, previously companies introduced a concept called stock. Right now this is not popular, this is not at all in existence. Clear? Now the question is, shares versus stock. Can a company directly issue shares to the public? Yes. But stock direct issue is not possible. First company will issue shares, later fully paid up shares can be converted into stock at the request of the member. That's it. So tell me, what type of shares can be converted into stock? Partly paid up or fully paid up? Fully paid up shares can be converted into stock. Can a company directly issue stock? No. First company issues shares, later shares will be converted into stock. Originally shares are issued to the shareholders, while in case of stock, the fully paid up shares of the members are converted into stock afterwards. Thus stock is not issued originally, but it is obtained by conversion of fully paid up shares. It's very simple. If you take laddu is a mixture of that bundi item. Yes or no? So transfer of one single bundi, 2 single bundi possible, but transfer of half bundi, 0.25 of bundi possible or not possible? But if you take a laddu, can I transfer half laddu? I mean, can I break it into half? Can I break it into 4 parts? Is it clear? So in examination, don't write stock is a laddu, share is a bundi. Don't write like that. For your understanding, I'm telling you. Can I proceed? 2 points are important in this concept. 2 points. Can a company directly issue stock? No. Can a company convert partly paid up shares into stock? No. That's it. Next one, kinds of share capital. Tell me, how many kinds of share capital we are having? 2 kinds. Once again I'm telling you, kinds are different, types are different. Types of capital means authorized capital, issued capital, subscribed capital, called up capital, paid up capital. But kinds of capital means equity share capital, preference share capital. So what is a equity share capital? It is a share capital other than preference share capital. So any share capital which is not preference share capital, it is equity share capital. Clear? Then what is preference share capital? It is a share capital which carries or would carry a preferential right with respect to dividends, with respect to capital. That means in a company, suppose turnover some 50 crores, expenses some 40 crores, next one tax some 3 crores. So whatever profit left over, how much? 7 crores is the profit left over. Now actually this 7 crores belongs to equity shareholders actually. But in a company, if company had issued preference shares, if preference shareholders are there, first dividend payment, to whom we should make dividend payment? Preference shareholders. So that means they get priority over whom? They get priority over me, or they get priority over you? They get priority over equity shareholders. That is what preferential right. Name itself is telling preference. That means they will be given priority. They will be given preference. With respect to what? With respect to calling general meeting? With respect to voting rights? No. With respect to only dividend. One. Second one is capital. In the event of liquidation, after settlement of all outside liabilities, whatever left over, first we will repay money to preference shareholders. Later we will repay money to equity shareholders. So any share capital that carries preferential rights with respect to dividends, with respect to capital redemption, it is nothing but a preference share capital. Whether that redemption is at par, that means 100 rupees you collected at the time of issue. At the time of redemption, whether you redeem at 105 or whether you redeem at 100 rupees, not an issue, but that redemption, it carries priority over equity shareholders. That premium, which one will decide? The premium is decided by terms of the issue. That means agreed premium as per MOA or AOA of the company at the time of liquidation. Clear? So equity share capital means share capital other than preference share capital. Preference share capital means share capital that carries two priorities. One is dividend, other one is redemption of capital. Now answer my question. Can a company issue preference share capital without issuing equity share capital? Can a company issue preference share capital without issuing equity share capital? Yes or no? Why no? Why no? Just now I told you, compared with equity, they get priority. If there is no equity, with whom they get priority? Clear? Suppose if company issues preference share capital without issuing equity share capital, we call it as equity only. It is not preference. Clear? Another reason, company can't issue irredeemable preference shares. At one point of time, they should be redeemed. Yes or no? But capital is something, it should be there as long as company is in existence. Can I proceed? Next one. Preference shareholders may also participate in equity pool post the preferential allotments, entitlements. Preferential entitlements. Such preference shares are known as participative preference shares. Such preference shares are known as participative preference shares. That means, same example, 50 crores is my turnover, 43 crores my expenses and taxes. So net 7 crores profit is available for shareholders, equity as well as preference. Suppose preference dividend is 1 crore. I deducted 1 crore preference dividend. What is this? Preference dividend. Balance amount how much? 6 crores. Suppose equity dividend is 2 crores and the balance amount is 4 crores. Actually this amount belongs to whom? Equity shareholders. Why? Because they are the real owners of the company. Whatever risk is associated in the business, whatever reward is entitled to, who are entitled to, or who should bear the risk, who are entitled to the profit? Equity shareholder only. So after payment of preference dividend and after payment of equity dividend, whatever amount is left over, in that amount along with equity shareholders, if preference shareholders also get a share, then those preference shares are treated as participative preference shares. Participation means what? Participation in voting or participation in profits? Participation in profits. Which profits? Before equity dividend or after equity dividend? After equity dividend. Whatever amounts left over after payment of preference dividend and equity dividend, in that pool, if preference shareholders also get right, then that preference shareholders are treated as participative preferential shareholders. But to find out this right of participation, we must look the terms of issue. That means every time when a company is issuing shares, it will issue an offer document. It may be a private placement or it may be a prospectus. So check the terms of issue or check AOA. If AOA specifies preference shares are participative, then they will get participation rights, or else they will not get participation rights. Preference share capital is presumed to be non-participatory, cumulative, unless AOA specifies otherwise. Cumulative means what? Cumulative means accumulation. Suppose this year if they didn't get any dividend, tell me dividend, when I will pay dividend? When I'm in losses I will pay dividend, when I'm in profits only I will pay dividend. Dividend is an appropriation of profit. It's not a charge of profit, it's a appropriation of profit. So if I have profits, then only I'll pay dividends. This year I had no profits. Now preference dividends, that amount, if it is carried to the next year, as dividend in arrears, such preference shares are known as cumulative. No carry forward, sir, just it will expire, sir, non-cumulative. Now coming to equity shares includes ordinary shares, differential rights. Ordinary shares means one share equal to one vote, and equal dividends. If I announce 10% dividend, it is equal to all the shareholders in case of ordinary shares. But coming to differential rights, one share may not give one vote. One share may give 10 votes, or 10 shares may give one vote. Let's see. Next one, equity shares with differential rights. Important concept. Section 43, equity shares with differential rights. So in kinds of share capital, it's not that much important, but once again I'm telling you, this is very important. Share versus stock. Next one is, issue of equity shares with differential rights. So here the concept is, in my company, say for example, TM Limited, Tata Motors Limited, total paid up equity share capital of company is 100 crores. In this 100 crores, 75 crores is held by promoters and 25 crores held by public. 25 crores held by public. So, in terms of number of shares, imagine 10 crore shares. So 7.5 crore shares with promoters, 2.5 crore shares with public. One day, company is planning to raise funds for expansion of business activities, or for the process of amalgamation. In the process of amalgamation, they need additional 100 crores. Imagine. So total, how much it would be? 200 crores. Now the point is, if they collect this money from public, what happens? Promoter shareholding would be 75 crores and public holding would be how much? 125 crores. Previously, promoters had how much percentage of voting? 75. But post issue, that means post new public offer, promoter shareholding will fall to how much? And public shareholding will increase to how much? 125 by 200 means it's 62.5%. And promoters holding will fall to 37.5%. So previously with the holdings they can easily influence special resolution. Now present with their holding, they can't even influence ordinary resolution. Yes or no? So they are not interested to dilute promoters stake. That means dilution means if they go with the new public offer, promoters voting percentage is falling from 75 to 37 and off. So they are not interested. So promoters point of view, dilution of control, they are not at all interested. At the same time, if you think public point of view, they will never show interest in the voting. They will always show interest in what? Dividends. Yes or no? Returns only. See, company, for example, company is located in Mumbai. You are in Chennai. You are holding some 100 shares. Each share value, imagine 1000 rupees. 100 into 1000 means how much? 1 lakh. Now for just exercising 100 votes, will you travel from Chennai to Mumbai? So where traveling charges some 20,000, stay charges 10,000. Will you show interest in traveling from Chennai to Mumbai just to exercise that 200 votes? Just 100 votes, not interested. So that means why you invested money in the company? Looking at dividends. So for public, dividends is important matter, whereas for promoters, control is important matter. Now this company, to raise this 100 crores, what they did, they came up with a concept called differential voting rights. Differential voting rights. Here, they told that 10 shares equal to 1 vote. And each share will get a dividend of normal dividend plus 5%. So that means if normal dividend is, imagine 10%, they will get how much dividend? 15%. Now public will show interest in which type of shares? These differential voting rights. Suppose if one share is giving 10 votes, they are known as superior differential voting rights. Superior voting rights. But this concept is not there in India for the time being. Superior voting rights, no one is following this concept right now in India. Tata Motors previously they issued a differential rights, and the highlight of the differential rights is for every 10 shares they will get one vote. Now imagine they collected 100 crores, face value 10 rupee, that means how many shares? 10 crore shares only. 10 crore shares into 1 by 10, yes or no? Each share will give how much vote? 1 by 10. So now 10 crore into 1 by 10 means 1 crore votes. Previously they had how many votes? 2.5 crore votes plus this time 1 crore votes. So total how much it is? 3.5 crore votes. Whereas promoters, they are holding how many shares? 7.5 crore shares. They are holding how many votes? 7.5 crore votes. If you observe carefully, company is getting 100 crores money. Yes or no? At the same time, dilution of voting power, is it happening? Happening, but minimum. So if you observe here, total how many votes are there? 11 crore votes are there. Out of 11 crores, 7.5 means 7.5 divided by 11 means almost they are having a, how much they are having? 7.5 by 11, just calculate and tell me. 60 plus only they are having, 60% plus control only they are having. Dilution of control is there, but minimal. Imagine if differential voting rights concept is not there, then their voting percentage right from 75 to 37.5% it gets dropped. Yes or no? You may get a doubt, sir, instead of going to public, ask promoters to contribute. They had no money, that's why. If they had money, they will go with which concept? Rights issue. Under rights issue, they subscribe additional shares, company will get money. Clear? So having differential rights, the benefit is promoters control over company will not get diluted much. At the same time, from public also, from public point of view also, they will get shares with higher returns. Can I proceed? So tell me, is this a beneficial concept to the company and promoters? I mean to the company as well as promoters as well as investors? Yes or no? Yes. Now to get this benefit, they should comply with certain conditions. Issue of equity shares with the differential rights, it's a benefit. To get this benefit, they should comply some conditions. So what are those conditions, sir? First important condition is AOA authorization. For a company to do anything or everything, company should get power from where? AOA. I told you, MOA defines the scope of company, MOA confines the scope of company, whereas AOA defines the powers of internal management. Whether board of directors on behalf of company issues equity shares with the differential rights or not, they get power from which document? AOA. Suppose if AOA is silent, then what we have to do? Go and comply section 14. What is section 14? Alteration of. So now alter AOA by inserting a clause relating to issue of equity shares with differential rights. Now condition 1 satisfied. Next condition, if you observe here, to some extent, at least to some extent, voting percentage of the existing members is getting reduced. Yes or no? Yes or no? Some extent only. It's not much, but minimum voting percentage is getting affected. That means if existing members' interest is getting affected, first you have to take whose approval? Existing members' approval. And what kind of approval? Ordinary resolution. If you are an unlisted company, such ordinary resolution shall be passed at a general meeting. But if you are a company with equity shares which got listed on the stock exchanges, simply I call it as listed companies. So in case of listed companies, such resolution shall be obtained via postal ballot. That means resolution should be passed through postal ballot. This point can be tested for 2 marks MCQ. Or they may narrate a situation like this. TM Limited, whose equity shares got listed on recognized stock exchanges, planning to issue equity shares with the differential rights. And company secretary is having a doubt regarding passing ordinary resolution through the kind of voting, whether show of hands or poll or postal ballot like that. So please advise. Now you need to answer by adding this point. Everyone getting my point? So in all companies, ordinary resolution is compulsory, whereas listed companies, ordinary resolution shall be obtained via postal ballot. And for getting this resolution, definitely we have to issue notice to the members. And along with notice, you need to attach a document called explanatory statement. Sir, in explanatory statement, what we will find? We find only justification, reasons. So explanatory statement should contain details about issue, how much amount you are going to gather through this issue, how many number of securities you are offering, and what are the terms and conditions, like one share equal to 10 votes, one share equal to 10 votes, or 10 shares equal to 1 vote. So what are the terms of the issue? You just give them a brief. Now reading all these terms and conditions, definitely member will make a sound decision. Yes or no? Yesterday I told you, decision making means it's not like flipping up a coin. It's not picking up a paper. Yes or no? It's not an optional. It's just, they have to take a decision through a, they have to make a, what type of decision? Informed decision or otherwise informed decision. They can make only informed decision only once you inform them completely. Next one, voting powers of shares with differential voting rights should not exceed 74% of total voting power at any time. So what is this point? There is a limit on number of shares with differential voting rights. Sir, to what extent I can issue differential voting rights, sir? It's very simple. Voting power from differential rights shall not exceed 74% of total voting power. If you observe, total voting power is nothing but voting power from ordinary shares plus voting power from differential voting rights. That is equal to total voting power. Correct? So that means voting power from differential voting rights less than or equal to 74% of total voting power. Just wait. Yes, this is the equation. Voting power of ordinary shares plus voting power of differential voting rights is equal to total voting power. Now voting power from differential voting rights less than or equal to 74% of total voting power means what? 1 second, ma. Yes, voting power from differential voting rights is equal to total voting power minus voting power from ordinary shares. Correct? Yes or no? But the restriction is voting power from differential voting rights less than or equal to 74% of total voting power. To understand this, generally, I used to tell equation like this. For example, company is having 1 lakh shares, ma. Company is having 1 lakh shares where one share gives one vote. Where one share gives one vote. Now, how many differential voting rights company can offer? And the terms, if you observe, every 10 shares will give one vote. Imagine every 10 shares will give one vote. So yes, you all know, let's the unknown figure be X. And voting power from ordinary shares, how many shares we are having? 1 lakh. So 1 lakh into 1 plus X number of differential voting rights, and the specialty is each share will give how many votes? 1/10 of votes. 1/10 of vote for each share. Less than or equal to 74% of, I'm sorry. So if you observe carefully, this is total voting power of the company, one equation. And we had another equation. What is that another equation? Voting power from differential voting rights less than or equal to 74% of total voting power. So just now we got a total voting power equation, right? We didn't got a X figure. We didn't got the value of X figure. But if you observe, if we insert this amount, if we insert this point in the first equation, it would be like this. Voting power from differential voting rights, how much it is actually? X into 1/10 less than or equal to, for the time being I will write it as equation form, equal to 74% of total voting power means 1 lakh into 1 plus X into 1/10. Correct? X by 10 is equal to 74% of 1 lakh means 74,000 plus 0.74 X by 10. If you bring X this side, X by 10 minus 0.74 X by 10 is equal to 74,000. So that means 0.26x by 10 is equal to 74,000. So x is equal to 74,000 into 10 divided by 0.26. Just calculate and tell me. It's like 74,000 means 7,40,000 into 10 by 0.26. 7,40,000 divided by 0.26. How much? 90? 28 lakh? 46,000? 154. Okay. Let's check whether it is correct or not. Very simple. Ordinary shares. How many shares? Right now I am having 1 lakh shares into 1 lakh votes. Differential rights. How much number we got? 28,46,154 shares. Yes or no? This is the count of shares. Each share is giving how much vote? 0.1 vote. Because the point is 10 shares will give 1 vote. That means each share will give 1/10 of the vote. So that is into 1 by 10. So the answer would be 2,84,615. So total number of votes, if you observe in a company, 3,84,615. And if you observe the percentage, this 2,84,615 divided by 3,84,615, it will be less than 74% only. You will get it. 73.99%. Understand? That means in a total voting power, the voting power coming from differential voting rights shall not exceed 74%. So post issue, we will check this limit. Post issue, that means after issue of equity shares with differential rights, voting power coming from differential rights shall not exceed 74% of the total voting power. And the companies only with a good track record, that means the company which has not defaulted in filing financial statements or annual returns for the last 3 years, only those companies can offer equity shares with differential rights. Next one, company has no subsisting default. And next one, company has not defaulted. Observe carefully, this is no subsisting default and this is no default. No subsisting default means the default should not be in existence right now. Not defaulted means in the past, present, there is no such default. Subsisting default means up to now there may be a default, but if you rectify them, okay, it is not said to be subsisting default. There is no subsisting default. Clear? So what are those subsisting defaults? Payment of dividends, repayment of deposits, interest thereon, repayment of debentures, interest thereon, redemption of preference shares. So with these defaults, you are prohibited from issuing equity shares with differential rights. You rectify these defaults, proceed with issue of equity shares with the differential rights. Next one, company has not defaulted in the following, payment of preference dividend, payment of employee statutory dues like PF, ESI, TDS, gratuity, etc. Next one, transfer of IEPF dues. Once dividend declared, up to 7 years after declaration, if no one is claiming dividends, then shares plus dividends shall be transferred to IEPF. If company makes any default in transferring these amounts to IEPF, then company is defaulted. Then company is said to be a defaulting company. Defaulting company is not allowed to issue equity shares with differential rights. Next one, repayment of any term loan from public financial institution, state level financial institution, banks, including interest thereon. So default in repayment of loans plus default in payment of interest on those loans, again it is a default. But don't worry, if you had these defaults, first you rectify them. From the year of rectification, wait for 5 years. After completion of 5 years from the year of rectification, I'm not telling date of rectification. Suppose 2016-17 default happened, and this was rectified in the year 2020-21. Rectification happened. Now from here onwards, wait for 5 years. Prohibition, ban period is there. How many years? 5 years. That means 21-22 ban, 22-23 ban, 23-24, 24-25 and 25-26. So up to 25-26 ban. From 26-27 onwards, if you want, you can issue equity shares with differential rights. Clear? Just the last condition I'm telling. Other conditions, no subsisting default, right? So even if you had these kind of defaults, you rectify, next minute you can offer equity shares with the differential rights. Whereas with respect to these 4 defaults, first you rectify, then wait for 5 years. Next one, last 3 years company has not been penalized by a court tribunal under RBI Act, SEBI Act, SCRA, FEMA. So if you make any mistake in foreign exchange transactions, you will get punishment under FEMA. If you get punishment, you are prohibited from issuing equity shares with the differential rates for 3 years. Last 3 years no defect means, no default means, if any 1 year, in any 1 year if defect is there, after that year wait for 3 years. Existing equity shares with voting rights cannot be converted into differential voting rights. So conversion is not possible. Differential rights will come into the picture only by fresh issue, but not by conversion. Next one, holder of differential voting rights shall have same rights as other equity shareholders like bonus rights subject to differential rights. Suppose you are having ordinary shares, I am having differential share. So in the case of bonus, in the case of rights, I will get a differential shares, you will get a ordinary shares. That is the only difference. But what are all the other rights you are having? What are all the other rights available to me? They are common. That means you can attend general meeting, I can also attend general meeting. You can also vote, I can also vote. All rights are similar. But in case of bonus, in case of rights, what shares you will get? What shares you are having, only those shares you will get. If you are having ordinary, you get ordinary. If I am having differential, I will get differential. The register of members shall include details of differential voting rights issued with the shareholders details. Who are holding differential rights. To identify them, you have to maintain the details in the register separately. Next one, register of members shall include the details of differential voting rights issued with the shareholder details. Board of directors shall disclose the issue of DVRs in the board report for the financial year in which issue was completed. So this is all about disclosures in board report. And last, this section will not apply to 2 companies. What are those 2 companies? IFSC public, all private. Sir, what about IFSC private, sir? When I am telling private means that includes IFSC private. Provided their MOA, AOA should allow them. If you remember section 6, I told you, act to overriding effect. If there is any inconsistency between AOA and act, which one will apply? Companies Act will apply. AOA will not apply. But here section 43 is giving freedom to these 2 companies, MOA, AOA. So in your AOA, if you had different clauses, follow them. No need to apply section 43. Clear? See, defaults point of view, once again I am telling you, defaults very important. Total some 16 to 17 defaults are there. Just observe carefully the screen. Defaults I classified into 2 categories. No subsisting default, no time defaults. No subsisting, no time. In no time you can see 3 years, 5 years. In 3 years, if you observe carefully, last 3 years, right now we are in the which year? 2024-25 financial year, yes or no? Next month onwards we are set to be in 25-26. Let's take we are in the year 25-26. Standing in this year, last 3 years means what? 24-25, 23-24, 22-23. Last 3 years you have no default. You have not defaulted in filing returns with ROC, and you are not penalized by the court or tribunal under RBI Act, SEBI Act, FEMA Act, SCRA Act. 3 years is different, 5 years is different. What is about 3 years? Last 3 years no default. 5 years means what? Default happened somewhere in the next, after 2 years rectification happened. Now here I should count like year of rectification plus 5 years. It's like forward calculation. Year of rectification plus 5 years. Okay na? Sir, how to remember? Very simple How many types of finance we are having? If you observe carefully, equity share capital, one finance, preference share capital, debentures, deposits, next one term loans from the banks, yes or no? Write term loans here itself, and remaining 4 just write under subsisting defaults. Remaining 4 write under subsisting defaults. With respect to equity share capital, what default I can do? I can do only dividends. I can do mistake of dividends. Preference share capital I can do redemption defect, redemption default. Debentures I can do default of redemption of debentures, payment of interest on debentures. Next, deposits I can make a default of deposits as well as interest on deposits. Term loans, if you observe, term loans including interest here. And preference dividend you have to right here. You have to remember preference dividend under 5 years. And what are the other two defaults? Employee statutory dues, IEPF transfers. Clear? Everyone? So I incorporated I incorporated all the points accordingly. But simply, if you observe this chart, you can. So just once again look at the screen. Defaults classified into how many types? 2 types. Subsisting time. Subsisting defaults means at the time of issue of DVRs, there should be no such defaults. How to remember? 4 sources of finance. What are those 4 sources of finance? Equity, default is dividend. Preference, default is redemption. Debentures, default is redemption as well as payment of interest. And last one is deposits, interest on deposits. Over. Next, coming to time. So we are having 2 time periods. Two time periods. One is 3 years, 5 years. 3 years means last 3 years you should not have these defaults. What are those defaults? ROC returns and penalties. That's it. ROC returns and penalties. Coming to 5 years, once default happens, you have to rectify them. After rectification, after year of rectification, wait for 5 years. So here only one source of finance it comes, but that is term loan plus interest. Next one, preference the dividend. Next one, employee statutory dues. Last one, IEPF. That's fine. So with this, equity shares with the differential rights completed. In this entire chapter, the lengthy topics is differential voting rights. Next lengthy topic is further issue of shares. Further issue of shares, section 62. Next buyback, and next reduction of capital. Buyback 68, reduction 66. And all remaining concepts are small concepts only. And one more concept is there, preference shares section 55. Transfer, it's a lengthy concept, but it's a points, transfer some 4 points, transmission some 2 points, like that only. But these are lengthy topics. Can I proceed? Next small topic is share certificate. Share certificate. In CA Foundation, you have listened to 2 words, document of title, document showing title. You remember? Document of title, document showing title. Document of title, whoever possesses that, he is the owner. Like share warrant, debenture warrant, railway receipt, whoever possesses it, they are owners of the properties. They are owners of the document. But document showing title means the possessor need not be a owner, but the person whose name is mentioned on the document, he is the owner. Like share certificate, property documents, property title documents. Let's see, Reliance Industry share image. So Reliance Industries Limited share certificate image. Yeah, I can zoom like this. So this is the share certificate issued by Reliance Industry Limited. Looking at this share certificate, 2 things are very simple. Two things are clear. One is, who are the owners of the company? One is Surendra, second one is Shil, third one is Neena. They are owners of this share certificate. Second thing is, for how much amount they are liable to the company? And the answer is, they are liable for 0 rupees. Why? Amount, equity shares each of rupees 10, that is face value. Amount paid up per share, that is a paid up value. Face value 10, paid up value 10, that means what is a liability? 0. So in future, company cannot deny 2 things. One is, they are not owners of the company, like that they can't tell. Second one is, they are liable for some amount, like that company cannot tell. Why? They are holding fully paid up shares. So rule of estoppel. What is rule of estoppel? Once you make a statement, once you make a fact, subsequently you can't deny the fact. You can't deny the statement. So like that, here rule of estoppel applies 2 times. One is ownership, second one is liability. And if you observe this share certificate, share certificate should be signed by company authorized officers, authorized representatives. If company is having company secretary, then one director and one company secretary have to sign this share certificate. If company is not having a company secretary, then two directors have to sign this share certificate. If company is having common seal, affix the common seal. This is a revenue stamp. This is not a common seal. I told you common seal, it's not a rubber stamp, it's a metallic strip. When you affix on the paper, you can only feel it, you can only sense it. Infosys share certificate image. So here you can observe the here you can observe it. Around the revenue stamp you can see the impression. Is it visible first of all? At least I think around the revenue stamp some seal visible, around the revenue stamp actually seal is there. I think now I think it should be visible. Okay, fine. Now looking at this share certificate, it is very clear. This is a concept of, here you can find joint shareholding concept. Two persons holding a single share certificate jointly. So for owners, rule of estoppel is applicable. Second thing, they are holding what type of shares? Partly paid up shares. 10 rupees is the face value, 5 rupees is the paid up value. So tomorrow they are liable for how much amount? 5 rupees. Fine. So share certificate, here I am talking about a physical share certificate. I am not talking about a demat share certificate, because on demat share certificate numbering not possible, signature not possible. Why? It is in dematerialized form. So share certificate issued under section 46 subsection 1 shall be distinctively numbered. Distinctively numbered. You can see here certificate number 23474. And the next person will get a certificate number 23475. So distinctively numbered. Next one, it should be issued under common seal of the company, signed by two directors, or if company is having a secretary, then one director and one company secretary. Note, if the composition of board permits, at least one of the aforesaid two directors shall be a person other than MD or whole-time director. That means, one MD, one other director shall sign the share certificate. A director is considered to have signed the share certificate if their signature is affixed under passive mail methods such as engraving, lithography, digital signing, but not by a rubber stamp. So if you observe, if your CA foundation mark sheet, if you observe, BOS secretary signature will be there on that mark sheet. Do you think individually signing your all mark sheets? No. But in printing, we are getting it. Yes or no? That's we call it as lithography or digital signing or engraving. That means it should not be a mere rubber stamp. It should be affixed either through printing or it should be manual signature. That's it. The director is personally responsible for authorizing the use of signature and ensuring the security of any machine, equipment, material used for the purpose. That means who is custodian of a machine, which prints share certificate? Director. Director should take care of, how many certificates got printed today. So how many certificates have been issued, to whom certificates have been issued. Everything, is taken care by authorized person. Next one, duplicate share certificate. First of all, tell me why duplicate share certificate comes into the picture. What is the reason of duplicate share certificate? If original is lost or destroyed. Lost means it's gone. Destroyed means, yes, piece of paper, right? Even some fire catches the paper. What happens? That paper will be burnt. Or original share certificate is defaced, mutilated, turned. Simply, it was turned into two pieces. So here if you observe, share certificate is lost completely, whereas here share certificate is there, but it was turned into some 2 or 3 pieces. So in the first case, submit indemnity bond. In the second case, surrender the pieces of share certificate available to you. Now you have to pay fees of up to how much? Rupees 50 per certificate as decided by the board. Now what board of directors will do? Board of directors, by passing board resolution, they authorize to issue duplicate shares. So disclosure, state duplicate issued in lieu of share certificate number and prominently print duplicate. That means just now I shown you the share certificate, right? So here the word duplicate was not mentioned. That means this is original share certificate. Suppose if these two people lost share certificate, if they apply for duplicate share certificate, now on the share certificate clearly mentioned that issued duplicate share certificate in lieu of original share certificate number, like that, you maintain a disclosure so that it is very clear, yes, which one is original, which one is duplicate, we can trace it out. Next one, how much fees they should pay? Max 50 rupees. Who will decide? Board of directors. Time limit. So today, if you apply for duplicate share certificate, within how many days you should get duplicate share certificate? The answer is, if you are a member of unlisted company, you should get duplicate share certificate within 3 months. If you are a member of listed company, then duplicate share certificate shall be issued within 45 days. Sir, listed company means always securities are in demat form. No sir, the securities which are offered to public shall be in demat form. Suppose company Reliance is there. It issued equity shares and which were getting traded on the stock exchanges. And it issued preference shares to the identified persons. Imagine. Preference shares are not traded on the stock exchanges. Preference shares are not listed. Only equity shares are listed. In that case, you lost preference share certificate. So if you want preference share certificate, you can get duplicate. And if you file an application for getting duplicate share certificate, you will get within how many days? 45 days. Time limits are very important, ma. For listed companies, how many days? 45 days. For unlisted companies, 3 months. Record keeping. So how many duplicate share certificates we issued? To whom we issued duplicate share certificates? Everything. Maintain a register in form SH2, and that register shall be at a registered office. So where I should preserve that register? Registered office or any other place where register of members is kept. Are you all getting my point? Next one, for demat form of shares, duplicate concept will not arise because loss of share certificate, damage to share certificate will not happen if shares are in demat form. Next one, depository records are prima facie evidence of the ownership. It's very simple, man. Suppose you are having 500 rupee note. If it is a paper money, you will show paper money. If it is in bank account, you will show bank balance, or you can show passbook. So whatever entry recorded in that passbook by the State Bank of India or by your bank, it is an evidence that you are having a 500 rupees. So depository records will act as an evidence that you are a shareholder, you are having ownership on so many shares. Next one, manner of issuing certificates or duplicate certificates. So how a company issues duplicate certificates? Let's see. Section 46 subsection 3 overrules company AOA for issuing certificates. That means which one is superior, which one is inferior? Section, that means act is superior, AOA is inferior. Share certificates are issued for physical shares only, but not demat shares. Prerequisites for issue. First thing, surrender letter of allotment or fractional coupons. So under private placement, you filed an application for shares and company made allotment. At the time of allotment, they will not issue shares. First, they will give you letter of allotment. Yes, your application has been accepted. You have been allotted with so many number of shares. Now, when you surrender this letter of allotment, against this letter of allotment, they will issue share certificate. Then what is this fractional shares, sir? Suppose company made an announcement like this, 1:9 bonus issue. Company made announcement like this, 1:9 bonus issue. For every 9 shares if you are holding, you will get 1 bonus share. If I am holding 90 shares, I will get how many bonus shares? I will get 9 bonus shares. If I am holding 9 shares, how many bonus shares I will get? 1. Suppose if I am holding only 8 shares, how much bonus share I will get? I will not get bonus share. Why? Shares are not available in fractions. So here what I will do, I will search for a person who is holding a single share. I will search a person who is holding a single share. For him, 1/9 fraction eligible. I am eligible for 8/9 fraction. So I will take this right, I will ask him to give that 1/9 right. I will pay some money. I will pay. 1/9 right I will get. Now this 1/9 fraction, 8/9 fraction, together how much it is? 1 share. So by surrendering these fractional coupons, I will get a complete share. Next one, share certificate must be in form SH1. What is the format of share certificate? SH1. On the share certificate, these three details shall be included. What are those three details? Names of the shareholders, number of shares held by the member, and what is the paid up value. Because this decides owner of the company, this decides ownership on how many shares. And this decides liability of the members of the company. Next one, recording of details. All issued certificates should be recorded in the register of members, including the date of issue. So this is all about registers. Next one, maintenance of share certificate records. Form SH1 and other related records. Blank forms for share certificate shall be machine numbered and printed under board resolution. Forms kept in the custody of CS. If no CS, then authorized person. All records shall be maintained for at least 30 years permanently in disputed cases. In case of dispute cases, you have to maintain records permanently. For other cases, 30 years. This is like similar to DDs in banks, demand drafts. If you want a DD, by depositing, the amount which you want, suppose you want a DD for 10,000. If you give 10,000 rupees to bank, what bank will do? It will give DD to you. So it's actually, it was prepared a long back, but on that, the particulars like who is the beneficiary, how much amount I should pay, these details will be incorporated. Like, checkbook, if you observe, checkbook. Banks prepare checkbook and bank will issue checkbooks to the account holders. So everything was pre-drafted. Now you will write the details of payee, you will mention the amount and you will sign it. That's it. Clear? So similarly, share certificates, blank share certificates. Suppose if you observe this one, before printing, this is a blank share certificate. So this paper was used to print details about Duleep and Maya regarding how many shares they are holding, how many shares, 100 shares. And you can also see distinctive numbers here, 22,03,801 to 22,03,900. That is the serial number of shares. Certificate number is different. Certificate number means how many certificates they have issued so far, that is certificate number. And how many shares they are holding, that is the distinctive number, that is different. So that means, before Duleep, other members, up to Duleep, remaining members, they are holding shares up to 22,03,800. And Duleep serial number is 801 to 900. And if you are a next person, you will get certificate number 23,475. And if you are holding some 100 shares, your serial number will be 901 to 1000. Understood? Everyone? Next, punishment for fraudulent duplicate certificates. Punishment for fraudulent duplicate certificates. Suppose, our managing director need money. He is planning for a world tour, he need money. So daily investors are coming and asking, sir, any person ready to sell shares, please let me know, sir, like that. You want to invest money in that company, and so you are waiting. So if any person comes and sells shares to you, you are ready to purchase those shares. But no one is coming to sell the shares. That's why managing director, what he did, he started, he opened a printing press. He took these blank certificates and he is making duplication of existing shares. Actually, when company should issue duplicate shares? If any person approaches company saying that, sir, my share certificate has been lost, I have lost share certificate, or my share certificate has been defaced, I need a duplicate share certificate, then only issue duplicate share certificate. But here, without any application, managing director duplicated original shares. Suppose total number of shares 1 lakh. Face value of each share is 10 rupee. Then total, how much is the total? 10 lakhs. So in this case, company will get a punishment of, even though managing director is making mistake, punishment comes to company. And what is the punishment? 5 times of 10 lakhs. That means 5 times of face value of shares involved in duplication. That is 50 lakhs. Maximum 10 times of the face value of shares or 10 crores, whichever is higher. Suppose 10 times of 10 lakhs means how much? 1 crore. And what is the statutory limit? 1 crore or 10 crores, whichever is higher. That means 10 crores. So minimum 50 lakhs, maximum 10 crores. Suppose 100 crores worth shares involved, sir. Then minimum 5 into 100 crores, that means 500 crores. Maximum 10 into 100, that means 1000 or 10 crores, whichever is higher. So simply 1000 crores. So minimum punishment is 500, maximum is 1000. Understood? So this is punishment to company, not to the individual directors. Sir, then what is the punishment to individual director, sir? Punishment is 447. Clear? So in this entire section, the chance of getting question is the punishment for fraudulent duplicate certificates or time limit for issuing duplicate share certificates. What is the time limit? 45 days for listed companies, 3 months for correct. Next question, intentionally managing director, to defraud the existing members, he printed duplicate share certificates worth some 10 crores. Then what are the consequences on the company? Company 5 times of 10 crores, 50, or 10 times of how many crores I told? 10, right? 10 times of 10 crores, 100. So minimum fine 50, maximum fine 100. And to the director who is in default, the punishment is section 447. Clear? Everyone? Can I proceed or break 5 minutes? I'll give you a break 5 minutes. So in share capital chapter, we completed 2 concepts, section 43, section 46. Moving on to next concept, section 47, voting rights of shareholders. Suppose Mr. Ajay, he invested 4 lakh rupees in a company C Limited. C Limited total paid up equity share capital is 10 lakhs, imagine. And how much he made investment? 4 lakhs. For which C Limited issued equity shares. And what is the face value of this equity share capital? 4 lakhs. Okay, now listen carefully. So with this 10 lakhs, C Limited acquired one land and building, furniture, some plant and machinery. Say for example, land and building 6 lakhs, furniture 1 lakh, plant and machinery 3 lakhs. So total how much? 10 lakhs. And what Mr. Ajay got? Ajay got 4 lakhs paid up equity share capital shares. Clear? Now one day, Ajay want his money back. That's why what Ajay did? Ajay went to the company and asked, so give me my share of assets in the company. So I invested 4 lakhs. And you are telling that land and building 6 lakhs, furniture 1 lakh, plant and machinery 3 lakhs, so total 10 lakhs. So take my share capital, give me furniture and plant and machinery. Now tell me, the intention of Ajay, is it correct? Do you think is company C Limited bound to return furniture, plant and machinery to Ajay? The answer is no. Why? Because this is not a partnership firm. This is not a partnership firm. This is a company. So in case of company, who is owner of the assets? Company is owner of the assets. And who are owners of the company? Members are owners of the company. That doesn't mean members are owners of company assets. That's what separate legal entity. Now what is the use of these shares? He got shares, face value, how much? 4 lakhs. He got shares of 4 lakhs. With the shares, he can't even get share in the assets of company. Then what is the use of holding these shares? To clean his tongue? To clean his tongue? No, then what is the use of holding shares of 4 lakhs? He is not getting a share in the company assets. Tell me, in return what he is getting? That's what, in return he is getting some rights. He is investing 4 lakhs not to get a share in the company assets, but to get some bundle of rights. In that you can see first one is share of profits, we call it as dividend. Second one, whenever company wants to make a decision regarding alteration of MOA, alteration of AOA, alteration of name clause, shifting of register office from one city to another city. Next one, issue of preferentials, issue of equity shares with the differential rights. For all these decisions, yes, company should consult this member Mr. Ajay. That means right to be consulted. Accordingly, he is entitled to attend a general meeting. He is entitled to vote at a general meeting. So this bundle of rights, for getting this bundle of rights, he is making investment of 4 lakhs into the company, and for which he is getting shares. So tomorrow if he need money, yes, he can transfer these shares to a person who is ready to buy those shares. Suppose Mr. Charan want to purchase those shares for 4,20,000 rupees. So Ajay, you transfer those shares to Charan for 4,20,000, and the transfer, yes, company will register the transfer. Now who will become shareholder? Charan becomes shareholder. Are you all getting my point? Now one among such bundle of rights is voting rights. Let's see. Voting rights of equity shareholders. Every equity shareholder, is it equity shareholder or preference shareholder? Equity. Not all shareholders, only equity shareholders has right to vote on all resolutions placed before company. First of all, resolution means what? Sir, 31st December night, me, my friends sit together. We think on next year new proposal, sir. That is resolution, sir. Yes, sir. No, resolution means, it's a process of accepting a proposal. It's a process of accepting the proposal by the authority. In case of AGM, authority is members. In case of board of directors meeting, authority is directors. Getting my point? It's simply a process of obtaining consent from the authority. And we had one more word called motion. Motion is nothing but proposal. Motion is nothing but proposal. When this motion got accepted, we call it as resolution. Who accepts this motion? Authority accepts motion. In case of AGM, members comes under the authority. In case of board meetings, directors comes under the authority. Clear? Everyone. So every equity shareholder has a right to vote on all resolutions placed before company in the general meetings. Not only general meetings, sometimes through postal ballot. In case of poll, voting rights on a poll are proportional to the shareholder's share in the paid up equity share capital. See, here we are having two types of voting. One is show of hands, other one is poll. So what is the difference between show of hands, poll? In show of hands, chairman, after introducing the motion, he will ask how many of you are in favor. Come on, raise your hands. How many of you are against to the proposal? Raise your hands. So here voting will happen through showing the hands, raising the hands. And in case of poll, a ballot paper is given to the persons attended the general meeting. In that ballot paper, you can exercise your voting rights. And the important difference between show of hands and poll, suppose in show of hands, a person is holding, imagine a person is holding one share. How many votes will be given to him? One vote only will be given to him. Suppose another person is holding some 1 lakh shares. How many votes are given to that person? One vote only, because it is not possible to raise hand 1 lakh times. 1, 2, 3, 4. It is not at all possible to count also. Correct? So here, irrespective of shareholding, each and every equity shareholder will be given one vote. But coming to poll, one share equal to one vote. Suppose the person is holding 10,000 shares, then how many votes he will get? 10,000 votes, provided all these shares are fully paid up. All these shares are fully paid up. Suppose few shares fully paid up, few shares partly paid up, then proportional voting power will happen. Proportionate voting power will come. Suppose there are two class of shares, class A, class B. Class A fully paid up, 10 out of 10 fully paid up. Class B only 5 rupees paid up. So in this case, if they get one vote, these people will get a half vote only. The reason is we are talking about paid up equity share capital. So in this paid up equity share capital pool, how much you are holding? Suppose total paid up equity share capital is 10 lakhs. I am holding 1 lakh in this pool, sir. Okay, 10% voting right for you. I am holding 50,000, sir. 5% voting right to you. I am holding 5 lakhs vote. I'm holding 5 lakhs worth paid up equity share capital, sir. Then 50% voting power. Everyone getting my point? So one share equal to one vote. I assume that all shares are fully paid up. Next one, in case of Nidhi companies, a member cannot exercise voting rights exceeding 5% of the total voting rights. Very, very important point. MCQ, 100% chance is there. Listen carefully. Nidhi company, suppose let's have 5 persons, A, B, C, D, E. Total share capital, imagine 10 lakhs. Equity share capital of Nidhi company, 10 lakhs. Mr. A is holding 10,000, B is holding 20,000, C is holding 40,000, D is holding 80,000, and E is holding 1,60,000. Now you have to determine voting power of each and every member. Come on, tell me. Voting power of each and every member. A is having how much voting power in the company? Tell me. 10,000 divided by 10 lakhs, that means 1%. Correct? Correct? Next, B, 20,000 is the paid up share capital. B is holding 20,000 paid up share capital out of 10 lakhs. So 20,000 divided by 10 lakhs means 2%. Mr. C, 40,000 divided by 10 lakhs, that means 4%. Mr. D, 80,000 divided by 10 lakhs, that means how much? 8%, but restricted to 5% only. D can exercise how much voting power? 5%. Mr. E, 1.6 lakh divided by 10 lakhs means 16%, but E can also exercise 5% voting power. Maximum voting power a person can exercise in Nidhi companies 5%. Suppose if this is an ordinary company other than Nidhi company, then A 1%, B 2%, C 4%, D 8%, E 16%. Clear? So in case of Nidhi company, what is the ceiling limit? 5%. Maximum a person can exercise 5% voting power. Next one, voting rights of preference shareholders. Generally, preference shareholders will not get any voting rights. They get voting rights with respect to the areas which are affecting them. Areas which are affecting them, like variation of preference share rights. Suppose you told every year I will pay 10% dividend. 10% preference share capital, 10 lakhs, redemption after 10 years. Like that you made a proposal and you allotted preference shares. Now looking at this statement, preference shareholders are entitled to two rights. Right number one is every year they are entitled to dividend of 10%. Right to two is they are entitled to redemption after 10 years. Now the time is not good. You are not in a position to pay 10%. You want to reduce it to 9%, or you want to increase the number of years from 10 to 11 years. In both the cases, the rights of preference shareholders are getting affected. So you have to take consent of preference shareholders. Next one, winding up of the company. So in the event of, if you want to liquidate the company along with equity shareholders, preference shareholders are also given a right to vote. Next one, for repayment or reduction of capital or preference share capital. So simply this is nothing but reduction of capital. Section 66. In case of reduction of capital, along with equity shareholders, preference shareholders also get voting power. Clear? Only in 3 cases preference shareholders get voting power. What are those 3 cases? Matters affecting their rights, winding up of the company, reduction of capital. Except these 3 areas, in one area preference shareholders get voting rights. When, sir? If preference dividend remains unpaid for 2 or more years, consecutively 2 or more years, those shareholders can also vote on all resolutions like equity shareholders. It's like simple. If father income is not sufficient, suppose if husband income is not sufficient, who will also work in that family? Wife will also work. Because of equity shareholders decisions, company is not in profits. Now who will also get right to participate in that voting? Preference shareholders. When? If the dividends are in arrears for 2 or more years. Are you getting my point? It's not arrears. I'm sorry, it's not arrears. If preference dividends remains unpaid for 2 or more years, that means if they are not getting dividends, that means this point, in this point, the right of voting, who gets the right of voting? Cumulative or non-cumulative? Answer is both. Let me repeat the point one more time. Sir, suppose preference shares are cumulative preference shares, sir. They are not getting dividends for the last 3 years. Will they get voting rights? Yes. Suppose preference shares are non-cumulative preference shares, sir. Last 3 years we are not paying dividends, sir. Will they get voting rights? Yes. Whether cumulative or non-cumulative. If we are not paying dividends to them for 2 or more years consecutively, they get voting rights. How long they can exercise voting rights, sir? Till the dividends remains unpaid. Till the dividends remain paid. Until dividends remain unpaid, they will get voting rights. Suppose this year you cleared all preference dividends, then their voting rights will become 0. In case of poll, voting rights on a poll are proportional to the shareholders' share in the paid up preference share capital. Next one, ratio of voting rights between equity shareholders and preference shareholders is proportional to the paid up capital. Paid up capital. Suppose equity share capital 10 lakhs, preference share capital 5 lakhs. So now paid up share capital means equity plus preference, that is total how much? 15 lakhs. Imagine Ajay is holding 1 lakh equity share capital. Sorry, 1.5 lakh equity share capital. 1.5 lakh equity share capital. Suppose if preference shareholders are getting dividends on timely basis, then what is the Ajay voting power in the company? Ajay voting power in the company is 1.5 lakh divided by 10 lakhs, that means 15%. Imagine preference shareholders are not getting dividends for the last 3 years. Now what is the voting power of Ajay, sir? Ajay voting power is 1.5 lakh divided by, it's not 10 lakhs, it is 15 lakhs. Because who is also getting voting power? Preference shareholders are also getting voting power. So here you have to take a paid up share capital, that means 1.5 divided by 15 lakhs, so total 10%. So that is the meaning of this point. Ratio of voting rights between equity shareholders and preference shareholders is proportional. Suppose here equity shareholders holding 10 lakhs, preference shareholders capital is 5 lakhs. So equity shareholders voting power is 2/3, whereas preference shareholders voting power is 1/3. Is it clear? Shareholders vote proportionately to the paid up share capital of their share class in AGMs as well as EGMs. Next one, non-applicability. Section 47 does not apply to private companies specified IFSC public company provided MOA AOA provides for it. If you remember first class I told you, compared to public company, private company will have relaxations. This is such instance. So section 47 will not apply if private company MOA AOA decides otherwise. If MOA AOA is silent, then section 47 is applicable. Suppose if they write that preference shareholders will not get voting rights even their dividends remain unpaid for 10 years. Like that, if a private company writes such clause in AOA, preference shareholders will not get any voting rights. Clear? Everyone? Next. Variation of rights of shareholders. 3 times this concept came in the examination so far. 3 times. Variation of rights of shareholders. Let's see. %, preference share capital, amount 1.5 crore, redemption after 10 years. So today I am offering a preference shares. I am telling that every year how much dividend I will pay? 15%. And when I will redeem? After 10 years. When will I redeem? After 10 years. So looking at this statement, preference shareholders will get 2 rights. Right number 1 is 15% dividend, and right number 2 is redemption after 10 years. Now if you change the rights of preference shareholders, we call it as variation of rights. Suppose if you want to reduce 15 to 13, or if you want to increase this 10 years to 15 years, this is said to be variation. As you all know, Variation of terms and conditions require mutual consent of the parties. Here, who are the parties? Company one side, it is making a proposal. Let's reduce dividend to 13, or let's increase redemption period to 15. And who is the other party? Preference shareholders. If meeting is possible, if the total number of members is less than or equal to 200, imagine. Total number of members less than or equal to 200, imagine. If meeting is possible, call them for a meeting, take special resolution. Suppose in that company 300 members are there. How many? 300. Then you have to conduct voting through postal ballot. In that case, obtain consent from 3/4 preference share capital holders. Let me repeat one more time. 3/4 preference share capital holders. It's not 3/4 holders. It's a 3/4 capital holders. Sir, what is the difference, sir? How much is the capital, ma? 1.5 crore, yes or no? Just take calculator and tell me 1.5 crore into 3/4. I think 75 lakhs, 37.5 lakhs, 112.5 lakhs. Now listen carefully. Listen carefully. Total preference shareholders are, imagine, 10 in number. It's not 10, 100 in number. How many? 100 in number. One member alone is holding 1.2 crore paid up, preference share capital, and remaining 99% are holding a 0.3 crore preference share capital. Now getting consent from this single member is sufficient. Why? I'm using the word holders of 3/4 paid up preference share capital. If it is 3/4 of the holders, then that means 3/4 of 100, 75. I'm not using word 3/4 of members. I'm using the word 3/4 of the capital holders. So 3/4 of the capital, if it is held by one person, then get consent from that person. If it is held by two persons, get consent from these two persons. Clear? Once again I'm telling you, if meeting is possible, what type of resolution I need? Yes, sir. Sir, meeting not possible, sir. Postal ballot applicability is there, sir. Then 3/4 value holders should give consent in writing. This is consent, okay, fine. But you need to check whether constitutional documents allowing you to change the rights of the members or not. Constitutional documents means check MOA, AOA. Suppose MOA, AOA is silent, sir. Then look at the terms of issue. The terms of issue. The terms of issue means what, sir? Very simple. If you had made offer to the public at a large, you might have issued document called a prospectus. If you have made an offer to the identified persons, you might have made offer through private placement, offer come application letter. Go through the documents. In these documents, about variation, observe one clause. Suppose variation is prohibited. Suppose variation is prohibited, then don't make variation. Sir, this point is not at all there in the issue terms, sir. Then you can proceed with a variation. Let me tell you one more time. So for variation, we need consent of parties. Before that, you need to check constitutional documents. If constitutional documents are allowing you to change the rights, change. Suppose constitutional documents are silent, sir, then go with issue terms. Check whether issue terms prohibits variation or not. Sir, issue terms are silent, sir, then you can proceed. With how much consent? Either special resolution at meeting or 3/4 of the capital holders consent in writing. But sometimes what happens, changing rights of one group affects the rights of another group. For example, for this, my company is having ordinary shares, my company is also having differential rights. Ordinary shares, one share equal to how many votes? One vote. Differential rights, 10 shares equal to one vote. Now, in company, 1 lakh ordinary shares are there, differential shares, 1 lakh differential rights also there. If you observe here, normal voting rights, for ordinary shares, 1 lakh into 1, total votes how many? 1 lakh. Whereas for differential rights, total number of votes how many? 1 lakh into 1 by 10, that means 10,000. So total voting power, if you observe, it is 1 lakh 10,000. In this 1 lakh 10,000, ordinary shareholders, they are holding some 90%. Imagine 90% of the total voting power. And differential rights, they are holding how much? 10%. It will be 9 point something, but let me round it off. So 90% of the voting power is left with ordinary shares. 10% of the voting power is left with differential rights. Now, company decided to change this clause. Company decided to change this clause. How they want to change this clause? Like this, 1 share equal to 10 votes. For example, 1 share is equal to 10 votes. Now after variation, what happens? Just observe, after variation what happens? Instead of 10,000 votes, how many votes they will get? 10 lakh votes. And 1 lakh is constant, so total voting power means 11 lakh. In this 11 lakh, ordinary shareholders contribution is 10%, differential rights contribution is 90%. Previously 90% is left with ordinary, 10% is with differential. But because of variation of differential rights, ordinary shareholders rights are getting affected. Are you getting my point? Now variation of this particular clause alone is not sufficient. You have to sorry, approval from this class alone is not sufficient for such variation. You have to take approval from this class also. Getting my point? Everyone, what is the first step? Check constitutional documents. Next step, check issue terms if constitutional documents are silent. Then proceed with members approval. What kind of approval? Special resolution at general meeting, or if it is through postal ballot, 3/4 of the members consent. Let's see. Rights of class of shares can be varied if consent is obtained from at least 3/4 of the holders of issued shares. Issued shares holders of that clause in writing, or special resolution in a separate meeting. They are not just telling 3/4 of the holders, they are telling 3/4 of the share capital holders. So here for me value is important, not number, value. Or special resolution in a separate meeting. Sir, whether it is special resolution or in writing, it depends on number of members. If number of members is up to 200, postal ballot is not mandatory, it's optional. Then go with special resolution in separate meeting. If number exceeded 200, then postal ballot is mandatory. In that case, you have to obtain consent in writing. Variation is allowed if provisions for variation are included in MOA, AOA, or in the absence of such provision, it should not be prohibited by the terms of issue of the shares. Here terms of issue means prospectus or private placement. Everyone, regular class or crash class? Crash, right? So that's why somewhat speed you will observe. Comfortable? Yes sir. No. Yes, okay. Next one, impact on other classes. If variation affects the rights of another class, consent of 3/4 of that other class is also required. Next one, no consent for variation, application to the tribunal. That means members who are not giving consent for the variation, if they want, they can go and file application with a tribunal. Let's say if holders of 10% or more of issued shares of a class did not consent means what? Against. They can apply to NCLT to cancel the variation. Suppose company propose, company at the time of issue they offered 15% dividend. Now the company want to reduce it to 13%. 90% gave approval, 10% are against to the proposal. Now this 10%, if they want, they can go to NCLT. Yes or no? So within how many days? Within 21 days from the date consent was given or resolution has been passed. So tribunal decision is binding on all the shareholders. The company shall file a copy of tribunal order with ROC within 30 days of NCLT order. Very simple ma. This 10% are said to be aggrieved party. Yes or no? Aggrieved party means party who is suffering. Suffering party, what he will do? He will cry. So law is also asking him, cry, but not in front of me, in front of NCLT. And for crying also status is important. How much status needed? 10% status needed. And if you want to cry within how many days? 21 days. Sir, 1 month completed, sir. Don't cry. Okay, na? So if you want to cry within how many days? In front of me or in front of you? in front of NCLT. No, don't write cry, write application in the place of cry. Tribunal decision is binding. Okay, special points. Let's see. Issuing new preference shares pari passu with existing shares does not require consent of preference shareholders. Pari passu means equal priority. Equal priority. Suppose first time I issued preference shares, after 1 year I issued another preference shares. Now with respect to payment of dividends, everyone will get a equal priority. That's it. Cancellation of shares, reduction of capital does not amount to variation of rights. Correct, because cancellation of unsubscribed shares, reduction of capital, to this logically the provisions of variation will not apply. Variation is one different concept and these two are different concepts. For reduction of capital we will apply section 66. For cancellation of share capital we will apply section 61. Okay, now so variation completed. In variation, if they want to ask a question, dissenting shareholders want to file an application with NCLT. They don't know about the provisions of Companies Act regarding how many number of members should file an application with NCLT and within what time limit they want to file application with NCLT. Please advise. And the answer is 10% of the class capital. Application shall be filed within 21 days of either special resolution or consent has been provided to the company in writing. Clear, everyone? And what is the time limit for filing NCLT order with ROC? 30 days. So far, how many sections we completed? 43, 46, 47, 48. Right? 43, we had only two time limits. One is 3 years, other one is 5 years. What is all about 3 years? Last 3 years, no defaults. And what are those defaults? Non-monetary, monetary. Non-monetary means ROC. Monetary means penalty. Penalty by court or tribunal under FEMA, SEBI, SCRA. Remember. Next 5 means after rectification. After year of rectification, wait for 5 years. And this is for term loan, interest on term loan. Preference dividend, employee statutory dues, i.e. PF. So these are the time limits under section 43. Next, what is the time limit? What are the time limits I discussed with you in section 46? Two time limits I discussed with you. Issue of duplicate share certificate. 45 days in case of a listed company. 3 months in case of come on, tell me, 45 days in which case? Listed. 3 months in case of? Okay, fine. Apart from these two time limits, we had no another time limit. But we had one punishment clause. The punishment clause is officer in default always gets 447. Whereas company will get punishment of minimum 5 times, maximum 10 times or 10 crores, whichever is higher. That is all about 46. Next one, 47. Only one limit I told you. What is that one limit? In case of Nidhi company, a member can exercise maximum how much voting rights? 5% voting right. That is the only one limit. Another limit is if preference shareholders dividends remains unpaid for 2+ years, then they will also get voting rights. Next 48, two time limits. 10% dissenting shareholders can file application with NCLT within 21 days. And whatever NCLT passes an order, it is binding on company and members, and the same shall be filed with ROC within 30 days. Clear? So like this, the moment you complete one concept, after completion of another concept, revise previous concept. Trust me, you will not forget those concepts. Can I? Sir, 2 sections you ignored. No, sir. Those 2 sections are very, very small sections, ma. What are those 2 sections? Not relevant for examination. Nature, ma. Share nature is a goods. Every share is a movable property. It is transferable, similar to the goods. Next one, numbering. Tell me, shares should have a common numbering or distinctive numbering. I already shown you in a share certificate. That's it. So these 2 are very, very small concepts. For the time being, in institute material also, these 2 sections are not there. But nature means they are mobile in nature. Numbering means distinctive numbering. That's it. So up to 48 we completed. Next small part, that is 49 to 51. Let's see. 49. What is 49? Calls on shares. Calls on shares. When I discuss with you shelf prospectus, you should get a doubt like this. Sir, instead of making 4 public offers in a year, at the time of application, let's collect to 25%, sir. At the time of allotment, let's collect 25%, sir. Call 1 25%, call 2 25%. Like this also possible, no, sir? Possible only. But this leads to forfeiture. Why? Because our mindset is like this. If someone sells India in installments, everyone will pay first installment. Yes or no? Definitely yes. So even financially incapable people also looking at this 25%, they will try to purchase shares. But when company is making calls on shares, few people may make default in paying call amounts. Now what company should do? Issuing notices. If they didn't respond, forfeiture. Again reissue of forfeiture share. For us, business important, compliance procedure important, business is important. So why this nonsense? Let's go with shelf prospectus, where I will make 4 public offers. Each time I will issue information memorandum. First time prospectus, next time information memorandum. Up to how many months or how many years? 1 year. 1 year from the date of first public offer. Correct. Understood. Now calls on shares. So this is the powers of a directors to make calls on shares. Board of directors, by passing board resolution, they will fix 2 components. How many? 2. What are those 2 components? First one is call amount. Second one is due date for payment of call. So calls, liability of a shareholder to pay full value of partly paid up shares is enforced by making calls. Statutory liability, section 10 subsection 2. If you remember section 10, what is section 10? Effect of MOA AOA. Company is liable to members, members are liable to company. Members among themselves directly no, but indirectly yes. 10 subsection 2 states that all money payable by a shareholder under MOA AOA is a debt owned to the company. It's like borrower debt owned to the bank. Yes or no? If borrower takes loan from a bank, for example 10 lakhs, for this 10 lakhs borrower is liable to bank. But coming to company, if you observe, C Limited member face value is 10 rupee, paid up value is 8 rupee. So with respect to 2 rupees, company can recover that money from member as if company stands in the position of bank, member stands in the position of borrower. If you observe the difference, first borrower will take money from a bank, but here member will not take money from company, but still member is liable like a borrower. That's what the meaning of this point. All money payable by a shareholder under MOA AOA is a debt owned to the company. Next one, related sections. Liability arises, when liability arises? Only when a call is made. Related sections 49, 50, 51. Let's see. Calls must be on uniform basis. Calls must be on this point. A previous, I think September attempt, 5 marks question came. 5 marks question came in the September attempt. The question is like this. Company made a calls on shares, for example 10 rupees is the call amount. Face value is how much? 100 rupee. So far 60 rupees collected. I'm just telling facts. Amounts, forget about the amounts, but I'm just telling you the question points. Face value is 100. So far paid up value 60. Now company made a call of how much? 10 rupee. One particular member failed to pay the call amount. That's why company asked him to pay balance complete amount, that is 40 rupees. Now company calling 40 rupees from the member. Is it correct as per provisions of Companies Act? Answer is incorrect. Why? Call should be uniform basis. Uniform means what? For you if it is 10 rupees, for me also 10 rupees only. So shares belonging to one class, for that class, call money should be equal. Suppose sir, this group I like very much sir, so for these people only 1 rupee sir. That group I hate sir, so for them 5 rupees sir. Possible or not possible? For each class, in that class, each and every member is liable for equal amount multiplied by number of shares held by that person. Next one, section 50, calls in advance. If company wants to accept calls in advance, it can accept calls in advance through AOA authorization. Next one, dividend rates on paid up amounts. Let's see one by one. Calls must be uniformly made for all the holders of a given class of securities. Shares of same nominal value but different paid up amounts do not fall under same class for uniform calls. For this, if you observe Tata Motors company, Tata Motors, ordinary share face value is 2 rupee, differential share face value is also 2 rupees only. Now just looking at face value, sir, these two belongs to only one class. No, sir. No, 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 no. Even though face value is equal, it need not be same class. Because one is ordinary shares, other one is differential shares. Can I proceed? Shares of same face value but with different paid up amounts do not fall under same class for uniform calls. Shareholders may pay a part of the call amount due. The company is obligated to accept the amount tendered. So that means what? If shareholders want, they can pay part amount, they can pay full amount. But if calls are said to be in arrears, then company can take action against a defaulting person. Calls in advance. Company, if authorized by AOA, may accept advance payments of unpaid amounts. If you observe in this one point, the important condition is there for accepting calls in advance. What is the important condition? AOA authorization. Suppose if AOA is silent, can company accept calls in advance? No. Accepting calls in advance is not at all possible. Next one. Advance payments do not confer extra voting rights until amount is officially called up. So simple provision, right? Very simple provision. Let's see. ICICA Inter suggested answers. First question, if you observe, okay. These are multiple choice questions. First theory question. Just look at the question. 5 marks. First question only tricky question. SAB Health Products Limited. Okay, this is not a private company. It's a limited company. Issued equity shares worth 5 crores. It was fully subscribed and partly paid at 50 each. The company made a call to all its subscribers to pay a sum of 30 for each share held by them. Mr. GH, a subscriber to the shares of a company holding 10,000 shares, paid all the money due on the shares. That means in advance. Later, GH claimed interest on money advanced by him and also dividend in respect of advance money paid. Is his claim justified? One shareholder. Another shareholder, Mr. LK, holding 15,000 shares, did not pay the first call. So directors called upon him to pay the entire amount due by him in respect of the shares held by him. Referring to the provisions of Companies Act, rules made thereunder, examine whether the directors of SAB Health Products Limited permitted to do so. Share capital, if you observe, buyback, interesting concept is there. Bonus issue, important concept is there. Rights issue, another important concept. Preference shares, another important. Differential voting rights. So some 5-6 important concepts are there. Keeping all these concepts aside, simply they asked a question on calls and shares. Clear? So that's what expect from unexpected areas. So here total 3 questions. One is interest on calls in advance, dividends on calls in advance, next voting rights on calls in advance, and last call need not be uniform basis. 4 questions in 1 question, and it is for 5 marks. No heart at all, heartless fellow framed this question. But for us it's not necessary. Just look at the provision. 50, 51, everything. 49, 50, 51. So Mr. GH is entitled to claim interest on money advanced by him and also dividend in proportion to the amount paid up on share if so authorized by articles of the company. So here you need to remember one point. If question is not clear, then answer should also it should not be clear. That means don't write whatever you know. Write along with assumption. If you observe that answer, last point, if so authorized by articles, that is assumption. Next, in the matter of LK, the action of board of directors of SAB Health Products Limited towards LK for calling to pay entire amount due by him in respect of shares held by LK is invalid and not permissible. And I am asking you, do you think, even all India first ranker will write all this stuff? No, he will not write all this stuff, but meaning should convey, that's it. Because if you observe that last paragraph, the simple line is sufficient. The contention of directors with respect to Mr. LK is not permissible, that's it. But how they wrote, the action of directors of company towards member for calling to pay entire amount due by him in respect of shares. First one is amount due. Next one is in respect of shares held. Array, definitely in a company, person is liable for his shares only, not for other shares. So he is having plenty of time. That's why he drafted beautifully. But for us, we are having how many hours time in exam? 3 hours. So conveying answer is sufficient. So that's what, after looking at this question, I came to know that buyback waste, debentures also one section 71 is there. In debentures lot of points are there. That means all are unimportant, only this one is important. That's why only I am telling you, at the beginning of first lecture also I told you clearly, instead of studying share capital, if you study dividends, deposits, charges, preliminary thoroughly, that means covering all areas, you can easily write some 15 marks. Can I proceed? 50 completed, 50 calls in advance when it is possible, only when it is authorized by AOA. And advance payments do not confer additional voting rights until amount is officially called. That means until that call in advance becomes capital, no extra voting. Because you remember section 47, voting rights always talks about paid up share capital. Paid up share capital. Paid up share capital means it excludes calls in arrears. It also excludes calls in advance. Calls in advance is a liability to the company. It's not a capital. Next, proportionate dividend. Dividend may be paid proportionately based on paid up capital, including calls in advance, subject to, in exam also same point, if authorized by AOA or subject to AOA. See what generally happens. Suppose face value is 10 rupee paid up value 6 rupee. Company declared dividend like this, dividend at the rate of 10%. If nothing is mentioned in AOA, then this 10% should be applied on 10 rupees. In AOA, if it is specifically mentioned that dividend will be paid only on paid up value, then this 10% should be applied on 6 rupees. Now the point is, suppose if someone deposited 4 rupees calls in advance, if AOA is silent, then he will get a dividend on 10 rupees. That means including calls in advance. Are you getting my point? But if AOA authorizes company to pay dividend only on paid up value, then he will not get dividend on calls in advance. That's what, if you look at the answer, that's what the assumption they drafted in such a way. Also, dividend in proportion to the amount paid up on each share if authorized by AOA. Or else he will get dividend on face value, which includes calls in advance. In that case, whether it is calls in advance are irrelevant, because suppose 6 rupee paid up value, I paid 6 rupee, you paid 10 rupee. If AOA is silent, you will get dividend on 10 rupees. I will also get dividend on 10 rupees. Clear? Next one. The board may decide to pay dividends on pro rata basis if all equity shares are not equally paid up. Pro rata means proportionate. Suppose one class fully paid up, other class partly paid up. So fully paid up shareholders, on paid up value they will get complete dividend. Partly paid up, since it is half paid, for example, on that half paid only they will get dividends. Preference shares dividend is always paid at a fixed rate for preference shares, correct? At the time of issue of preference shares, if I tell 10%, then if I tell 10%, they will get dividend of how much? 10% only. So with this 49, 50, 51, 3 sections completed, basics completed. Clear? Break or can I continue? Next part, 52 to 55. 52 to 55, maybe some 25-30 minutes. Can I proceed? Okay. So issue of shares at premium. Issue of shares at premium. Premium means what? Above the face value. That means if issue price is greater than face value, the difference is treated as premium. For me, premium is nothing but goodwill. Suppose a partnership newly started, each and every partner will contribute capital. Suppose that partnership is 20 years old, and if someone wants to join that firm, now how much amount they will pay? Do you think they pay only capital, or do you think they will also add goodwill? Why? Because it is in existence over a period of 20 years. Now similarly, our company is in existence for the last 40 years. Now you want to become member in my company. Now you will get share not only in our company capital, but also you will get share in our company reserves and surplus. So you pay extra amount. That extra amount is called a premium. Simply it's a goodwill. So here section 52 is not talking about how much securities premium I should fix. It is not talking about quantum of securities premium. It is talking only about utilization of securities premium. Let me repeat, section 52 is not telling that how much premium to be fixed. It is telling about utilization of premium. Suppose if you fix too much premium, no problem. Under income from other sources, you are liable to pay tax on that securities premium. This is as per Income Tax Act. Yes or no? If you fix too low securities premium, then that is loss to you, opportunity cost to you. Clear? And one more point, AOA authorization not at all required for fixing securities premium. Remember this point. So can a company issue shares at a premium only with AOA authorization? True or false? False. So here AOA will not do anything at all. When a security is issued at a price higher than face value, it is called issue at a premium. Difference between issue price and face value is the premium. Premium received is transferred to securities premium account. And tell me, do you think securities premium is received only in the form of cash or in the form of kind or both? Cash, kind, both. Which one? Suppose cash, issue of shares at a premium for cash, okay. In case of kind, you can observe amalgamation. In amalgamation, purchase consideration is settled by issuing shares. So there, I won't get securities premium in cash. I get securities premium in kind. So cash, kind, both possible. Next one, for reduction of capital, securities premium is treated at par with paid up capital. So this I will tell you in section 66 or at the end of this section. Next one, application of securities premium account. So for what purpose I can utilize securities premium, sir? All companies can utilize securities premium for 5 purposes. How many? 5. What are those 5 purposes? Break even point. Do you remember break even point? B square E P square. B square means buyback bonus issue. E stands for expenses connected with the issue of shares, issue of securities. P square stands for writing of preliminary expenses. Next, premium on redemption of preference shares or debentures. B square E P square. Bonus buyback, utilize securities premium. Expenses connected with issue like underwriting commission, utilize securities premium. Next one, writing of preliminary expenses. Next, premium on redemption of preference shares. But if you are a company preparing financial statements according to accounting standards, that means section 133 company, then for you securities premium can be utilized only for B square E, that is bonus issue, buyback. One second. So section 133 companies means what? Section 133 companies means companies which are preparing financial statements in accordance with accounting standards. For them, securities premium can be utilized only for 3 purposes. One is unissued equity shares to be issued as fully paid up bonus shares, writing of an expenses connected with issue of shares. Next one, buyback of shares. Simply buyback, bonus issue, expenses. Now if you remember bonus issue accounting entries, in case of bonus issue, definitely we need to increase equity share capital, yes or no? Since we are issuing equity shares, equity share capital should be increased. Equity share capital is a credit component. So to equity share capital account, for example 10 rupee. Now we should debit something, right? In accounts we are following what concept? Double entry concept. In case of double entry concept, we should debit something or else there would be no matching. So debit, what I will do? Debit I will do either CRR or I will do securities premium or I will debit free reserves. So CRR account debit, securities premium account debit, free reserves account debit. So these three 10. Now if you observe, securities premium is which account, credit account or debit account, which balance account? Credit balance account. And for reducing this, what we will do? We will debit. Now this entry tells us that utilization of securities premium. Now the question is, apart from these three purposes or apart from these five purposes, if I utilize securities premium for any other purpose, then reduction of capital will apply. Sir, apart from these 3 or 5, for what purpose I will use securities premium, sir? Very simple. For payment of dividends, you are utilizing securities premium. Securities premium account debit to provision for dividends. Provision for dividends account debit to bank account. That means fund is going out. So if you utilize securities premium for a purpose which is not stated here, then instead of debiting securities premium, you debit a share capital account. That's what reduction of capital provisions. Clear? Everyone? 52 over. Section 52 over. Next 53. What is 53? What is 53? Issue of shares at discount. Allowed or not allowed? Allowed or not allowed? Not allowed. Very simple. Not allowed. Not allowed. Prohibited. Very simple. See, I became member by subscribing shares at face value 10 rupee. Like me, there are some 1000 individuals. Now if company is offering share at 8 rupees to the new members, definitely it's an injustice to existing members. Yes or no? So that means for new members, some preferential treatment is giving. It's a loss to the existing members who are holding shares at a face value. So issue of shares at discount is 100% void. But we had two exceptions. Exception 1 is sweat equity. Exception 1 is sweat equity. And exception 2 is issuing shares at discount under a scheme called debt restructuring scheme or statutory resolution plan. How many of you remember internal reconstruction? Internal reconstruction, you can see like this. For example, equity share capital 10 lakhs, creditors 20 lakhs. Next one, fixed assets plus current assets some 25 lakhs. Profit and loss debit balance some 5 lakhs. Now balance sheet tallied, yes or no? Yes or no? In this current assets, suppose imagine cash balance is just 3 lakhs. And creditors are asking, come on, pay the amount to us immediately. Come on, pay the amount to us. But is this 3 lakhs sufficient for discharge of 20 lakhs debt? No. For discharge of this 20 lakhs, definitely we should sell assets. If I sell assets, I can't carry business operations. I can't carry business operations. Now, creditors and company will enter into a compromise arrangement. We call it as compromise arrangement. Actually, they are at dispute. So now they will enter into a compromise. According to this compromise, creditors may relinquish interest dues. For example, interest due is 4 lakhs is there. They will agree to waive off that interest. Balance how much is there? 16 lakhs. For this 16 lakhs, they may accept to take shares, but face value of the shares is 20 lakhs. Actually, what is outstanding due? 16 lakhs. To discharge this 16 lakhs, how much worth share capital we are issuing? Face value of 20 lakhs we are issuing to discharge 16 lakhs. That means some 20% discount is there, yes or no? But this is allowed. Why? Under DRS or statutory resolution plan. Both these plans are like, internal financial assistance. Without affecting going concern, without affecting ongoing operations, it's like a somewhat financial distress relief. Already they are distressed. Yes or no? So coming out of it like that, some relief we are doing. So under this scheme only, yes, issue of shares at discount is allowed. The scheme complies with RBI guidelines, directions, regulations. Of course, you can see here some independent authority like RBI is closely monitoring it. In that case, how existing members' interest gets affected? Definitely no. Penalty for non-compliance. That means if you violate 53, that means if you issue shares at a discount other than sweat equity, other than SRP, other than DRS, then company and officers in default will get a punishment. And what is the punishment? What is the punishment? Amount equal to amount raised through discounted shares or 5 lakhs, whichever is less. Here I am talking about issue price. Suppose issue price is 8 rupee, like that 1 lakh shares are there. 8 into 1 lakh, 8 lakhs, or 5 lakhs, whichever is less, that is the punishment. 5 lakhs is the punishment to both company as well as officer in default. Here I am not talking about face value, here I am talking about issue price, amount raised. If issue price is less than face value, we call it as issue at discount. Clear, everyone? Next, along with that, you have to refund with interest. Company shall refund all monies received with 12% interest per annum from the date of issue to the persons holding the shares. Same point, if you observe private placement also, the same thing happened at last. Next one, restriction. This restriction does not apply to debt instruments. If you remember zero coupon bonds, it will be like this. We will give you bond of 1 lakh rupee to you right now. After 5 years, you can redeem this bond. You will get redemption of this bond. That means you will get 1 lakh. During these 5 years, we will not pay a single rupee as a interest. Sir, in that case, how inflation will be adjusted? How interest will be adjusted? Very simple. Today, we collect from you 59,000 rupees. But after 5 years, how much amount you can collect from us? 1 lakh. So here there is no periodical interest, but at the end you will get bond face value. So observe carefully, bond face value is 1 lakh, but today how much amount I am collecting? 59,000. That means, is it at a discount or not at discount? At discount. Is section 53 applicable to this situation? Not applicable to this situation. Understood, everyone? Next, 54 sweat equity shares. 54 sweat equity shares. One point is missing. I will write in the material, and I will tell you. Once material is given to you, I will tell you to note it. Sweat equity shares. It's a cream biscuit. Don't write in exam. It's a cream biscuit. Why? First of all, tell me today, for the survival of organization, what is the important factor? Money. Correct. I agree with you, money. But do you think money is an unlimited resource? No, it's a limited resource. I need to check other requirements also. 100% I can't pay money to my staff. So somewhat I will stop. So that somewhat which I stop, for that, what I will do? I will give options to the employees to subscribe shares whenever company offers shares. It comes under ESOP. But this is different concept. Sweat equity is different concept. Under sweat equity, what happens, For example, take Dr. Reddy's company, Dr. Reddy Laboratories. One doctor, he worked a lot. He developed a formula to cure, for example, COVID, for example, cancer. A small formula he developed. Using that formula, COVID, cancer can be treated. Understood? Medicine means what? It's not like it's a big thing. It's a small formula. Ingredients to be mixed so that medicine can be developed. So this person developed a formula. That means definitely skilled person. Yes or no? What happens if this news comes to the market? Sun Pharma, Laurus Labs, all other pharma companies, what they will do? They will try to attract this person by offering more and more packages. Right now your package is 1 crore, right? We will offer you 100 crores. Like that also they will give offer. Because why? If this person is with Laurus Labs or Sun Pharma, their company can grow. Their business can grow. If you observe, because of this formula, Dr. Reddy Laboratories can easily sell medicines to the cancer affected patients, COVID affected patients. So business will run business, they can continue business in long run. So competitors will try to attract this person. Right now we can't offer that much money. Imagine right now we can't offer that much money. Now what we will do, here, whatever formula he generated, we will try to value that formula. How we value it? Very simple. How many medicines we can sell in future, how much amount we are going to get it. If you calculate present value of all those amounts, you get a value of the formula. That much worth the shares I will give to him at free of cost. at free of cost. Now what happens, that employee feels impressed. Why? So far he is a worker in the company, he is an employee in the company, but from now onwards how he feel? He also feels like a member of the company, owner of the company. Up to now he worked for salary, but right now onwards he will work for dividends. Yes or no? So in this way we can stop this employee from quitting our company, from joining other companies. So that's why I told you this is a motivational biscuit or cream biscuit. Now for issuing sweat equity shares, a company has to comply conditions. What are those conditions? Let's see the conditions. First one, what is a sweat equity share? It is an equity share issued by a company to its directors, to its employees at a discount or for a consideration other than cash. It is very clear. At a discount means we are getting no asset, or we are getting a less than face value. We are getting less than face value amount. For non-cash consideration means, just now I told you example, right? He developed a formula. Using that formula, we can, for example, we can earn a revenue of some 20,000 crores. Imagine. From this, we can easily get a net profit of 4,000 crores. So this is the asset he developed. Against this asset, we are giving shares. That means we are getting something in return, but that is not in cash. Clear? Sir, why they will issue at a discount, sir? To motivate employees well in advance. This happens in advance. This happens when research becomes successful. If research is successful, we get a non-cash consideration. In the process of research, to motivate employees, we are giving some shares at a discount under sweat equity, sir. That is also possible. Suppose if we get some asset, we will record that asset in the balance sheet as per accounting standards. If we are not getting any assets, sir, then what we will do? Whatever share capital, whatever the value of shares I am giving to the employee, I will charge it to the profit and loss account as an employee benefit expense. Getting my point? Treatment of non-cash consideration. If I am getting asset, I will record it in the balance sheet. If I am not getting any asset, I will charge it as an expenditure to the profit and loss account. Clear? Everyone. Next. Conditions for issuing sweat equity shares. First and foremost important condition is issued shares. Sweat equity shares belongs to class already issued. This is one extra condition to be there in the material. Sweat equity shares belongs to the class already issued. That means from a fresh class of shares, I should not issue sweat equity. Logic is very simple. If it is a new class means what? I had a class A equity shares, I had class B equity shares, for example. Class A already issued, they are already in circulation, they are in the market. Anyone can purchase, anyone can sell. Class B not at all issued so far. If I give these shares, if employee needs money, can he sell those shares? No. Why? Because they belongs to new class. They are not yet came into the picture. They are not tradable right now. So offer only existing class shares, not new class. Another logic is also there. Another logic is, from new class, if you offer shares at a discount, definitely that new class will lose its value. Tomorrow if you show these shares, what others will think? Oh, already these shares you issue to your employees at a discount. No. So like that, no one will show interest in the new class. That is the logic behind it. But forget about the logic. The important point is, offered shares should belong to existing class. It should not belong to new class. Existing class means already issued to the members, subscribers, public. And that issue is authorized by special resolution. Allotment shall happen within how many months? 12 months of special resolution. So what is the validity period of special resolution? 12 months. That means what? Within 12 months of SR, allotment should be completed. Or else what we have to do, sir? Again take one special resolution. It will have a validity of 12 months. At least within next 12 months, allot securities. To whom? To the employees. Details specified, to whom you are offering shares, how many number of shares you are offering, what is the current market price, and what is the consideration you are getting, company you are getting, and to whom you are offering those shares, who is the director, who is the employee. So that member will make a independent decision. Yes or no? Suppose company is there, C Limited, managing director very skilled person, he is having a son. Whenever IPL match happens, that person will sit in a sofa and he will eat only snacks until match gets completed. He eats snacks only, imagine. And if you ask that fellow what is debit, what is credit, he know nothing. If you ask that fellow qualification, the qualification is fail in first class, so no promotion to second class. Now that company is planning to offer sweat equity shares to the son of managing director. If this information knows to the members, definitely will they approve the resolution or will they reject the resolution? Definitely reject the resolution. So for that you have to specify the names of directors or employees who are eligible to sweat equity shares. Listed companies comply SEBI. Rights of sweat equity shareholders pari passu with other equity shareholders. And this is not a new point. If you remember section 24, what is section 24? 2 plus 4, 2 CG, 4 SEBI, powers of CG and SEBI. I told you, listed company in the process of listing, with respect to these two companies, I told you two activities: issue and transfer of shares, non-payment of declared dividend. Who will take care of these activities? SEBI. Issue of sweat equity shares means issue of securities only, right? So listed company should also comply with which regulations? SEBI regulations. Next one, sweat equity shareholders pari passu with other equity shareholders. This is like, if you remember movie, we had Amul Baby character, we had Raghuvaran character. Who is Amul Baby? In that movie, villain. Yes or no? He is a qualified, BTech person. Raghuvaran is also qualified BTech person. But that fellow is a son of managing director. This fellow, jobless person. At the end, both had same priority because both are qualified graduates. Yes or no? Similarly, whether you are a sweat equity holder, whether I am a normal normal equity holder, both had same rights. Where attending general meeting, voting at general meeting, dividends. In all the cases, whatever rights you are having, same rights I will have. Whatever rights I am having, same rights you will get. Next important point, 15% limit per year. In this entire question, chance of asking a point is A and B, also C, also D. That's it. A, B, C, D. Limits limits. To what extent they can issue sweat equity shares? To what extent they can issue sweat equity shares? And the answer is, at a time they can offer sweat equity shares up to 15% of paid up equity share capital or 5 crores, whichever is higher. But during the lifetime of the company, it should not exceed 25% of paid up equity share capital. Suppose my company paid up equity share capital is 100 crores. Now I want to offer sweat equity shares. In a year, how much, to what extent I can offer sweat equity shares? 15% of 100 crores. That means 15 crores or 5 crores, whichever is higher means 15 only. So in the year 2025, right now 2025 only, right? Yes. In the year 2025, I offered sweat equity shares I offered sweat equity shares 15 crores. So at the end of the year, total paid up equity share capital is how much? 115 crores. In this 115, 100 is normal, 15 is sweat equity, right? Next year, that means in the year 2026, how much equity, sweat equity shares I can offer, sir? The answer is again 15%. Now if you observe, 100 into 15% means 15 crores. 100 only, right? Normal capital is 100 only. 100 into 15 means 100 into 15% means 15 only. So if you add 15, what happens? It comes 130. But this is not allowed. Why? During the lifetime of companies, sweat equity shares shall not exceed 25% of capital. 25% of existing capital means 100 crores. That means 25 crores. Already last year 15 crores you offered. Current year you can offer only 10 crores. Clear? So that is very important limit, very important limit. Can be tested. So in a year, to what extent I can issue sweat equity shares? 15% or 5 crores, whichever is higher. But during the lifetime of the company, if you want to increase sweat equity shares, increase normal capital. For example, right now normal capital is how much? 100 crores, right? You make bonus issue of 1:1, then 100 crores becomes 200 crores. Or you make a rights issue, or you make a public offer, or you make a private placement, increase normal capital. Accordingly, you can increase the sweat equity shares. Clear, everyone? Fine. Startup relaxation. Startup means what? It is in research phase. For example, I want to set up a business in Chennai. So in Chennai, I will first verify the environmental conditions, which crop is suitable to the Chennai environment, and to the soil which crop is suitable. So this research I will do, and nearby, I will search for markets, or I will go in contact with exporters, or I'll go in contact with importers. Like this, I will do research initially. Once my research becomes successful, I will start business. So definitely in startup phase, I won't earn money. In fact, I spend money. Now, whatever employees are asking, I can't give them blindly because fund scarcity will be there. So definitely, employee needs can be satisfied only by giving a other benefit like sweat equity. So that's the reason for startup companies, it's not 15%, it's not 25%, it's a 50%. 50% for startups up to 10 years post incorporation. Lock-in period. Sweat equity shares are not transferable for 3 years. In capital gains only, sale of one property, if you purchase another property, you can claim deduction, that means exemption, but you have to maintain that property for 2 years, 3 years. Lock-in period is there, right? Similarly, in sweat equity shares also, lock-in period is there. How much? 3 years from the date of allotment. Valuation. Here valuation, 2 times valuation will be done. One time for shares you are offering to the employees. So what is the share value? One valuation. Second valuation is intellectual property rights. Sir, intellectual property right means, I told you, medicine formula. That formula is intellectual property rights. So what would be the value of intellectual property rights? So share value, IPR value. Who will do? Registered valuer. IPR, know-how value addition, valued by a registered valuer with a justification report for the board. IPR means intellectual property rights. This is a intangible asset. Tangible or intangible? Intangible asset. Coca-Cola or thumbs up, if you take 2 liters bottle will be there, right? So the selling price of 2-liter bottle is 100 rupees. And you think how much cost is involved in the 200? How much cost is involved in that 100? Just tell me a wild guess. Any guess? For manufacturing that 2-liter Coca-Cola bottle, how much they spend, Hardly some 3 to 4 rupees. 3 to 4 rupees. That remaining is amortization of formula which they developed previously. And the remaining is brand ambassador services, brand ambassador services. Mahesh Babu sir will not work at free of cost, right? He charges remuneration. Right now you can see Shubham Gill sir is doing that advertisement. Another one, I think Madam heroine, Devra heroine. So somehow, when I'm crossing the streets, I can see all these celebrities are making thumbs up advertisements. Do you think they work at free of cost? So that cost only. How much it will take? They will have a tanker full of water. In that they mix ingredients. For us, 2 liters bottle, it's a big bottle. For them, one tanker will be there. So manufacturing cost is very less, but these advertisements, GST, extra government, GST, all these, mix up how much it would be? 100 rupees. Even the 20 rupee bottle, if you ask shop owner, sir, at what price you get? If you ask them, they will tell 12 or 15 rupees. The 20 rupees bottle they get just for 15 rupees or 12 rupees. So they only earn a margin of some 5 to 8 rupees. Why? They are making investment. Yes or no? Manufacturer immediately they will sell the stock immediately. Whenever stock ready, they will sell. But who holds that stock until sale gets completed? Retailers. That's it. That's the logic. Okay, fine. Now, the formula value is all about the future of the company. If you get that formula, you can easily, develop that Coca-Cola beverage just for 20 rupees, 25 rupees. But the point is, they will come to you, they will arrest you. Why? For unauthorized usage of formulas. Even, if you want, you can start an outlet. They will share you formula, and you can you can manufacture thumbs up, Coca-Cola, everything. Ingredients, they will tell you, this much quantity, you mix it. That's it. Fine. Next one. The director's report shall include issue details. A similar point you can see in differential voting rights also. It's nothing but disclosures in board report. Registers form SH3 to record sweat equity shares kept at registered office or a location authorized by the board. Registers means recording the details of employees to whom we offered sweat equity shares. Recording the details of assets, that means intellectual property rights we got from that employee. So all these should be recorded in a separate register, and that register is in which form? SH3, and it shall be kept at where? Registered office or any location authorized by the board. Treatment of non-cash consideration, already told you. If you are getting an asset like this, IPR account debit, the value is some 40 crores, and you are also issuing equity shares worth 40 crores. Face value, suppose 10 rupee, 4 crores. Remaining amount will be securities premium 36 crores. Tallied. Suppose value is 40 crores, worth of equity shares is 40 crores, but asset company is getting only 30 crores. So there is a difference of 10 crores. The 10 crores employee benefit expense account debit 10 crores. Director, then managerial director remuneration as per 197 calculation is there, right? So provide remuneration according to that. Next, definition of employee. So who is an employee? One who works for employer, but that employee should be permanent employee. Who? Permanent employee. Directors, whether whole time or not, and these two people may work in India or outside India. These two people may work in our subsidiary or may work in our holding company. In a group, if you observe, this is our company, we are having holding company, we are having subsidiary company. In these three companies, even a good news comes in one company, automatically it becomes a good to other two companies. So my holding company employee worked a lot. I want to gift him some shares at free of cost. Yes, you can gift him. My subsidiary company employee worked a lot. I want to gift my equity shares at free of cost. Yes, you can gift it. But the main thing is that employee should be permanent employee. Value addition means, actual or anticipated economic benefits derived or to be derived from know-how, intellectual property rights, professional expertise provided by the recipient. That means, developing a medicine attracts more number of patients. That means we can do business in long run. That's all about. But one important point in sweat equity shares. One important point in sweat equity shares, you have to remember this point. 1 year after incorporation, and you need to cancel this point. Previously, when Companies Act 2013 came into the picture, there is a condition called post 1 year after incorporation. That means up to 1 year of incorporation, company is prohibited from offering sweat equity shares. What is the condition? Up to 1 year of incorporation. That means companies shall wait at least 1 year for offering sweat equity shares. But this is becoming a hurdle to startups. That's why MCA, with the help of parliament, with the help of parliament approval, they deleted this word. So on this we had a practical question which came twice. The question is, because of employees support, company performed well, company turnover almost doubled compared with last year, and company just came into the existence only for 11 months. That means, Jan, Feb, March, January company came, 3 months turnover, the turnover got tripled in the next 9 months. So company is just 9 months old. Now company wants to offer sweat equity shares to the employees. One of the friend of CEO advised that company can't issue sweat equity shares up to 2 years of incorporation. So please advise CEO of the company. And the answer is, even 1 day after incorporation also company can issue sweat equity shares. There is no condition called 1 year since incorporation, no issue. Clear, everyone? So with this I will stop for the time being. Let's have a break of 10 minutes. So let's continue our discussion with next concept, that is issue and redemption of preference shares, section 55. So in a company, for raising finance, for raising funds, so what are the alternatives available to the company? Generally, either go with own funds or go with loan funds. Yes or no? In a company, you will find only two funds: own funds, loan funds. Own funds comes from equity shareholders. Loan funds comes from debenture holder or banks. If you observe, each and every type is having its own merits and demerits. If you observe merits in equity shareholders, there is no obligation to return money. There is no obligation to return money. No fixed obligation like payment of interest. Yes or no? No fixed obligations. But coming to loan funds, I had a fixed obligation with respect to interest, with respect to loan. But if you observe demerits in equity shareholders, too much issue of equity shares, what happens? Too much issue of equity shares, it leads to dilution of control. Yes or no? Previously, suppose 10 persons are there, 10 members are there, each member is having a 10% voting power. Now adding 10 more members, what happens? Voting power gets reduced to 5%. So too much of issue of equity share capital leads to dilution of control. Whereas coming to the banks, the biggest merit is no dilution of control. No dilution of control. So tell me, equity shareholders, when we pay dividends, when we have profits, we pay dividends. There is no commitment on company to pay dividends. There is no commitment on company to return equity shareholder funds. That is a merit. Demerits, issue of equity shares leads to dilution of control. For debentures or for bank loans, what happens? The merit is no dilution of control, but the demerit is every month I need to pay interest. Every year I need to repay certain portion of principal amount. Now combining these two securities, a hybrid form of security has been found, that is preference share. In preference share, if I have profits, then I will pay dividends. No profits, no dividends. Clear? But I will promise one time period. I will promise, for example, 10 years. After completion of 10 years, what I will do? I will definitely return those funds. Redemption will happen. That means repayment is compulsory, but payment of monthly return or payment of annual return is optional. Of course, here also they had one minus point. That minus point is, if preference dividends are not paid for 2 or more consecutive years, definitely they get voting rights. Once they are paid with the dividends, once dividends are paid, their voting rights become 0. So simply, preference share capital is a hybrid form of equity and debenture. When I have profits, I will pay dividends. No profits, no dividends. Understand? And they will not participate in voting rights in case of general meetings. They will participate in voting only for the matters affecting their rights, winding up of the company, reduction of the capital, and if preference dividends are not paid for 2+ years consecutively. Clear? See, 2+ consecutive years means what? They will get voting rights on all resolutions, similar to equity shareholders. So definitely this is a helpful instrument or helpful security to the company. So tell me, by issuing preference shares, dilution of control possible or not possible? Not possible, unless it is a convertible preference share. Now for issuing these preference shares, a company has to satisfy certain conditions. What are those conditions? Let's see. First of all, it should be authorized by AOA. Articles of Association authorization is compulsory. Clear? Everyone. Next one, issue shall be authorized by special resolution in a general meeting. So issue shall be authorized by special resolution in general meeting. So here also we need to take members approval. The reason is, compared to equity shareholders, preference shareholders get priority with respect to payment of dividends, with respect to redemption of capital. So that's why equity shareholders consent is compulsory. And what type of consent we have to take? Special resolution. Next, company shall not have subsisting default in the following 2 cases. What are those cases? Redemption of preference shares, payment of dividends due on preference shares. It's very simple. If you are not able to satisfy existing preference shareholders, why new preference shareholders? So at the time of issuing preference shares, company should not have following defaults. What are those following defaults, ma? Tell me, what are those following defaults? Redemption of preference share capital or payment of dividends due on preference shares. If company wants to issue preference shares, then eliminate, that means rectify these defaults. Next one, company cannot issue irredeemable preference shares. So compulsory redeemable. Sir, redeemable, right sir? Can I redeem them after 99 years, sir? No, no, no. Maximum redemption period is 20 years from the date of issue. Whereas infrastructure companies engaged in infrastructure projects, for them it's not 20 years, it's 30 years. Provided 21st year onwards, redemption should start. Every year 10%. Logic is very simple. If you look at the metro, it's not 1 year activity. They will take 10 years to complete the project. Now they will be left with 10 years to generate turnover, to generate profits. So they may not find sufficient time to redeem preference shares. In a 20 years, suppose 10 years they spent on construction of the metro. So they will be left with how many years? 10 years for redemption. But in these 10 years, they need to meet operational costs, they need to meet administration costs. So apart from this, again, if you are keeping preference share capital redemption condition on them, it will not be viable. It is not advisable. That's why for them, what is the duration? 30 years. Provided 21st year onwards, redemption should start. Suppose 21st year 10% redeemed, 22nd year also 10%, 23rd year 10%, like that. By the 30th year, they will be left with 10%. If they redeem the 10%, it becomes 0. Clear? So only for infrastructure projects, the benefit of 30 years is given, with a condition that 21st year onwards redemption shall happen, and it will be at the option of preference shareholders. So if they want first, they can stand in a line, up to 10% we will redeem, and remaining next year. Suppose many people came for redemption, then we will follow lot system. Lot system is lottery. So whose name appears first, for them redemption will happen. Next one, conditions for redemption. Issue conditions over. What are the conditions for issue? AOA, SR, no subsisting default, 20 years, exceptional cases 30 years. That's it. Irredeemable, of course, if I am writing 20 years, that means company is prohibited from issuing irredeemable preference shares. So remember the conditions for issue. Next one, conditions for redemption. Redemption, in that first one important point is sources for redemption of preference shares. Again, here you need to check in redemption value, maybe securities premium also included. Suppose face value is 100 rupee and we promise to redeem at 105 rupees. Redemption value is 105. So if you observe, in redemption we are having two components. One is face value, that is 100. Other one is securities premium, 5 rupees. So for this 100 rupees different source is there, and for 5 rupees different source is there. If you remember section 52, utilization of securities premium. For all companies, securities premium can be utilized for B square E P square. In that P square, P stands for premium on redemption of preference shares. Premium on redemption of debentures, premium on redemption of preference shares. So now listen carefully. Redemption value 105, two parts. Face value 100, securities premium 5. For this 100 rupees, yes, company can utilize two sources. One is company reserves, that means the amount available for declaration and payment of dividends. And second one is fresh issue proceeds. Fresh issue proceeds. It's like this, I'll take money from one source and same money I will use for redemption. And for securities premium, two sources are available. One is securities premium, other one is free reserves or reserves and surplus. But important point is securities premium is available to all companies other than section 133 company. And free reserves is available only for section 133 companies. Clear? Now let's see conditions. Sources, redemption can only be from profits. Profits eligible for dividend distribution. Proceeds from fresh issue made for redemption. Now fully paid shares, shares should be fully paid up. First of all, before redemption, you have to check whether shares are partly paid up or fully paid up. Only fully paid up are eligible for redemption. Next one, transfer to CRR account. If redeemed from profits, transfer nominal amount of redeemed shares to CRR. And if redeemed from fresh issue, no CRR transfer required. Only premium from fresh issue can be used for redemption. Premium, that means proceeds from fresh issue. That means proceeds from, for understanding I'm writing here, proceeds from fresh issue can be used for redemption. Clear, everyone? The logic of creating CRR, let me tell you. Suppose if you look at the balance sheet, equity share capital 10 lakhs. Next one, free reserves 10 lakhs. Outstanding liabilities 20 lakhs. Next, assets, fixed assets, current assets, all together 40 lakhs. Everything is fine. Now what happens, suppose, okay, preference share capital 2 lakhs, equity share capital 8 lakhs. So generally, the lenders will always check at capital of the company. Capital is 10 lakhs and we give 20 lakhs loan. Okay, fine, no problem. Suddenly, if 2 lakhs is getting reduced, what happens? It becomes 8. And whereas outstanding dues, 20 lakhs still there. So generally, they look for 2:1 ratio. 2:1 means, for every 1 rupee fund, 2 rupee we can provide debt. So today, yes, equity share capital share capital fallen by 2 lakhs, it fallen to 8 lakhs, whereas our due is 20 lakhs. If you tell them, sir, don't worry, sir, free reserves is there, no, sir, free reserves is available, no, sir, 10 lakhs worth free reserves is there, no, sir, they will not listen. Why? Who knows? If they call for EGM, suppose suddenly they call for EGM, and if they announce entire free reserves in the form of dividends, then that free reserves will become zero. Finally, whose interest gets affected? Creditor's interest is getting affected. So that's why we are not okay with this reduction of the capital. So like that, creditors may raise objection. To cool them, what we are doing, certain portion of free reserves. How much portion? 2 lakhs, that is face value of preference shares so redeemed. The 2 lakhs we are transferring it to CRR. So what is the difference between free reserves and CRR? Free reserves can be utilized for any purpose. There is no restriction on utilization of free reserves. But CRR, I can utilize only for one purpose, that is bonus issue. So tomorrow, the amount in the CRR, 2 lakhs amount in the CRR, I will issue shares. Then what happens? Existing capital 8 lakhs plus new capital 2 lakhs, total 10 lakhs. So the journey would be like this. Initially 10 lakhs is the capital. Because of redemption, it fallen to 8 lakhs. But because of CRR, tomorrow definitely company will issue bonus shares. It will come back to 10 lakhs. Original position, same position, safe. Suppose if you select proceeds from fresh issue. Proceeds from fresh issue. In that case, what happens? Originally 10 lakhs, some 2 lakhs will be added. We are getting that funds for redemption of existing preference shares. Once redemption gets completed, it will come back to original position of 10 lakhs. So there is no change in the position. So finally creditors will be safe. So this is okay, but in this case, to convince creditors, what we are doing, we are creating CRR. And how much amount I transfer to CRR? Complete redemption value, only face value in that redemption value, face value in the redemption value, correct. So here, if redeemed from fresh issue, no CRR transfer required, only proceeds from fresh issue can be used for redemption. Clear? Next point. For certain companies complying with prescribed accounting standards, premium on redemption shall be provided before redemption from company profits. Next one, preference shares issued before Act. Premium for shares issued before Act can be provided from profits or securities premium account, whereas other companies premium can be provided only from profits of the company, securities premium account before redemption. So to understand this better, one point. So what sources I can utilize for securities premium? Company profits, securities premium. Whereas for section 133 companies, only one source, that is free reserves. Clear? Everyone? Next, unable to redeem preference shares. This is important point. This can be tested. Unable to redeem preference shares. At the time of issue of preference shares, my financial position is good. So I promised them, yes, I'm going to redeem within 20 years of issue. So today I issued, after 20 years I'm going to redeem those shares. Like that, I kept a condition. On the due date of redemption, my financial position is not at all good. I'm not having sufficient liquid money. I'm not having any liquid money to redeem preference shares. In fact, last 2 years, I'm keeping preference dividends in arrears. That means, all these are cumulative preference shares. I'm not in a position to pay dividends. That's why these dividends are in arrears. Suppose, preference share capital is 10 lakhs. Dividend rate is 10%. Dividend rate is 10%. So 2 years dividend spending. That means, 10 lakhs into 10% into 2 years. That means 2 lakhs dividend is pending. So on the due date of redemption, total I am liable for how much amount? 12 lakhs. But I am not having sufficient funds to redeem preference share capital holders. In that case, what I will do, first I will call for a meeting. I'll call for a preference shareholders meeting. I will tell to them, right now I'm not having a funds to redeem you. But if you give approval to me, I will replace old shares with new shares. In the place of old shares, you will get new shares. And these new shares, the amount involved in the new shares is equal to old shares plus dividend in arrears. Dividend in arrears. That means dues. So, old shares 10 lakhs, outstanding dividends are 2 lakhs. So, I will issue new shares. The face value of new shares will be 12 lakhs. Clear? Apart from getting approval from the preference shareholders, I should also contact one independent person, that is NCLT. NCLT permission is also required. So NCLT ensures that whether I got approval from 3/4 capital holders, 3/4 capital holders. First NCLT will ensure whether I got special resolution. In easy terms, whether I got special resolution or not, they will check. Yes sir, I got special resolution. And NCLT will observe any dissenting shareholder in the company. That means who is against to the deemed redemption. This is not actual redemption. Actual redemption means what? I will pay money and I will get back my shares. But here what I am doing, I am giving new shares and I am taking old shares. This is deemed to be a redemption. So deemed redemption. So here what I will do, first I will get approval from preference shareholders. Next I will go to NCLT. NCLT observe any dissenting shareholder is there or not. Suppose some 7% of the capital, some 7% of the capital holders are dissenting shareholders, sir. Okay, 7%, right? That means 12 lakhs into 7%. So total it would be 84,000. So for 84,000, immediately you redeem. That means cash redemption will take place with respect to 84,000. And for remaining 93%, what I will do? I will take back old shares and I will give new shares, covering not only capital amount but also dividend amounts. So in this way, deemed redemption gets completed. So what are the 3 important conditions I should comply for deemed redemption of preference shares? What are the 3 conditions? Approval from preference shareholders, similar to special resolution. Approval from NCLT. NCLT gives approvals only when dissenting shareholders got redeemed. If company is unable to redeem preference shares or pay dividends, it may, with the consent of 3/4 in value of preference shareholders and approval from NCLT on a petition made by it in this behalf, issue further redeemable preference shares equal to due amount. That means capital plus unpaid dividends. NCLT, while giving approval, may order for redemption of preference shares held by preference shareholders who have not consented to issue of further redeemable preference shares. I call them as dissenting shareholders. And let me ask you point here, who is paying money to dissenting shareholders? Option A, promoters. Option B, controlling shareholders. Option C, company. Who is paying money to dissenting shareholders? Come on, tell me. Company, correct. Company is the right answer. Whereas section 13, alteration of object clause, section 27, variation of objects in the prospectus. In these 2 cases, it's not company, either promoters or controlling shareholders give offer to dissenting shareholders as per SEBI regulations. Clear? The issue or redemption of further redeemable preference shares does not amount to increase or reduce the capital of the company. If you observe, what is my outstanding capital? 10 lakhs. Including dividends, it is how much? 12 lakhs. Now to redeem these 10 lakhs, How much extent of preference shares I am giving? So 12 lakhs minus 7%, that means 84,000. So net 11 lakhs 16,000 rupees preference share capital I am giving to the existing members. So existing position is 10 lakhs, but it got increased to 11 lakh 60,000, 11 lakh 16,000. But still, I'm not going to consider it as a increase or reduction of the capital. Accordingly, the provisions relating to alteration of capital, the provisions relating to reduction of capital will not apply. Clear? Alteration of nomination is not an alteration of MOA, I told you. That means section 13 is not applicable. Here also, issue of redemption of further issue or for redemption of further redeemable preference shares does not amount to increase or reduction of the capital. That means reduction of capital provisions will not apply. In this case, even capital got reduced. Suppose out of 12 lakhs, 20% are dissenting shareholders. Now 2.4 lakh I paid cash. Balance amount how much? 9.6 lakh. For 9.6 lakh I am issuing a preference shares. Previously it is 10 lakh, right now 9.6 lakh. So reduction is there? No sir. Is this amounts to reduction of capital? No. Next. So with this 55 completed. So once again let's see the third point. The third point is sources for premium on redemption. One clarification I want to give you. For certain companies complying with prescribed accounting standards. That means I'm talking about which company? Section 133 company. Premium on redemption. Premium on redemption means, is it an inflow or outflow? It is an outflow. This amount I'm not getting it. I'm paying to the preference shareholders. It should be provided before redemption from company profits. That means, suppose, I'm having a company profit of 200. This is my free reserve. Listen carefully. This is my free reserve. My face value of preference share is 100. I fixed redemption value as 105. So for section 133 companies, that means, companies that are following accounting standards in preparation of financial statements, for them, premium on redemption, they can utilize only one source, that is company profits. That means free reserves. So if you observe, here there is a premium of 5 rupees. First you set off this 5 rupees with your securities premium. After setting off, the securities premium balance would be 195, correct? See, this is my securities premium balance amount. How much? 200. So first you set off 5 rupees premium on redemption. Next you set off face value 100. So here set off 100 means what? This amount I will transfer to CRR. So they are telling about order of utilization of securities premium. First you utilize securities premium for premium on redemption. Next you utilize balance amount for creation of CRR. Understand? And premium for shares issued before the act. That means, what type of shares they are? Old preference shares. Preference shares before the act means old preference shares can be provided from profits of the company. Next, if not sufficient, go with a securities premium. This is with respect to which shares? Old preference shares. Other companies, premium can be provided from either company profits or security premium account. So for other companies, two sources are available. Company profits, so that means, free reserves, securities premium. Whereas for section 133 companies, only one, that is company profits. First you utilize company profits. Next, utilize company profits for creating CRR. Understood? Understood the clarification? Fine. So let's continue our discussion with section 56, that is transfer and transmission of securities. As I told you in section 47, holding shares means it's not holding company assets, it's holding bundle of rights. But whenever a person needs money, he can sell shares. Whenever a person needs shares, he will purchase shares. So if you observe the effect of transfer, the effect of transfer, let's take two persons, Mr. Ajay and Mr. Charan. Both are members of a company C Limited. Ajay is holding some 100 shares. Charan is holding 0 shares. Now the effect of transfer, suppose if Ajay agreed to transfer 100 shares, what happens, Ajay shares, 100 shares will be deducted from the balance. So the balance becomes 0. and 100 shares will be added to Charan. So Charan will get how many shares? 100. So that means existing member ceased to be a member. What is the effect of transfer? The member is getting ceased because of transfer. So cessation of membership, I call it as cessation of membership. And you know, outsider is becoming a member of the company. This is one effect of transfer. Imagine Ajay is selling only 50 shares. And you know, by the time Charan is already having 50 shares. Now what happens? From Ajay 100, 50 will be deducted, so balance 50. And to Charan, already opening how much? 50 is there. Now because of this transfer, 50 will be added, total 100. Now the effect of transfer is existing member holding is getting reduced and existing member holding is getting increased. One existing member holdings reduced, other existing member holdings got increased. So finally the effect of transfer is either transferor ceased to be a member of the company, or transferor reducing his holdings. From transferee point of view, transferee becoming member of the company, or transferee increasing his holdings of the company. Clear? Next one, section 44, I clearly told you. What is section 44? Nature of shares. Shares are movable properties. Yes or no? That means transferable from one party to another party. But you know, this transferability is always depends on AOA, because if you take private company, transfer is always restricted. Whereas if you take public company, transfer is always permitted. Now for transferring securities, we have to comply certain conditions. What are those conditions? We can see in section 56. So transfer of securities applies to transfer of securities of the company, transfer of interest of a member in a company with no share capital. As you all know, company limited by shares, one concept is there, yes or no? And second one is limited by guarantee, and third one is unlimited company. And in limited by guarantee, unlimited company, we had two other alternatives. That one is with share capital, without share capital, with share capital, without share capital. Now the point is, what can be transferred? Point one is securities can be transferred. Sir, in my company there is no concept called security, sir. It is a company without share capital, sir. Then you know, ownership interest gets transferred. Suppose if you take, for example, if you take partnership firm, imagine partnership firm. In partnership firm, do you think firm issues shares to the partners, sir? No. But if you ask a partner how much share you are having in the firm, he will tell, I am having 25% share, I am having 30% share. That means 25% or 30% is the interest in the firm. It's not security, it's a interest. Now coming to companies limited by guarantee or unlimited company without share capital, each and every member will have certain interest, maybe 5% or 6%. Now that interest can also be transferred. So tell me, what can be transferred? Either securities or interest. Securities comes in company with share capital, interest comes in a company without share capital. Now for transfer, oral transfer is always not allowed. It should be in writing. It should be executed in a proper instrument of transfer, and we call it as transfer deed. Let's see, transfer shall be done using a proper instrument of transfer, that is SH4. So what is a form for instrument of transfer? SH4. Duly stamped, dated, executed by both transferor and transferee except for depository transactions. I am having 50,000 rupees money, cash. I want to pay money to you. You are in Chennai, I am in Hyderabad. Now to transfer this money, what I will do? I will go to bank, I will take one deposit voucher, vouchers that are available in bank. I will fill all the details. I will pay 50,000 to the banker. Now that amount will be transferred to your account. Suppose if I am having 50,000 in my bank account, tell me, bank voucher required or not required? Not required. Simply entering your mobile number. If I enter my PIN, amount will be deducted in my account, amount will be added to your account. So that's what, you know, if securities are in demat form, you know, depository, you know, if it is in demat form, for that instrument of transfer, required or not required? Not required. And that instrument of transfer should be duly stamped, dated, executed by both transferor and transferee. Remember, if you remember the point, you know, negotiable instruments, bill of exchange, promissory note requires stamps, check doesn't require stamps, only logic, man-made instruments or man-made agreements are enforceable only if they are stamped. If that instrument is made by the authority, like 500 rupee note, 200 rupee note, 100 rupee note, checks, all this comes under authority. For that, stamping is not mandatory. And the logic is very simple. India should get some revenue. India gets revenue under one act called Indian Stamps Act. By selling stamps, they get money. Only reason of Indian Stamp Act is to get revenue. That's it. That's why they made a point that all man-made agreements should be stamped. That's what, if I want to transfer this building, suppose I'm the owner of this building, if I want to transfer this building, for that registration of transfer is required. At the time I will pay 6.5% to 8% stamp duty. And you can see deposit, you can see title documents are on stamp papers. Why? All these are man-made agreements. Now tell me, transfer instrument, is it a man-made agreement or agreement made by the authority? Man-made agreement. Definitely it should be stamped. And it should also be dated. The reason, once you mention date on the instrument of transfer, within 60 days, those documents shall reach company. What is the time limit? 60 days. Next one. Who should execute instrument of transfer? Both transferor and transferee. Shall include name, address and occupation of the transferee. If you observe these three things, you can see in MOA subscription clause. That means, company has to maintain a record of all its members. What is that record? What is the details? Name, address, occupation. So for existing members, I know that information. For new members, they have to fill the form and they have to fill all these details. In this way, I get that information. Who get that information? Company. Shall be delivered to the company within how many days? 60 days of execution along with share certificate or letter of allotment. Yesterday I told you, once you apply for securities, once application got allotted, first you will receive letter of allotment. Against that letter of allotment, share certificate is given. So now, before you get share certificate, if you want to transfer, you can transfer that letter of allotment. So transfer deed plus letter of allotment or transfer deed plus share certificate. Tell me, within how many days I should submit these documents to company? 60 days. From which date? From date of execution of the instrument. That means date mentioned on the instrument. Exemption to the government companies. As I told you, government companies, who is the member in the government company? President of India, governor of the state. Simply if they need funds, can they transfer shares in this manner? No. For them, this procedure is not applicable. No instrument required for certain transfers in government companies. For bonds issued by the company, the transferee needs to inform company along with the bond certificate. For securities held by government nominees, that is President of India, governor of the state. Government nominees means only those two persons only. Exemption applies to government companies which has not defaulted in filing its financial statements and annual returns with ROC. If you are reading, just now I saw, if you are reading January 2024 study material, many amendments came to this January 2024 study material. Just go through the July 2024 study material. One biggest amendment is, actually this no default condition is there some 5 to 6 situations, 5 to 6 times this point is there in our syllabus. But in July 2024 edition, amendments have been incorporated. Only few cases only you will find this kind of point. Remaining cases you will not find this point. So getting it, see, section 56, exemption is applicable to government company. Not all government companies, only government company which is regular in filing financial statements and annual returns. Next one, suppose, unlucky sir, transferor gave me instrument of transfer sir, but I lost it sir. Then follow section 46. What is 46? For duplicate, what you will do? Along with application, you will file a indemnity bond, right? Submit those documents. If instrument is lost or not delivered within 60 days, company may register. It's not shall register, may, optional. May register the transfer on terms of indemnity as decided by board. Notice to transfer in case of partly paid shares. Suppose company C Limited. Our company is always C Limited. And Mr. M is a member of the company. He is holding a share, paid up value is 8 rupee, face value is 10 rupee. On share certificate, clearly mentioned, face value 10, no, paid up value 8. If he sell this share, he get only how much amount? 8 rupees. But there is a chance that he may manipulate buyer like this. I'm having a share certificate. without showing these figures, yes, without showing these figures, he can manipulate buyer. Yes, I'm having a share certificate. You pay me 10 rupees. I will give it to you. You can register this share certificate in your name. Or else I will submit these documents to company C Limited. They will register and they will issue new share certificate in your name. So you pay me 10 rupees. I will execute transfer deed. So like that possibility is there. You know, Mr. M, what he will do, he will execute instrument of transfer in favor of B and he will submit the document to C Limited. But later, if C Limited make calls on shares, tell me whether B liable or not liable? Definitely liable. But already he paid amount to M. So that's why if company is receiving an application for transfer for partly paid up shares, I'm not talking about fully paid up, partly paid up shares, and instrument is executed only by transferor. It is not submitted by transferee, it is submitted and executed by transferor. Then company should give intimation to buyer. Company should give intimation to transferee stating that, sir, the shares involved in the transfer are partly paid up, they are not fully paid up. So tomorrow if you make calls on shares, you will be liable. Clear? You know, out of trust, what we will do, sometimes we will sign some blank checks and we will give it to our relatives. Yes or no? So here also transferor might execute a blank instrument deed. So transferor later he may fill the details, and when application is received by company from transferor, so he should make a precautionary measure. You know, company should intimate about partly paid up shares to B. That is the point. Let's see. If an application for registration of transfer is made by transferor alone, the company shall not register transfer unless company has given notice to transferee. Transferee gives no objection within 2 weeks of receiving the notice. Which case? Partly paid shares. Suppose if they are fully paid up shares, intimation required or not required? Not required. Suppose if that application is submitted by transferee, then intimation required or not required? Not required. He can see the share certificate, right? So only when 2 conditions are satisfied, intimation is compulsory. What are those 2 conditions? Partly paid up shares. Second one, application by transferor. And how many weeks, you know, company should wait for approval? 2 weeks. Within 2 weeks, if company receives no objection, proceed. Suppose 2 weeks completed, there is no reply from transferee, sir. That means transferee accepted it, deemed acceptance. Then proceed with registration of transfer. Transmission. Transfer is different, transmission is different. Transfer, it happens between 2 parties voluntarily. I want to sell shares, you want to buy shares. We both enter into an agreement, based on terms and conditions, transfer happens. But transmission is through operation of law. So operation of law means, suppose, you know, member is there, he got deceased, he died. Now legal heirs of a member will get properties of M, and this is happening through operation of law. Yes or no? Now, you know, legal heir can't ask father, you come down, please sign the documents, please sign documents in favor of me, then only you go up. Possible? 100% not possible. So in this case, through operation of law, yes, in case of deceased member, legal heirs become members. And the process of registration, you know, the process to register shares in the name of M to shares in the name of legal heir, we call it as transmission. A company can register transmission of rights without being bound by conditions under section 56 subsection 1 for registration of transfer. Transmission is allowed upon receiving intimation from the entitled persons without requiring instrument of transfer. One small point, transfer, transmission. Let me ask you, so where instrument of transfer is required, ma? Transfer instrument. Where transfer instrument required? Once again I'm telling you, transfer voluntary or operation of law? Na? Voluntary. Okay. Transmission, operation of law. Next one, transfer, 2 parties required, whereas transmission only 1 party. Based on this, tell me, transfer deed where required? In first case or in second case? First case transfer deed required, second case not required, because, you know, original member, either he might have deceased or he might have become insolvent. That means he lost contractual capacity, or he might have become unsound mind. So in all these cases, you know, in first case he is not in existence, second case, third case, he is in existence, but he lost contractual capacity. So instrument of transfer required or not required. Next one, stamping required in which case, not required in which case. First case, stamping is required. Second case, not required. Next one, consideration, where required, where not required. Consideration. First case, yes, buyer shall pay some amount to the seller. Whereas transmission, person already gone up. Payment is not possible. Yes or no? Consideration not possible. Is it clear? So with respect to transmission, intimation is sufficient. Just look at the point once. Intimation from the entitled person, maybe a legal heir in case of deceased member, official assignee in case of insolvent member, legal heir in case of lunacy. So in these cases, entitled person will make intimation. So here transfer instrument is not required. Next one, cases of transmission. You know, generally transmission occurs in these three cases: death, insolvency, lunacy. Next one, time limit for delivering share certificates. Time limit for delivering share certificates. Suppose you applied for May 25 examinations. You applied for May examinations today. For example, imagine 10th March 2025 you applied for exams. When you should receive hall tickets? Before exams or after exams? After exams, no use at all. So there is a deadline for issuing hall tickets. Similarly, there is a deadline for issuing certificates. Here I am talking about certificates. I am not talking about securities. Certificate. Security, it's a asset. It's an asset. Certificate, it's a document showing title of that asset. So who is the owner of the asset? You know, how can we see it? Looking at certificate. Now time limit for issue of certificate, let's see. In case of incorporation, the subscribers to the MOA should receive certificates within how many days? Within how many months? 2 months of incorporation. Allotment happens immediately upon incorporation. Upon incorporation, the number of shares mentioned against their names in the MOA, those many shares automatically gets allotted to them. But within how many months they should receive share certificate? 2 months from the date of incorporation. In case of allotment of shares, you know, either prospectus or private placement, you know, in case of allotment of shares, within 2 months of allotment, they should receive certificate. Clear? Before they get letter of allotment, now they get a certificate. No time limit for letter of allotment, whereas a certificate, you know, within 2 months. Next one, transfer or transmission of securities. In case of transfer or transmission, transferee should receive certificate within 1 month of receipt of instrument of transfer or intimation of transmission. That means, you know, when company is receiving these documents, within 1 month, they should deliver certificates to the transferee. Getting my point? It's about delivering certificate. It's about delivering certificates. Next one, allotment of debentures. In case of allotment of debentures, within 6 months of allotment, company should deliver certificate to holder. That means, you know, allottee. So that's what, if you observe carefully, 2 and 4, how it is different you can see. 3 also there is a difference. 3 is talking about all securities, whether it is a share or debenture, it is talking about all securities. But 2 and 4 talks about only specifically, 2 is talking about shares, 4 is talking about debentures. Now tell me, for transfer of debentures, what is the time period? 1 month. For transfer of shares, what is the time limit? 1 month. Whereas allotment of shares, 2 months, allotment of debentures, 6 months. Next one, all securities by specified IFSC public and private companies within 60 days after incorporation, allotment, or transfer, or transmission. That means, you know, in the above cases, if you observe, different time limits there, 2 months, 2 months, 1 month. But for them, only one time limit, that is 60 days. Next one, securities dealt in a depository. In case of depository, in case of demat form of securities, generally, immediately transfer gets completed. Actually, T+2 cycle will be there. Today, if I sell, the third day, securities will be debited to my account and the count of securities will be credited to buyer account. The trading cycle is there. But immediately, delivery will happen. Clear? Everyone? Next. Try to understand this point. Just look at this point. Point 9. One practical question may come in examination if your time is too good. A legal representative can transfer deceased person's securities or interest. Securities or interest means what? Securities for company with share capital. Interest means correct. Without being the holder of those securities, as long as transfer is properly executed. So here the point is, M is a member of the company, died in an accident. Now son is a legal heir. Now son will get two options. Option 1, register shares in his own name, or he can sell those shares to outsiders. Getting my point? So any option he can exercise. So directly he can transfer it to outsiders, but if he decide to transfer it to outsiders, he need to execute SH4, that is transfer deed. And who will sign transfer deed? Father? No, father already died. Then who will sign it? Son. Sir, son is not a member. No sir, no problem, we assume son is a member of the company. Understand? So legal representative can transfer deceased person's securities or interest even without registering securities in his name. Clear? As long as transfer is properly executed. Next, default in compliance. First we need to understand what is default. Punishment easy, 50,000 applies to company and every officer in default. Penalty is easy, but default here, what type of defaults are there, sir? First, let's see. First default, SH4 is improperly executed, ma. SH4 is improper. In case of improper execution of SH4, tell me, company should register a, company should reject a? Company should register the transfer, company should reject the transfer, reject. Suppose if company register the transfer, punishment 50,000. Clear? Next one, within 2 months, 1 month, 6 months, like that, I told you time limit. If these time limits are violated, then also punishment. And I clearly told you SH4 is not required for transmission. So in case of transmission, just intimation letter is sufficient. Suppose intimation letter submitted but company is not registering the transfer, then also it is a defect. Are you all getting my point? So defects here refers to improper execution of SH4, company is making registration. Next one, in case of transmission, since transfer deed is not required but company is not registering the transfer. And next one, company is not issuing certificates within the prescribed time limits. In all the cases, punishment. What is the punishment? 50,000. Can I proceed? Hello? Energy lessa? Can I proceed? Imagine a situation in the examination hall. When you write examination? 2 to? But 2 to 3 you get a sleep, right? How can you write exams? Okay. Huh? 2 to 3 you sleep and 3 to 5 you write exams, right? Okay. Out of 3 hours, how much time you spend on writing? 3 hours, non-stop, without seeing also, your hand will be like this only. No. See, total 100 marks paper. And we are having 180 minutes. Sir, 15 minutes is there, sir. Throw it in dustbin. 15 minutes. Looking at our friends, looking at the paper. Once we see paper, once we see our friend. If he is happy, oh God, he know this problem. There is a, at my time, when I'm a student, my seniors, 2 of my seniors, they applied for examination at a time. And they got, first, second, like that. First person, he reads well. Second person, he copies well. So both qualified in the same attempt. Don't already applied, right? Okay, no problem. Friends should not fall in our center, ma. Then only we can write peacefully. So, no. See, where there is a way, where there is a will, there is a way. So even unknown person also, we can. It's not a big deal at all. Okay, fine. 100 marks, 180 minutes. 30 minutes avoid, deduct normal loss, abnormal loss, just deduct normal and abnormal loss. So total 150 minutes. 100 marks, 150, that means 1 mark is equal to 1.5 minute. This is the equation. So if you are writing 4 marks question, maximum you should spend how many minutes? 6 minutes, that's it. This practice may not be important for theory, but this is very important for accounts, like accounts only, not only other subjects, only accounts, because costing small only, costing all the things are small. So for theoretical papers, 4 marks equal to 6 minutes, but problematic papers, particularly if you take problematic papers, if you are doing a consolidation problem, or if you are doing a amalgamation problem, suppose the problem is of 16 marks, straight away you should invest 24 minutes only. Extra, if you want, invest 6 minutes, but 30 minutes completed, okay, leave some 2-3 pages space, start solving another problem. Because sitting in front of this problem, it may give you 16 marks if answer is correct. If answer is not correct, you may lose it. And one more small point for your for scoring, don't start your preparation, don't start your presentation. Two things: preparation, that means study; presentation, that means exam. Don't start your preparation and presentation with big chapters. For example, with respect to accounts, amalgamation, consolidation. Always start preparation and presentation with small chapters. For example, accounting standards, cash flow statement. Why? What happens? Suppose if you take accounting standards, or if you take cash flow statement, 8 marks problem is coming, and it takes hardly 15 minutes to solve it. So once slowly, if you complete small problems, by the time 2 hours if completed, 2 hours completed, by the end of 2 hours you solved only 60 marks, no problem. Remaining 40 marks, big problems, you can solve it peacefully in that 1 hour. Suppose 2 hours you spend on these big problems, you completed 40 marks, and balance 1 hour you need to write 60 marks. Definitely you know the problem, you know the answer, but hurry you will commit mistakes. That is with respect to presentation. With respect to preparation, if you start big chapters, what happen? Suppose 15 chapters are there in CA, in CA interlaw. 5 chapters are big, 10 chapters are small. Time required for 5 chapters, time required for 10 chapters, imagine equal. So you are left with some 20 days. Imagine 10 days over, only big chapters over. Psychologically it creates a pressure. Oh my god, I am left with 10 days, I am having 10 chapters. But if you complete 10 chapters, small chapters first, so easily, by revising multiple times. So when you go to big chapters, you won't feel pressure. You won't feel pressure at all. And moreover, big problems, big chapters only, adjustments, tricky adjustments they will ask. Everything, amalgamation, consolidation possible. Tricky adjustments are 100% possible. If you take income tax, PGBP, total income problem, 100% tricky adjustment will come. But small chapters like TDS, TCS, advanced tax, adjustments, tricky adjustments will not come. So when you start preparation, when you start presentation, first small. That means chapters that will give you 4 marks, next 8 marks, next 16 marks. You remember this hierarchy. Imagine if you started consolidation as a problem 1 in your examination. So definitely if it won't tally, if you keep it blank, or if you write some wrong number, first problem itself when it is wrong, automatically the impression will be lost for the subsequent questions. So that's why preparation and presentation begin with small. Okay, now come back. So penalty how much ma? 50,000 rupees. Next one, liability for depository. Depository, simply depository is involved in what kind of securities? Demat form of securities or mat form of securities? Demat form of securities. In demat form of securities also fraud is possible. How it is possible? Cyber attack. That means depository is not maintaining system secured way. So depository will get punishment under section 447. Clear? Next one, forged transfer. This is also a good concept for testing in examination. What is meant by forgery? What is meant by forgery? Imitating signature of other person. If you imitate signature of other person, it's a forgery. Tell me, how many of you did forgery in your progress cards? No one. Honesty, honesty is important. I never did forgery, but what I did, in one examination, I got 21.5 marks out of 25. So if my mother look at these marks, definitely she kill me. That's why what I did, I made like this. So I never forged signatures, okay? I'm a very good, decent, innocent person. Fine. Now listen carefully. Mr. Manoj is a member of a company. Share certificate is in the name of Manoj. Another person, for example, Mr. Ajay, a fraud person, what he did? In the absence of Manoj, he took share certificate. To that share certificate, he attached a SH4, that is transfer deed. And on this transfer deed, Ajay signed as if he is Ajay, and he also signed as Manoj, as if he is a Manoj, as if he is a Manoj. Now this instrument of transfer, that means SH4 plus share certificate, got submitted to company. Company registered transfer and company issued share certificate in the name of Ajay. 1 year completed, Manoj is not getting dividends, Manoj is not getting a notice calling for general meeting. So Manoj went to company, what is happening? And Manoj came to know that shares already transferred to Ajay under forged transfer. Now tell me, forged transfer actually valid or void? Should company register transfer or should company reject the transfer? But company allowed the transfer, that means company is at fault. So during this 1 year, whatever dividends company paid to Ajay, it is a duty of company to repay that amount to the Manoj, to Mr. Manoj, that is original member. And whatever amount company paid second time to the Manoj, second time, first time already paid to Ajay, second time it paid to Manoj. So this is a loss, company can recover that amount from Ajay. So simply you can see here 3 parties: company, original shareholder, OS means original shareholder, forged transferee, FT, forged transferee. So company is liable to original shareholder and forged transferee is liable to company. Suppose Mr. Ajay, he transferred shares to innocent person, for example Charan. Charan don't know about the forged transfer between original shareholder and Ajay. In that case, is Charan a true owner of the shares? Answer is no. Why? Nemo dat quod non habet. No one can transfer better title than he possesses. Already Ajay had no title, so Charan will also get no title. Now whatever amounts, dividend amounts paid to Charan, yes, once again company is liable to original shareholder. So it is a duty of company to restore original shareholder details in the register of members. But the problem is Charan will cry. Why? Sir, looking at the share certificate which is in the name of Ajay, I bought these shares. If you didn't issue that share certificate, I wouldn't have paid amount to Ajay. So for me, total loss, sir. Okay, don't worry. Company is liable to Charan. Whatever consideration Charan paid to Ajay, for entire consideration, company is liable to Charan. And company will get reimbursement from whom? Ajay. So total how many parties are there? Except company, total how many parties? Original shareholder, forged transferee, innocent buyer, and last one, company. So responsibilities of company, rights of original shareholder, rights of innocent buyer, obligations of a forged transferee is all about this question. Let's see, forged transfer. A forged transfer is a nullity and not legally binding. It occurs when a company registers transfer of shares based on an instrument of transfer with forged signatures of the transferor. Effect on real transfer. The real owner remains legal shareholder. The company can be forced to delete the transferee's name. Who can compel company? Real owner. That means original shareholder. And original shareholder can compel company to restore original shareholder's name in the register of members. Next, remedy for genuine third party buyer and company. What is the remedy? If a transferee who acquired shares via forged transfer sells them to an innocent buyer and company registers the new buyer, then what is the remedy available? Company cannot deny ownership rights to the genuine buyer who acted in good faith. That's why company should compensate innocent buyer. So here company shall restore the name of original shareholder, but may be asked to compensate innocent buyer. And company can seek indemnity from the first transferee, that means forged transferee. Clear? So company is responsible to two persons. One is original shareholder, other one is innocent buyer. Whatever loss incurred by the company, company will get indemnity. That means compensation from forged transferee. Role of dematerialization. Dematerialization significantly reduces the chance of forgery. Correct. If something is in demat form, something is in electronic form, forgery is not possible. Private companies are not required to dematerialize securities, but due to fewer shareholders, they can exercise caution and detect forgery more easily. Why? Fewer, exactly. And moreover, there is a point in section 2 clause 68. Transfer is possible only with the board of directors approval. So board will ensure that transfer are really transferred shares or not. That's it. Next one, 57. 57. Let's see section 57. What is 57? Personation. Punishment for personation of shareholder. Punishment for personation of shareholder. Three Idiots movie, do you remember? It was remade, remake happened with Vijay Talapati sir. You remember the name of movie, right? Oh, okay. In English, we can call it as a friend, yes or no? Correct? Telugu Snehitudu movie, name of the movie is Snehitudu. Same in Tamil also. But to understand for global audience, sorry, Indian audience, I'll write a name friend. In that movie, if you observe, his name, what is the name of that hero? What is the name given to that? Not principal. Principal name virus, I remember. Huh? What is the name of Ranchor Das? That is Three Idiots, right? Okay, okay, forget about the names. But if you remember, one scene, that rich person's kid should study engineering in engineering college. But who actually studied? Simply, nominee, representative. Yes or no? Certificate was issued in the name of real person only. But who got that certificate? A representative got that certificate. Yes or no? Two persons, to understand, I am telling you. V is a student. Another person, A, for example, another person, A. So A is an actual student, but on behalf of A, who attended the college, who attended the exams, who wrote exams, who got degree? Mr. V got degree. But finally, who claimed that degree? A claimed the degree. Correct? That is nothing but simply personation. That means, best example. Now I remember. Personation best example, Chandramukhi. You remember movie Chandramukhi, Rajnikant sir movie? First Chandramukhi, she stood like Chandramukhi. She kept a pose like Chandramukhi. Finally, she became, that is personation. Don't write in examination that story. But that is an actual example of personation. As you all know, in share certificate, images of shareholders are seen, or just names of the shareholders are seen? Names. And in India, it is very common, two or more persons will have same name. Suppose Rahul is a member of the company. On the name of Rahul, share certificate has been issued. Another person with same name, Rahul, what he did, he got these shares and he is trying to claim all the benefits associated with the shares. So simply changing the identity in order to get these benefits, whether he get these benefits or not. That means whether he get the benefits or it is in the process, still this fellow will get punishment under section 57. That is all about this section. Intentional personation. Let's see. If any person intentionally personates as owner any security interest in a company or any share warrant or coupon issued under the act, then that person, then the person obtains or attempts to obtain. First of all, why that person is making a personation? In order to obtain or attempts to obtain security, interest, share warrant, coupon. Receives or attempts to receive any money due to the rightful owner. then that fellow will get punishment minimum 1 year, maximum 3 years, and minimum 1 lakh, maximum 5 lakhs. It's not either or this, both. So in our movie also, Chandramukhi, I mean, actress stood like Chandramukhi, pose also like Chandramukhi. Finally, she became Chandramukhi. There, Chandramukhi punished her. But here, who will punish? Authority will give punishment. What is the punishment? Either imprisonment or fine, or both imprisonment and fine. Both imprisonment and fine. Finally, one point you have to understand, that is why that fellow is making personation. The only reason is trying to get some advantage over the security. Can I? 57 also over. 2 more sections before I give you break. 2 more sections. 58 and 59. 58 and 59. Small sections only. Let's see. Refusal of registration and appeal against refusal. For transfer, how many parties are required? 2 parties, transferor, transferee. And what documents are required? Share certificate or letter of allotment plus SH4. What is SH4? Transfer deed. Once either of these parties send these documents to company, it is the duty of company to issue share certificate or security certificate within 1 month. Yes or no? But sometimes what company can do, company is having a right to cancel the transfer, hold the transfer. For example, if this company is a private company, yes, it is having 100% power to refuse transfer. Simply to protect privacy, they can refuse transfer. In case of public companies, generally, why they refuse for transfer, shares are partly paid up. Imagine shares are partly paid up. Transferor, he is a wealthy man, he is having funds, but intentionally to escape from the liability, he is making one innocent, financially illiterate person, financially unsound mind, financially, I'm not telling mentally, I'm telling you financially. So he found financially unsound person and he is trying to transfer shares to that person, so that tomorrow even if company may calls on shares, that fellow will not make payment and this fellow will escape. So in this situation also, definitely what company can do, it can restrict, it can refuse to register the transfer. Suppose if they are partly paid up shares and transferee didn't give any intimation, or transferee gave objection, sir, don't register partly paid up in my name. So in all these cases, these are the valid cases where transfer registration can be refused. But apart from these reasons, apart from these valid reasons, in case of any invalid reason, company is making delay unnecessarily, without any proper reason, company is not registering the transfer. In that case, the affected party, that is transferee, can go to NCLT, can cry in front of NCLT. Sir, why aggrieved party is transferee? Because transferee already paid consideration to transferor. So transferee can appeal to tribunal. Clear? If a private company refuses to register transfer or transmission of any securities or interest, securities means which company? With the share capital. Interest means without share capital. It shall send notice to transferor and transferee within 30 days of delivery of transfer instrument or transmission intimation. Okay. Appeal to the tribunal. Transferee can appeal to the tribunal. It is very important. Who can appeal? Transferee. Within how many days? 30 days of receiving refusal notice. Sir, I didn't receive any notice from the company, sir. Then within 60 days of delivery of a transfer instrument or intimation. Why? Already when you deliver these documents to company, it is the duty of company to give share certificate within 1 month. Or it is the duty of company to give refusal notice within 30 days. Both same only, meaning both are same. For refusal notice 30 days, for registration of transfer and issue of certificate 1 month, both are same. So if you are not getting any share certificate, if you are not getting refusal notice, then from the date of delivery of documents, within 60 days, file an appeal with NCLT. Clear? Suppose in case of public company, here what is the time limit? 30, 60, right? There it is, add 30, that's it, 60, 90. 60, 90. Let's see once here. Observe carefully. Company shall give notice of refusal within how many days? Within 30 days of delivery of documents to transferor or transferee or person who filed intimation for transmission. Then transferee, aggrieved party or intimation fellow, he will file an appeal with NCLT. Within how many days? In case of receiving of notice of refusal, within 30 days in case of private company, within 60 days in case of public company. If there is no notice of refusal, then within 60 days of delivery of documents for registration of transfer in case of private company, in case of public company, 90 days. Now ball is in the court of NCLT. Now NCLT will decide either to allow or dismiss. Dismiss means cancel the application. Order means allow the application to register. The transfer application shall be registered. If anyone fails to comply NCLT order within 10 days, then that fellow will get punishment. That is imprisonment 1 year to 3 years, fine 1 lakh to 5 lakhs. Let's see here. So it is very tricky point to understand. In case of private company, once again I'm telling you, in case of private company, 30 days of refusal or 60 days of delivery. Whereas public company, 60 days of refusal or 90 days of delivery of instrument. When 90 days? If no refusal notice. When 60 days? In case of notice of refusal. So dealing by NCLT after hearing the parties may order transfer or transmission to be registered within how many days? 10 days. From the order date, you will be left with 10 days to register transfer or transmission. And also it may it may also ask for to pay damages. Direct rectification, just wait here also that point will come. Direct rectification, that point will come here. So 58, 59 somewhat interconnected. I will tell you, just wait. So non-compliance, punishment. What is the punishment to the officer in default? 1 to 3 years and 1 lakh to 5 lakhs. Next one, rectification of register of members. So what is 58 I filed application, but that application they are keeping in pending or they are not processing it. But 59, there is one highlight point. The highlight point is, I am a member of the company, but intentionally or unintentionally my name was omitted from the register of members. Or I am not a member, but they included my name as a member of the company. Two situations. One is, I am a member, but my name is not included in the register. Or I am a non-member, but wrongly my name was included in the register. In both the cases, we had a demerits. First case, demerit is non-receipt of general meeting notice, non-receipt of dividends. Second case, demerit is tomorrow if company makes calls on shares, even though I'm a non-member, I should pay because my name is included in the register. So that means finally there is an error or there is a mistake in the register. That mistake should be eliminated. That elimination we call it as rectification. Understand? So rectification of register of members. Remedy to the members, application to NCLT, aggrieved person. Why aggrieved person? Suppose I'm a non-member, but my name is included in the register as a member. So I'm a non-member, aggrieved person. Next one, member. He is a member, but his name was omitted from the his name was omitted from the register. So aggrieved person or member may apply to NCLT for rectification of register of members if person's name is wrongly entered in the register of members or member details are later omitted from the register of members. There is a default or delay in recording the name in register of members. So all these are Indian registers, but in case of foreign register, is it possible for a foreign member to come to India to file a petition with NCLT? No. That's why they can file a petition with competent courts outside India. So yes, government of India will announce some competent courts outside India. So you can go to them, you can file application there. Now what is the what powers tribunal is having? Tribunal, either it may dismiss the appeal if there is no evidence at all, or it may direct registration of transfer or transmission within 10 days, or direct rectification of register of members or records of depository and order of the company to pay damages to the aggrieved party. So if you observe, this point is common in 58 as well as 59, and this point is also common in 58 or 59. So that means 58 is talking about refusal to register, 59 is talking about rectification. So both are same only, both are interconnected in fact. So that's why NCLT powers are common in 58 as well as 59. Voting rights to the transferee. Sir, transferee, can he exercise voting rights? Yes, he can exercise voting rights unless tribunal suspended those voting rights. That means, Mr. M transferred shares to A, but this transfer not yet registered. Actually, M is not a member because he is not holding shares, but still his name is continued in the register of members. A is a shareholder, but he didn't become member because registration of transfer not happened. So in this case, who will exercise voting rights, sir? A will exercise voting rights unless suspended by the tribunal order. Contravention of other laws. Punishment. If transfer violates any law, including SCRA, SEBI, Companies Act, then NCLT on an application, NCLT may on an application direct any company depository to set right the contravention and rectify the records registers of the concerned parties. One live example for violation of SEBI Act. Yesterday, I think, day before yesterday, IndusInd Bank, continuously the share is hitting lower circuit. Actually, share, I think it's 9-10 rupees, I think, share value. Opening share 9-10. So one lower circuit, it came to 8-10. Next lower circuit, it came to some 755, for example. So, whenever a share touches a lower circuit or upper circuit, some 15 minutes break will be given to the share. That means 15 minutes, that share will not be tradable. That share will not be tradable. Why? Meanwhile, SEBI officers will check whether it's a genuine fall or intentional fall. If it is intentional fall, those who are responsible for that fall, they will be caught and they will be punished. Suppose this is genuine fall. After 15 minutes, they will open one more lower circuit. So, day before yesterday, first lower circuit is 10%, next lower circuit is 15%, next 20, next 23, finally 25. Like this, these many times lower circuit has been updated. Now, whenever circuit is getting updated, during that time, transfers are strictly prohibited. But if any depository is allowing to transfer securities, then the depository will get punishment under this section. Clear? So this is a live situation. So with this, section 59 also we completed. So we are left with section 62, section 72. Let's have a break for 10 minutes. Let's continue our discussion with section 60, that is authorized capital, called up capital. I told you previously, kinds of capital means we are having only two kinds, equity, preference. Coming to types of capital, authorized, subscribed, issued, subscribed, called up, paid up. Now let's see the content of section 60. Authorized capital, it refers to maximum amount of share capital that a company is authorized to issue as specified in the memorandum. So this is the maximum capital a company can raise by issuing shares. Called up capital, it refers to the part of share capital that company has called for payment from the shareholders. So here we know about here we read only about the types of capital. What is called up capital? What is authorized capital? But if you look at section 60, on all official publications, wherever you write about authorized share capital, it is the duty of company to publish subscribed capital as well as paid up share capital. Imagine, I'm introducing my company like this. My company name is V Global Industries Limited. Authorized share capital is 500 crores. Actually, paid up share capital is 1 lakh. Now, by hiding this paid up share capital, if I tell you that V Global Industries Limited, authorized share capital 500 crores, now what it conveys to the public, how public think about this company. This is a global company and this may be a Fortune 500 company. Yes or no? Because word global is there and authorized capital 500 crores is there. So wherever you are printing authorized share capital, at those places you need to print two other capitals, that is subscribed share capital, paid up share capital, so that there would be no negative message, there would be no misleading message to the public. I'm telling you, no need to print these two capitals if authorized share capital is not printed on the official documents. If authorized share capital is printed on the official documents, then also include subscribed capital, paid up share capital. Default for company 10,000, officer in default 5,000. Content is not there in study material, so you can ignore. For the time being, authorized share capital means maximum amount of share capital that a company is authorized to raise. Called up share capital means that is the amount a company so far called for payment. Paid up capital means called up minus calls in arrears. Next one, Alteration of share capital. Alteration of share capital. Capital clause of a company. In my company capital clause, the capital is like this: 2400 crores. Authorized share capital is 2400 crores divided into 480 crores shares, and face value is 5 rupee. This is my original capital clause of MOA. Original capital clause, not altered. Now my situation is, so far my paid up share capital is 2400 crores. That means authorized is equal to paid up. I still need some 2400 crores. Now what can I do? Simply, sir, increase authorized share capital. So after increase, what would be the revised capital structure? Revised capital structure, revised authorized share capital is 4800 crores divided into 960 crores shares. Face value 5 rupee. This is one way of alteration of capital, that is increase. Second way, quite reverse. Suppose out of 2400, my paid up share capital is just 2000 crores. That means remaining 400 crores, I had no intention to offer right now. I had no intention. Forever, I will not ask this amount. I will not issue this amount. I'm sorry. My authorized share capital is 2400 crores. My issued share capital, subscribed share capital, paid up share capital, everything is 2000 crores. So there is a unissued share portion, that is 400 crores unissued share portion. I will not issue forever. So why unnecessary? Let me cancel this. That means if I cancel this, what would be the revised capital structure? Revised authorized share capital structure would be 2000 crores divided into 400 crores shares, face value 5 rupee. So in how many ways I can alter share capital? Two ways. One is increase, other one is decrease. Apart from these two, suppose looking at this number of shares, how many number of shares are there? 480 crores. Why this much quantity? Let's reduce the number. Is it possible? Yes, possible. How? I will consolidate total share capital and then I will subdivide the share capital in this way. Like 2400 crores, right? First I will consolidate it as a one pool. Now I will divide shares with face value of 10. So revised number of shares would be 240 crores. So previously 480 crores shares, right now 240 crores. But there is no change in 2400 crores authorized share capital. There is no change in 2400 crores authorized share capital. Only face value I am revising. Okay. Suppose I want more number of shares. The reason is transferability, trading point of view. Suppose if you take, MRF company share, if you take, the share value of MRF is 1 lakh rupee for the time being. Face value how much? This is a market price. Face value is how much? 10 rupee. Imagine an investor with 60,000 rupees. Tell me how many shares he can purchase? How many MRF shares he can purchase? 0. Why? 60,000 is not sufficient for 1 lakh. So tell me, for small shareholders, is it possible to trade MRF share? No. Now what company can do? Company can split one share into 10 shares. Now revised face value would be 1. If one share is getting divided into 10 shares, that means market price will also comes to 10,000. That means divided by 10. So 10 shares of 10,000 means 1 lakh. Now when market value is getting 10,000, definitely with the money he is having, he can purchase 6 MRF shares. So this is we called split. We call it as split. Suppose in this situation you can see 2400 crores common. Face value I am making 1 rupee. That means number of shares get increased to 2400 crores. So if you observe, increase of capital, decrease of capital, consolidation of share capital, split of share capital. And last one is, I will convert few shares into stock, or I may reconvert stock into shares. So in how many ways I can alter my capital? 5 ways. Increase, decrease, consolidate, split. And last one, conversion of shares into stock, reconversion of stock into shares. But for alteration of share capital, 2 conditions to be satisfied. Before alteration 2 conditions, after alteration 1 condition. What are those 2 conditions? First, my AOA should allow me. If AOA is not allowing, go and follow 14. Sir, AOA authorization is there, sir. Then call members for a meeting, obtain ordinary resolution. So 2 conditions before alteration over. Next, what is the condition after alteration, sir? Intimate ROC within 30 days of alteration along with altered MOA. Now, for alteration of MOA, tell me which resolution is required? Yes, sir. But in 2 cases, OR is sufficient. Can you tell me, can you name those 2 cases? One case you can name here itself, alteration of capital. Alteration of capital, what type of resolution? Ordinary. In another situation also, OR is sufficient. Can you name that situation? You think on it. Name alteration. Yes, sir. Huh? Shares to stock, that is nothing but alteration of capital only. Here only I wrote. Object clause alteration, yes, sir only. Situation, shifting from one state to another state, yes, sir only. Name, in name, when OR is sufficient, OR is required. Yes, correct. Name change happens because of 2 reasons. Voluntary, compulsory. Voluntary, yes, sir. Whereas compulsory, that means rectification of name, OR is sufficient. So, alteration of MOA, SR is needed with 2 exceptions. What are those 2 exceptions? Rectification of name, OR. Alteration of capital, OR. So, if you observe, for alteration of capital, how many conditions to be satisfied? 3. AOA authorization, OR, filing it with ROC. So, in these 5 ways, if you observe, only this point, if you observe, note here one note and here another note. These 2 notes we need to understand. If consolidation and division results in changing in voting powers, it shall be approved by the tribunal. Generally, because of consolidation, voting powers will not change at all, because previously I had 10 shares. Because of consolidation, 10 shares may become 1 share. Previously, how many votes I am having? Right now also I will have same votes only. Let's see, company is having 1 lakh shares, I am having 10,000 shares. Company decided to consolidate 10 share as 1 share, imagine. Now total number of shares will become 10,000 and my shareholding will come to 1,000. Previously my voting power is 10%, now also my voting power is 10%. So majority of cases, consolidation and division will not result in change in voting powers. Again student will get a doubt, sir, why consolidate and divide? I told you 480 crore shares will be consolidated as a single share and it will be divided into 960 crore shares. Just look at the notes. Where is the point? Yeah. First one, this is increase of capital. This is diminution of capital. This one split. And this one. If you observe this one, 2,400 crores. There is no change in authorized share capital. 2,400 crores only. I'll consolidate all 480 crores shares into 1 share and then I will divide it into 240 crores with a revised face value of 10 rupee. That's what first I will consolidate, next I will divide. Because of consolidation and division, 99.99% there will be no change in voting powers. But few situations there may be a chance. How comes, for example, company decided to consolidate 1 lakh share into, consolidate and divide into 1 share. So if you observe carefully, a big shareholders, definitely no problem for them. If they hold 10 lakh shares, they will get 10 shares. If they hold 5 lakh shares, they will get 5 shares. Suppose small shareholders, those who are holding just 20,000 shares, 30,000 shares, 5 shares, 5,000 shares, will they get share in return? No. They are bound to surrender these shares to company's promoters. Because shares fractional not available, right? Fractions of shares not available. So in this situation, what happens, promoters voting power will go up. Public shareholding will come down. Those who are holding small shares, their shareholding will come down. Promoter shareholding will go up. So shareholding going up means voting power gets increased, whereas small shareholders voting gets reduced. That means this is like a oppression of small shareholders. This is like, simply we are killing small shareholders legally. So this should not be allowed. That's why in this case we will seek tribunal approval. Sir, this is genuine only, sir, not to oppress minorities, but as a policy of company, we are doing this. So no one is getting, no one is getting affected. Like that, if you are able to prove, tribunal will give approval. Next, subdivide, if you observe, Face value 10 rupee, paid up value 6 rupee, imagine. Now you decided to split this one share into two parts. In that case, face value becomes how much? 5, 5. Similarly, paid up value should also become 3, 3. It should not be like this, 5, 1. It should not be like that. Proportionately, the paid and unpaid amounts on a reduced share shall maintain the same proportion as the original share. Clear? Next one, cancel shares. As I told you, note this is not considered as reduction in share capital. Just wait. Diminution versus reduction I will discuss with you in section 66. Just wait. Decrease in share capital will not result in reduction in share capital. Why? I will tell you in 66. Ignore. So with this 61 completed. Next one, section 62. Further issue of shares. Why it is further issue of shares? Because initial issue already happened. When initial issue happened? At the time of incorporation of company. So any issue subsequent to initial issue we call it as further issue. Now this further issue of shares shall be offered in this manner. In which manner? In this manner. First priority I should give to existing members. Second priority I should give to employees. Third priority I should give to others. Why? Because I love existing members. No. To avoid dilution of control. To avoid dilution of control, first priority is given to existing members. If existing members are not okay, then I will go with employees. Why? Because they are internal members, they are internal persons, they know about company. So I can avoid prospectus, I can avoid private placement, all these things I can avoid. Clear? So that is all about employees. No, fund is very huge, my requirement is very huge amount. Then you can go with others. But if you observe one thing carefully, for employees, for others, special resolution is mandatory. Whereas existing members, special resolution is not at all required. Now if you observe, if you are giving offer to the existing members, you need to prepare a document called a letter of offer. So for public offer we use document prospectus. For private placement we use document private placement offer cum application letter. For existing members we use a document called a letter of offer, and that letter of offer shall be dispatched at least 3 days before subscription, so that they can go through this document. They can go through this document within the 3 days. And that offer period is nothing but subscription period, during which you can file an application, you can deposit money for additional share. That offer period should be minimum 7 days, maximum 30 days. So these 3 days, these 7 days can be reduced in private companies, IFSC public companies with the consent of 90% members. Suppose I'm opening offer on 20th March onwards. Offer begins from 20th March. So this offer communication should be done at least by 17th March, 18, 19, 20, 3 days before. Yes or no? Very simple ma. Big billion days. Amazon, Flipkart is announcing, big billion days. So after completion of offer they communicate, before opening of offer they communicate, before opening of the offer. Similarly here also. And this offer period should be minimum 7 days, maximum. That means it should not be less than 7 days. It should not exceed 30 days. Renunciation is possible. Right to subscribe additional share. This is a right available to. This is a statutory right available to all the members. Okay. So if they want, they can transfer that right to their neighbors, whoever. But I told you, if renunciation is happening beyond 50 persons, in one case study, SEBI decided it as a public offer. Yes or no? SEBI declared it as when renunciation is happening to a number of persons exceeding 50, it is deemed to be a public offer. Next one. So with this, existing members letter of offer over. Employees, if you are going with employees under employee stock option plan, special resolution is required. But for private companies, OR is sufficient. For IFSC public companies, OR is sufficient. Next one, for others, others means nothing but 2 categories of people. One is identified persons, one category. Public at a large, another category. For identified persons, I will follow section 42. For public, I will follow section 23 to section 40. That means prospectus related provisions. So valuation report is compulsory in case of others, because new persons are becoming members of the company. If I fix a higher share price, these new persons will be at loss. If I fix a lower share price, existing members will be at loss because they subscribed at higher prices. So whether price is, whether price is whether price is genuine or not, for that get a valuation report. Small point before I open material, small point. If you observe carefully, first priority should be given to whom? Existing members. For that, resolution is not required. Any person other than existing members, if you are offering shares to any person other than existing members, definitely special resolution is compulsory. But to this rule we had two exceptions. What are those exceptions? Company issued convertible debentures, company issued convertible preference shares. At the time of conversion, special resolution is not required. Special resolution is not required. Why? Because at the time of issue of convertible debentures, at the time of issue of convertible preference shares, already special resolution has been passed. Just now I discussed with you in section 55, issue of preference shares requires special resolution. Correct? Similarly, in private placement, issue of CDs, issue of convertible debentures also requires a special resolution. So at the time of issue, since company passes special resolution, at the time of conversion, that means at the time of issuing shares to the debenture holders, to the preference shareholders, special resolution required or not required? Not required. Next one, non-applicability. Second, compulsory conversion of debentures or loan. Our company, intelligent company, it got loan from government. Generally government will take loan, but as per provisions of Companies Act, government gave loan to company. Next, company allotted debentures to the government. Tenure completed, but company is not paying these amounts. That means company is not in a position to clear these amounts. Liquidity, no liquidity. Now government will consider the public interest involved in this company. Public interest involved in this company. How C Limited is having impact on the public. For example, in C Limited, 10,000 employees are there. That means 10,000 families are based on C Limited. So if we order for liquidation of C Limited, all these 10,000 families will come on road. So considering public interest, what government will do? Government will ask company to convert these debentures, to convert these loans into equity shares. When government is passing that order, sir, wait, sir, you are an outsider, sir. For issuing shares to outsider, members approval required, special resolution required. Applicable, not applicable? Not applicable. Central government order itself is sufficient for conversion, so no need of special resolution. Understand the logic. Except existing members, if you are going with employees, if you are going with outsiders, SR is compulsory. But this SR is not required for converting securities, for converting debt into equity, preference shares into equity. And next one, in case of compulsory conversion of debentures issued to government, loans obtained from government into equity, there also SR is not required. But if you want to challenge central government order, you can challenge central government order within 60 days. Within 60 days of CG order, challenge CG order. Suppose appeal dismissed or you didn't appeal government order, then government order itself is sufficient to show effect on authorized share capital. That means your authorized share capital automatically gets increased to the extent of such a conversion. Suppose right now 100 crores is my authorized share capital, paid up share capital also 100 crores. Loan amount is 25 crores. Now government is asking to convert a loan amount into equity. Sir, my authorized capital, my paid up share capital is matching, sir. I can't increase it, sir. No problem. My order is sufficient to increase authorized share capital to the extent of 125 crores. Clear? Simple. Section 62 over. And this section 62 not applicable to Nidhi. Why? Nidhi companies are popular for what? Accepting deposits, lending loans. So whenever I am issuing a new shares to the new members, again calling for a meeting, members come on, give me approval. Every time allotment, every time taking approval from existing members, that is practically not possible. That's why this section is not applicable to Nidhi. Yes, voting rights in case of Nidhi company restricted to 5%. So section 62, when I summarized, it's almost half page content. Let's see in material. One, almost 2 pages. Almost 2 pages. Suppose if you check here, share capital and debentures here, section 62, right? This is previous material. So those who have read the previous material, for you I am just telling you the changes between old and new. Even for transfer and transmission also you can see the content. It starts from here, 11th question. Come on. Yeah. Almost 3 pages. So without compromising content, reduce the content. Let's see, section 62, right? Yeah, this is 62. You can see here, page number 114. Let's see till where it went on. Come on. Yeah, it's ended. 118. 5 pages. 114, 15, 16, 17, 18. 5 pages. Now which matter you deleted, sir? Practical insight required for examination. Ignore. Chart, already I shown my handwritten notes. Why once again? Ignore. Relative definition, already came in previous chapter. Ignore. Next one, this point I shown you in handwritten notes. This point also I shown you in handwritten notes. Government order, deemed increase in authorized share capital, mandatory conversion, non-applicability of 62. See, non-applicability of 62, if you observe, it's almost 1 page. Non-applicability is almost 1 page. Deemed increase, including deemed increase. But if you look at the handwritten notes, it's just some 5 to 10 lines, 5 to 6 lines, that's it. So why I'm telling you all this is, even if you read this much content, no need to write this much content in the examination. Instead of doing this, you read it 2 to 3 times this one, or your own handwritten notes. If your own handwritten notes is available, 100% you follow it, because when you're writing something, a lot of efforts you will keep without your knowledge. So definitely you will remember that points for sure. If you are reading someone books, you need to read it, you need to revise it. But if you draft it on your own, no need of 2 to 3 revisions, just 1 revision is sufficient. Okay, come back, let's see section 62. Further issue of shares. When a company with share capital plans to increase its subscribed capital by issuing more shares, these shares shall be offered first to whom? Existing equity shareholders. In what ratio? In the proportion to the paid up share capital on the shares they hold as on offer date. That means, suppose the ratio is like this, 1:10. For every 10 shares you are holding, you will be given 1 right. Suppose I am holding 100 shares, I will get 10 rights. You are holding 10 shares, you will get 1 right. Someone is holding 1000 shares, they will get 100 rights. So that's why in proportion to the paid up capital. Next one, to the employees under an ESOP, employee stock option scheme, subject to a special resolution passed by the company. So what is ESOP? You can see here, an option of biscuit. On page it is an option, but in fact it is a, yes, honey biscuit. An option granted to directors, officers, employees, only internal staff members. Company will not offer me because I am outsider. Okay, so option granted to directors, officers, employees of the company or its holding company, subsidiary company, to buy, subscribe shares at a predetermined price in the future. In accounts, I think ESOP is there for you, right? Calculation of ESOPs. So same thing, this is conditional part, and whatever problems you are solving, accounting part. In the following cases, an ordinary resolution is sufficient instead of special resolution. Which case? A private company that has not defaulted in filing its financial statements under section 137, annual return under section 92, specified IFSC, public companies. So for these two companies, what type of resolution is sufficient? Ordinary. Can I? Next, for listed companies, SEBI share based employee benefit regulations 2014 must be followed. unnecessary this point, I know, because in section 24 it is very clear, listed company, company in the process of listing, issue and transfer of securities, SEBI regulations will apply, yes or no, same point. Next, to any other persons, just look at the priority, existing, employees, others. If authorized by special resolution, shares can be issued even to those not covered under above two categories, simply outsiders. Shares can be offered for cash consideration or for non-cash consideration. Amalgamation is best example for non-cash consideration. If offered for non-cash consideration, the price must be predetermined, determined by a valuation report from the registered valuer as per rule 13 of the company's share capital and debenture rules 2014. Next, this is one part of the, one subsection of the main section. In this subsection, what we read, existing equity shareholders, employees, any other persons. Next one, to the existing members, if you want to give offer, if you want to give rights offer, then what conditions to be satisfied? First, you need to prepare a document called letter of offer. Letter of offer shall specify number of shares being offered, specify the time period for acceptance, which shall be at least 15 days but not more than 30 unless a shorter days period is prescribed. This is a amendment. This is amendment applicable since our attempt, May 25 attempt. Previous study material, this 7 days concept is not there. So from May 25 onwards, the point is, time period for acceptance means what? Offer period should be minimum 15, maximum 30. But this can be reduced to up to how many days? Up to 7 days. As per Act 15, whereas as per rules 7. Clear? Remember the limit, because chance is there to ask this point in the examination, chance is there. So minimum offer period should be 7 days, maximum offer period should be 30 days. Letter of offer shall state that if offer is not accepted within the specified time, it will be deemed declined. That's only, because mere silence does not amount to the acceptance in this situation. If you are not filing application, we assume that application has been, offer has been declined. Confirm rights to renounce shares in favor of another person unless restricted by AOA. So renunciation benefit is possible, 100% possible, unless it is prohibited by AOA. Now if you observe, all these are contents of letter of offer. Next, notes. If an existing shareholder declines the offer, does not respond within specified time, the board of directors may dispose these shares in a manner that is not disadvantageous to the shareholders of the company. Very important to understand this word, not disadvantageous. Not disadvantageous means it's not advantageous. It's not advantageous. It's like, I should not, no loss to me, that's it. It need not be a profit. Suppose market value of the share is 650, imagine. Under rights issue, you offered that share for 550 only, because existing member, right? So definitely we should give benefit to the existing member. You fixed 550. If existing member is not willing to take this share, sell this share in the market or subscribe, allow someone to subscribe this share at a price not less than 550. I'm not expecting any profit, but below this price, don't make any allotment. So here I should not get any loss. That doesn't mean I should get profit. For me, 0 also okay, that's it. So in examination, don't write in a reverse manner. That is in advantageous. It is not correct. Not disadvantageous to the shareholders of the company. That means simply, whatever shares remained unsubscribed under rights issue, board of directors are having powers to dispose them in such a manner that there should be no loss to the company, no loss to the shareholders. When determining the proportion of the shares to be offered, allocation shall be as fair as possible under the circumstances. Talking about ratio, 1:9 or 1:8. So fix it accordingly. For private companies and specified IFSC public companies, a shorter notice. Shorter notice means what? I told you 3 days, at least 3 days before opening of the offer. And offer should be opened for at least 7 days. This 7 days, that 3 days can be reduced only with the consent of the members. And for that, how much consent I need? 90% of the members consent in writing or electronically. Next, length of the notice. Length of the notice means it's not A4, it's not A3. Length of the notice means Before offer period starts, how many days before I should give notice? Answer is 3 days. At least 3 days before issue opens. And how can I send that notice? Right now, if lawmaker writes a provision, he may write WhatsApp, Twitter, email, Gmail, etc. But who wrote this provision? Experienced person. For experienced person, what is the eligible, what is the applicable mode of applicable mode of notice? Registered post, speed post, electronic mode, courier, or any other method that provides a proof of delivery. Clear? For private companies, a shorter notice period, that is less than 3 days, is allowed if 90%. If 90%. That's what, if you look at my notes, handwritten notes, this 7 days, this 3 days can be reduced with the consent of 90% of the members in both private companies and IFSC public companies. Moving forward, board approval only. For rights issue to the existing members, board resolution is sufficient. Members approval is not sufficient. Why? There is no dilution of control. There is no dilution of control. Previously, company capital, for example, 1 lakh. I am holding 10,000. Company offered 10% as rights. That means total how many shares they are offering? 10,000 shares they are offering. For me, how many shares I will get? 1,000. So previously capital is 1 lakh. My holding is 10,000. That means 10%. Right now, my holding will go to 11,000. Capital of the company 1.1 lakh. That is also 10%. No dilution of control. Since dilution of control is not there, ordinary resolution is not required. Only board resolution is sufficient. Can I proceed? Next one. Exception 62 does not apply to the debentures as well as conversion of loans. 2 points I already told you. If a company has issued debentures as per issue conditions or loan as per loan terms converted into equity, it increases the subscribed capital of a company. However, 62 does not apply. For convertible debentures, for convertible preference shares, 62 shall not apply. But here, the conversion terms and conditions should be predefined and they are approved in general meeting through a special resolution. When? At the time of conversion, before issue? Come on, respond. When I need to pass special resolution in case of convertible debentures? At the time of issue of convertible debentures, or at the time of converting them into equity? Issue of convertible debentures. That's what they are telling. Special resolution before debenture is issued or loan is granted. Can I? Next, CG directed conversion. Look at the point. Debentures issued to the government, loans granted by the government. Entertainment. Government will take money from us. Government giving. Okay. No criticism. I'm sorry, government. Okay, fine. Either fully or partially into company shares. If government finds it necessary in the public interest on reasonable terms set by the government, even if original debentures original loan terms do not allow conversion, but still government will direct for conversion. That means at the time of issue they are NCDs. To whom we issued NCDs? To the government only. And we are not in a position to return. Now what we can do? We can convert them into equity. Government can convert them into equity. A remedy against forced conversion. If company disagrees with the conversion terms, it can appeal to the tribunal within 60 days of receiving the order. The tribunal will hear both the parties, that is company and government, and pass an appropriate order. Factors considered by the government, before government passes any order, what are the factors government considers? What is the position of the company? What are the terms of the debentures? What is the interest rate? And all other relevant factors. Considering these factors, central government will pass an order for converting debt into equity. Effect on authorized share capital. If the government orders conversion, company's authorized share capital automatically increases by the value of converted shares. The MO is altered accordingly. Exemption for Nidhi companies. I told you, section 62 does not apply to Nidhi company. However, they must protect shareholders' interest while using this exemption. Why I am telling you, for Nidhi company exemption, whenever I am going to outsiders, I need to take special resolution. But Nidhi company, new members may join for depositing their money, or members may exit when they repay loans. So both the times taking special resolution practically not workable in Nidhi companies. And moreover, members are not that knowledgeable persons. Why? All Nidhi companies are popular in rural areas. They know only one thing. To save money, they will deposit money into the Nidhi company. Two small concepts before I conclude for today. Two small concepts. One is bonus. Second one is communication with ROC. So up to here I'll discuss today. Remaining concepts tomorrow. Issue of bonus shares. Almost my energy also dropped. Let's see. Issue of bonus shares. First of all, tell me why company issue bonus shares. Why company issue bonus shares? More reserves. Fine. Dilution is not. Dilution will not happen here. Motivate the shareholders for what? Everyone will get, if 1:1 is the ratio, everyone get double shares. There will be no effect on voting rights. Not increased. Reliance Industries. Let's look into the financial statements of Reliance Industries. Corporate action. Yeah. Balance sheet. Just look at the balance sheet. What is the capital of the company? Crores common figure, crores common figure. We'll take only standalone financial statements. Why not? Why consolidated? Standalone. What is the capital of the company? Recent capital 6,766 crores. Clear? Visible? 6,766 crores. Reserves and surplus 5,08,000 crores. Okay, so total it would be 5,15,000. Imagine, round it off. 5,15,000 crores belongs to whom? Members. But if you observe, what is the fixed assets here? What is the amount of fixed assets involved here? 3,61,000 crores. Current assets 2,62,000. Other assets 3,35,000. So if you consolidate current assets and other assets, they are sufficient to discharge current liabilities and other liabilities. No issue at all. No issue at all. Now the point is, generally looking at this reserves and surplus, what public will do, what members will ask, sir, this much reserve is there, no sir, please distribute dividends, sir. But what company did actually? What company did? Company invested that reserves and surplus in the fixed assets. That means certain portion of profits are not available in current assets. They are invested in the fixed assets, which we can't distribute in the form of dividends. To distribute dividends, we need to sell these fixed assets. So that's why what company can do, here, company can capitalize certain portion of profits in the form of issuing bonus shares. So company will tell like this, okay, no problem. For every one share you are holding, I'll give you one extra share at free of cost. Suppose, share value is 1,000, right? By issuing another share, what happens? 2 shares equal to 1,000. That means one share becomes 500. Now market value of share comes to 500. This is not fall in the share price. This is adjustment in the share price. Previously one share equal to 1,000. Now 2 shares equal to 1,000. That means one share equal to 500. Now what happens, because of bonus issue, number of shares in market will go up. If number of shares go up, easy transferability, easy tradability will come. Suppose previously I am holding one share, I want 500 rupees money, I can get money only by selling one complete share, but I don't want to lose ownership. Now what can I do? After bonus issue, I can sell that one share, remaining with one share, I can be still member of the company. So in this way, transferability, marketability will be increased. Since price is coming down, many people will participate in that company shares. Clear? But the main objective of bonus shares is to capitalize reserves. Capitalizing the reserves. PB Fintech. This is the company yesterday I told you. Just look at the PE ratio. Just look at the PE ratio of this company. For getting 1 rupee return, you need to invest 4,162 rupees. So earning per share is 0.32 and present trading value of the share is 1331. So in long run, definitely this share will fall. To what extent it will fall, we too don't know, because in market gambling things will also happen. I'm not telling 100%, but chance is there. So suppose if you think that the share price will fall, suddenly this share price will go up. So market sentiments are entirely different. So still some people are holding these shares, means don't know with what reason, with what intention they are holding these shares, I don't know. But to the best of my knowledge, the perfect investment, if someone want to make investment into the shares, this is the perfect company. You have to invest and you have to keep that investment aside, because share price is 388 rupees, but this share every year it gives return of 62 rupees, 67 rupees. So for getting return of 1 rupee, it's sufficient if you invest 5 rupees. It's sufficient if you invest 5.75 rupees, you will get 1 rupee in return. So like this, these shares you should purchase and you should not sell it immediately. You should hold it for at least 1 year. So within 1 year, there is a chance that this share price will be doubled, because the sector PE is 12 times, whereas this company PE is 6 times. So to match sector, doubling the share price, PE will match to the industry. Doubling means 50,000, investment means 1 lakh. But right now, the share is continuously falling without any reason, You can look at here, 1 year, almost it reached 580 rupees and it started declining. Suppose if you look at the maximum starting, the share is 50 rupees only. That means investing 1 rupee, you will get 1 rupee return at the end of the year. Okay, fine. That's not our subject, but our subject is bonus issue. Bonus shares are issued to the existing shareholders as fully paid shares free of cost. Now my doubt is, company, it is making like this, it is making announcement like this, face value 10 rupee, bonus 8 rupee, just to pay 2 rupees. Bonus issue like this possible or not possible? Because this is like issue of shares at discount. Not possible. Bonus share should be fully paid up at free of cost. Another way of bonus issue also possible. That another way is, previously the paid up value is 8 rupee, face value is 10 rupee, unpaid value how much is there? 2 rupee, and you don't want to call this amount. In that case, you can close this amount by adjusting the reserves and surplus. So you will make the 2 rupees as a bonus element and you will convert paid up value to 10 rupees, converting partly paid up into fully paid up. Bonus shares are issued to the existing shareholders as fully paid up at free of cost. Sources. So for bonus, what sources I can utilize? I can utilize free reserves, securities premium, CRR. Free reserves, no obligation. Security premium, B square E. Buyback, bonus issue, expenses connected with issue. Next one, capital redemption reserve, only one purpose. That is what that one purpose is, bonus issue. Revaluation reserves, prohibited. In your balance sheet, if any revaluation reserve is there, it is prohibited for bonus issue. Revaluation reserve comes because of revaluing fixed assets. Procedural conditions. First condition, anything for company to do anything, first approval should come from AOA authorization. Next, members approval, ordinary resolution. You may get it out, sir. For rights issue, ordinary resolution not required. Why for bonus issue ordinary resolution required, sir? Because in bonus issue we are capitalizing reserves and surplus. Certain portion of reserves and surplus are transferred to share capital. So that's why we need to communicate with them. That's why we take simple majority. We consider only ordinary resolution. It's not special, ordinary. So board resolution for calling general meeting, in general meeting ordinary resolution is required. And at the time of announcement of bonus issue, these two defaults company shall not possess. Company shall not commit defaults with respect to interest on deposits, principal amount of deposits, interest on debentures, principal amount of debenture. Simply deposits debentures including interest thereon. Next one, statutory dues such as employee provident fund, gratuity, bonus. Employee statutory dues. So two defaults company should not possess. One is deposits, debentures, interest thereon. Second one is employee statutory dues. Partly paid up shares must be fully paid up before issuing bonus shares. That means company offering shares should be fully paid up, and to whom shares should be offered? To the persons who are holding fully paid up. That means, myself company, you are shareholders. You will get a bonus share which is completely fully paid up, and to get this share, first of all your share should be fully paid up. Getting my point? Issued shares should be fully paid up, and the persons receiving those shares should hold only fully paid up shares. In case of partly paid up, convert them into fully paid up by making a calls on shares. And bonus shares can't be issued in lieu of dividends. This is very, very hypothetical point. The meaning of this point is, this year I announced a 20% dividend. For example, board of directors announced a 20% dividend, and ordinary resolution has been passed against this dividend. Now instead of paying dividend in cash, can I give share at free of cost, sir? No. Dividends, it should be paid in cash. In the place of dividends, you can't issue bonus shares. That means bonus share should be in addition to the dividends. It should not be in the place of dividends. Capitalization of profits. According to section 123 subsection 5, a company may capitalize its profits or reserves to issue fully paid up bonus shares or pay unpaid amounts on the shares held by members. Okay. Last point. Unpaid amounts to, pay unpaid amounts means what? This point means converting partly paid up shares into fully paid up. Last point. Section 55, section 61, section 62. What is 55? Redemption of preference shares. 61, alteration of share capital. 62, in 62, government order to convert debt into equity. In all these three cases, that means in all these three events, within 30 days of happening this event, company has to communicate with the ROC in form SH7. That's it. Company has to communicate about these three events or any one of these three events in form using SH7 with ROC within how many days? 30 days. Alteration of share capital, company shall notify ROC. Notify ROC means shall file a notice with the ROC. Form number SH7, and in case of altered MOA, alteration to MOA, file altered MOA with ROC within how many days? 30 days. And the events are alteration of capital, government order resulting in increase in authorized capital, redemption of redeemable preference shares. And what would be the punishment for default? Company 500 per day up to 5 lakhs. Officer in default 500 per day up to 1 lakh. Clear? So with this I end today's session. So yesterday I started share capital and debentures chapter, section 43 to section 72. So first we'll look into these sections once again, and then I'll proceed with the pending concepts of this chapter. So in this chapter we are having total 30 sections, 43 to 72, divided into two parts, share capital, debentures. Both had a concept called nomination. Both had a concept of nomination, 72. Share capital 43 to 70, nomination 72, debentures 71. In share capital, three parts: basics, issue, transfer. Basics, kinds of share capital, nature, numbering. You'll find all these three in a share certificate. Holding share certificate, a person is entitled to few rights, that is voting rights. Sometimes the rights may be varied. Next one, he will also get obligations by holding this share certificate. What is that obligation? Calls on shares. Sometimes he may deposit a extra amount that we call it as calls in advance. And as per section 51, dividend, a company pays dividend only on paid up value if authorized by articles of association. Next one, issue. Company may issue shares at a premium. Company is prohibited from issuing shares at a discount. Exception, sweat equity shares. Company may also issue preference shares. Next one, transfer. Transfer and transmission of securities, but you have to remember transfer is at par. P stands for personation, 57, appeal, 58, R stands for rectification, 59. Next one, capital. Two parts, publication, alteration. publication 60, alteration 61. Alteration means either increase or reduce. How a company can increase its capital? By further issue. If that issue is for money, that means rights issue, section 62. Issue without money, bonus issue 63. Always company has to communicate matter with ROC 64. Now coming to reduction, reduction is of two types, reduction of liability, reduction of capital. Reduction of liability 65, not there in our syllabus. Next, reduction of capital 66 to 70. Reduction of capital 66, restrictions on purchase of its own securities 67, conditions for buyback 68, CRR 69, and prohibition on buyback 70. So this is all about chapter summary. Now in this I completed up to section 64. So up to 64, if you observe the important concepts, issue of equity shares with the differential rights. So what are the conditions a company should satisfy for issuing equity shares with the differential rights? AOA authorization, it should be authorized by AOA. Ordinary resolution is required for listed companies. Such resolution shall be passed through postal ballot. And company cannot issue equity shares with differential rights 100%. There is a limit. The limit is up to, the voting power from differential rights shall not exceed 74% of total voting power of the company, and company shall not commit following defaults. Those defaults are classified into two categories: subsisting defaults, time defaults. Companies shall not have these defaults at the time of issue of equity shares with the differential rights. So what are those defaults? Just remember four sources of finance. Equity, for equity, default will be declared dividend, non-payment of declared dividend. Next one, preference share capital, redemption is a default. Debentures, interest plus principal defaults. Deposits, interest plus principal defaults. Next one, time defaults, two categories, 3 years, 5 years. 3 years means last 3 financial years, company should not commit these defaults. 5 years means year of default is immaterial. Year of rectification we need. From the year of rectification onwards, 5 years ban. After 5 years from the end of year of rectification, they can proceed with issue of equity shares with the differential rights. So 3 years, the defaults are two types: non-monetary, monetary. Non-monetary means ROC filing, monetary means penalties under RB Act, SEBI, FEMA, SCRA. Next, 5 years defaults. Company shall not commit defaults in repayment of term loans, payment of interest on term loans. Next one, default in payment of preference dividend, employee statutory dues, IEPF transfers. Clear? Remaining points, disclosures in board report, notice plus explanatory statement disclosures. Next one, rights available to equity shareholders holding equity shares with the differential rights. So all these simply disclosures matters, but important condition, conversion is strictly prohibited. Conversion allowed or not allowed? That means ordinary share can't be converted into differential right, differential right can't be converted into ordinary share. Either surrender ordinary shares, get differential rights, or surrender differential rights, get ordinary shares. Clear? Next one, section 46. So sometimes these kind of points also very important. Section 43 is not applicable to two companies: IFSC public companies, private companies, provided MOA AOA specifies otherwise. That means if MOA AOA is silent, then 43 is applicable. If MOA AOA provides otherwise, then 43 is not applicable. Next, section 46. Here you have to remember, share certificate is valid only if it is issued under common seal. If company is not having common seal, then it should be signed by 2 directors or 1 director plus 1 company secretary. If common seal is there, fix it. If common seal is not there, then signature. That means whether common seal is there or not, signature by these people is compulsory. If common seal is there, affix common seal, that's it. Okay. Next one, time limit for issuing duplicate share certificates. Important point, time limit. In case of listed companies, time limit is 45 days. Unlisted companies just double, 90 days. That means 3 months. Maximum fees a company can charge for issuing duplicate share certificate is 50 per certificate. For this, board resolution is required. And disclosures, 2 disclosures are needed. One is on duplicate share certificate, other one is registers, and those registers shall be maintained along with a register of members. Clear everyone? Next one, in case of fraud, if a company issue duplicate share certificate with an intention to fraud exists, with an intention to defraud existing members, or with a fraudulent intention, then the punishment is per company 5 times of face value of shares involved in duplication, or maximum how much, 10 times of face value or 10 crores, whichever is higher. It's not lower, higher. Officer in default will get punishment under section 447. Next, voting rights. Here only point you need to remember is Nidhi company, because we had one MCQ. We had one MCQ. A member in Nidhi company can exercise maximum voting power of 5%. If he is holding 1% capital, 1% voting power. 3% capital, 3% voting power. 6% capital, 5% voting power. Next, 47 shall not apply to IFSC public companies or private companies, provided MOA AOA contains other provisions. Next, variation of shareholders. Important limit is we need to obtain consent from the members. What type of consent? If meeting possible, that means if postal ballot is not applicable, then special resolution. If postal ballot is applicable, at least 3/4 of the issued shares holders. Clear? But before getting consent, you have to check company constitutional documents. And before that, you have to check that company is having a share capital which is divided into different classes. Okay, so constitutional documents, you need to check MOA AOA. If MOA AOA is silent, then check the issue terms, whether prohibition is whether variation is prohibited or not. If not prohibited, then you can proceed with a variation. Important limit, dissenting shareholders. How many shareholders? It's not a number of shareholders. Dissenting shareholders, here the value is important. What is the value? 10% of class capital may file a petition with NCLT within 21 days of variation, and order of NCLT is final. File NCLT order with ROC within 30 days. That's it. Next one, sweat equity shares. Sweat equity shares conditions, special resolution, and this special resolution is valid for how many months? 12 months. That means within 12 months allotment should be completed. Next one, yes, for getting special resolution, yes, company has to issue notice calling for general meeting. Along with notice, explanatory statement is mandatory. In that explanatory statement, you need to provide details like current market price, names, details of the employees or directors, consideration if any company is receiving. Okay. Next one, listed companies, SEBI regulations, unlisted company, Companies Act is sufficient. And what type of shares company can issue? Existing class of shares. This point is missing in the material, so we need to incorporate this point. Next one, limit is very important, and one more point, sweat equity shares are offered to whom? Only permanent employee, not temporary. Next, director, whether whole time or not, but they should work either in our company or subsidiary company or holding company, either in India or outside India. So limit is very important. So what is the limit, ma? In a year, max 15% of existing capital or 5 crores, whichever is higher. Lifetime, 25% of the existing paid up equity share capital. But for startups, up to 10 years after incorporation, the limit is only one limit. The limit is 50%. Lock-in period, how many years? 3 years from date of allotment. Shares, sweat equity shareholders are not allowed to transfer their sweat equity shares. Next one, if company is receiving any depreciable asset, carry to balance sheet. No assets are, then record it as a expense. Record it as an expense. Charge to profit and loss account. Next, disclosures in board report, registers, all these are common. Who will record entries in the register? If company is having CS, CS. If no CS, then authorized person. Clear, everyone? Next, issue and redemption of preference shares. What is the maximum tenure a company can issue preference shares? 20 years. For infra companies, 30 years. Provided 10% redemption shall happen from 21st year onwards. Important condition you have to remember is no subsisting default. At the time of issue of preference shares, company has not committed any default. That means even if company has committed default, upon rectification, they can proceed with issue of preference shares. So with these subsisting defaults, they are prohibited from issuing preference shares. Next important conditions are, for redemption. For redemption, the shares shall be fully paid up. Now, redemption value includes premium. Now you have to separate nominal value and premium. Nominal value can be, you can use company profits for redemption of nominal value of the share. You can also utilize issue proceeds. But if you are utilizing company profits, you need to transfer nominal value of shares so redeemed to the CRR account. Clear? For premium, we are having two sources. What are those two sources? One is company profits, other one is securities premium. But securities premium is not allowed to section 133 companies. Clear? Everyone? Next, issue of further redeemable preference shares. Three conditions keep in your mind. Three conditions. One is approval of preference shareholders. How much approval? 3/4. Similar to yes sir, but don't write in exam yes sir. It's 3/4 of capital holders. Second one, NCLT approval. NCLT gives approval only when company redeems dissenting shareholders shares. And issued new shares will cover not only capital amount but also covers dividends that are in arrears or dues. Clear? Everyone? Next, transfer transmission. You have to remember time limits. The time limit is 60 days. 60 days is for what? Within 60 days of execution of transfer deed, either transferor or transferee shall submit documents to company for registration of transfer. But this is not applicable to transmission. This is not applicable to government securities. This is not applicable to demat securities. Clear? Instrument of transfer shall be dated, stamped and signed by both transferor and transferee. You will also find the particulars of transferee, that is address, occupation, name, etc., etc. Next one, what is the instrument of transfer? SH4. Along with SH4, what documents we should submit? Share certificate or letter of allotment. If not submitted within 60 days, then attach one indemnity bond. Next one, if it is lost in transit, then also attach a indemnity bond. Next one, company cannot register transfer of shares in one case. What is that one case? If shares involved in transfer are partly paid up and application is submitted by transferor alone. In this one case, company shall not register transfer unless it gets NOC from transferee. No objection from transferee. So for that, what is the time limit? 2 weeks. Transferee should give no objection. Transferee should give no objection to the company within 2 weeks. If transferee is silent, company assumes that he is willing, that means he is accepting the registration of transfer. Okay na? Everyone? Next, important conditions. Tell me, what is the time limit for issue of share certificate in case of subscribers to MOA? 2 months from incorporation. Allotment of shares, 2 months from allotment. Allotment of debentures, 6 months from allotment. Transfer transmission, 1 month, 1 month. Okay na? See, instrument of transfer, 60 days time limit, not applicable to transmission cases. In case of transmission, within reasonable time, a legal heir has to communicate with company. That means he has to provide information in writing. We call it as intimation request. You know, it's a letter of request or intimation in writing. That's it. Next one, for IFSC companies, for all events, what is the time limit? 60 days. 60 days of incorporation, 60 days of allotment, 60 days of transfer, 60 days of transmission. So these are the time limits. Who should remember these time limits? Company or members or transferees or company. This is the duty of company. This 2 months, 2 months, 1 month, 1 month, 6 months, 60 days, this is the duty of company to deliver certificates. Whereas this 60 days, this is the duty of transferor and transferee. Can I proceed? Next, penalty. You can see here 50,000 penalty. Next, forged transfer. Forged transfer, logic very simple. Just remember this concept. Nemo dat quad non habet. Nemo dat quad non habet. So original shareholder name shall be restored. What are all the benefits paid during this period? Yes, original shareholder is entitled to claim all those benefits. Company can recover all those losses from forged transferee. Innocent transferee can recover damages or can get compensation from company. If our time is too good, definitely question will come on this area. Ignoring all silly topics like DVRs, buyback, bonus issue. Clear? So, because you can see 2 attempts back, that is September, a question came on 49, 50, 51. Many students will ignore these points. They can write this answer only when they hear or when they listen to the class only. Okay, next, 58, 58, you remember 3 time limits, 30, 60, 90. Sorry, 30, 30, 60 for private company, 30, 60, 90 for public company. What is this first 30? It is the duty of company to serve refusal notice, to serve notice of refusal of registration of transfer. Yes or no? First 30 is the duty of company to serve notice of refusal. If a transfer is getting a notice of refusal in case of private company, within 30 days he has to appeal, he has to file appeal with NCLT. No notice of refusal, then 60 days. For public company, 60 days from the date of notice of refusal. No notice of refusal, sir, then 90 days from delivery of documents for registration of transfer. And one more point, if sufficient cause is shown, sir, I don't know about these provisions, or I'm occupied with some other works. That means, if transferee is able to satisfy NCLT, even though after these time periods also, he can file a petition with NCLT. Clear? Now what NCLT will do? NCLT can pass an order, either confirming the registration or dismissing the appeal. But company has to comply the NCLT order within how many days? 10 days. Contravention, the defaulting officer, I repeat, defaulting officer will get a punishment, that is imprisonment 1 to 3 years, fine 1 to 5 lakhs. So this punishment is to the company or defaulting officer? Obviously defaulting officer. How can you tell, sir? Imprisonment is not possible to the company. And it's not imprisonment or fine, it's imprisonment and fine. So contravention, the officer responsible to comply NCLT order and who violated NCLT order will get this punishment. Clear? Can I? Next, rectification. So here you need to remember 3 points. I'm the member of company, but my name was omitted. Or I'm not a member, but my name was included. Or company is making unnecessary delay in entering, in updating the register of members. In all these 3 cases, aggrieved party can file an application with NCLT. Sir, company can also file application with NCLT. Why, sir? Suppose if depository is making a mistake, my securities are in demat form, it is the responsibility of depository to maintain the records, and depository is making a delay, depository is making a mistake, then it's a loss of reputation to the company. So company can file an application against depository with NCLT. But outsiders, foreign members, don't worry, for you no need to come to India, no need to file application with NCLT. You can file application with any court outside India, that is competent court, that is a court declared by the central government, a court which was declared as a competent court by central government. Okay, next one, finally, yes, authority is having a power to pass an order, either dismissing the appeal or ordering the company to rectify the registers. Next one, further issue of shares. Tell me, what is the first priority? To whom we should offer shares? Existing members. If not, obtaining special resolution, go with employees, or obtaining special resolution, go with that means not covered in employees, not covered in existing members. So for others, special resolution and valuation report both are required, whereas for employees, SR is sufficient. And if it is a private company, no default in 92-137, and if it is a IFSC public company, OR is sufficient. Now if company is planning to, or company is making a rights issue, that means offer to the existing members, proportionate offer to the existing members, then what conditions company should satisfy? First, it should prepare a document called letter of offer. It shall be dispatched to the members at least 3 days before opening of subscription list. 3 days. And offer period, what is the minimum offer period? 7 days. Actually it is 15 days as per act, but as per rules 15 got reduced to 7. So minimum 7 days, maximum 30 days. But these 3 days, these 7 days can be reduced in 2 companies. Which 2 companies? Private company, IFSC public company, with the consent of 90% members. And renunciation available or not available? Available unless prohibited by AOA. Next one, this special resolution, when you are going with others, special resolution is needed, but this special resolution is not required in 2 cases. How many cases? two cases. One is convertible debt, convertible preference shares, convertible loans. Why? Because we already passed a special resolution at the time of issue. Second one is compulsory conversion. That means here government is passing an order to convert loans from government or to convert debentures issued to the government into equity. For that, government will consider certain parameters like public interest, financial position, rate of interest, issue terms and conditions. But if you are not convinced with the government order, you can file an appeal with NCLT within 60 days of government order, or else your share capital clause in MOA gets increased to the extent of capital mentioned in government order. Clear? Everyone? Bonus shares. Come on, answer me. Can a company issue bonus shares out of revaluation reserves? Possible or not possible? So for what are the sources available for bonus issue? Free reserves, securities premium, CRR. Can a company issue partly paid up bonus shares? No. Bonus shares should be fully paid up. However, partly paid up equity shares can be converted into fully paid up. So offered shares should be fully paid up, and the persons receiving shares, that person should also possess fully paid up shares at the time of bonus issue. The company has not committed defaults. What are those defaults? Interest deposits, debt securities. Interest on deposits, interest on debt securities, and then principal on debt securities. Employee statutory dues. Clear? Can a company issue bonus shares in lieu of dividend? No. Bonus can't be issued in the place of dividends. And authority approval, if you look at bonus shares, from whom we need to take approval? Members or board of directors? Members. Ordinary resolution is required. Everyone? Next. So in three cases, redemption of preference shares, government order to convert debt into equity, alteration of capital. In these three cases, it is the duty of company to communicate with ROC in form SH7. And what is the time limit? 30 days. Default 500 per day up to 5 lakhs for company, 500 per day up to 1 lakh for officer in default. That's it. Can I proceed? Next one, section 66, reduction of capital. Reduction of capital happens because of two reasons. Reason one, accumulated losses. Reason two, excess amounts left with the company. Now company wants to return those amounts to the shareholders. Will it amount to buybacks or no? In buyback, company will take shares from members. But here company will not take shares. Company will return certain portion of paid up value money to the members. Let's see. Just look at the balance sheet. Company C Limited balance sheet. Paid up share capital 8 lakhs. Outstanding liabilities 10 lakhs. Fixed assets, current assets, fixed assets 6 lakhs, current assets 6 lakhs, profit and loss account debit balance 6 lakhs, 18 lakhs. Next, same balance sheet, same company's balance sheet, paid up share capital 2 lakhs, outstanding liabilities 10 lakhs, fixed assets 6 lakhs, current assets 6 lakhs. So 12 lakhs. So if you observe carefully, in both the balance sheets, net effect is same. If you observe here, net worth available to the, net worth of the company is 2 lakhs. Here also net worth of the company is 2 lakhs. Sir, how you got 2 lakhs, sir? 8 lakhs minus accumulated losses. If you look at the balance sheet, certain portion of capital is not available in the form of assets. It was lost due to accumulated losses. I'm asking you, these two assets anyone can purchase, but anyone can purchase this asset, profit and loss account debit balance 6 lakhs, value is 6 lakhs, no. So by paying 6 rupees, this asset you can take, anyone can purchase that asset, no. That means that is an asset which has no value at all. So what I am doing, I'm just writing of this miscellaneous asset with a paid up share capital. So for an outsider looking this balance sheet, he gets a good impression. Looking at this balance sheet, he gets a wrong impression. Yes or no? Now, this is one way of reduction of capital. Here what I am doing, I am reducing my paid up share capital. Another way is, for example, paid up share capital 8 lakhs, outstanding liabilities 10 lakhs, fixed assets 10 lakhs, current assets 8 lakhs. So total how much? 18 lakhs. So in current assets my cash balance is for example 3 lakhs, and this is too heavy for me. I don't want 3 lakhs. Even 1 lakh is there, it's sufficient for carrying business operations. So 2 lakhs idle funds I am having. Then do one thing. So call equity shareholders and return 2 lakhs to them proportionately. Return 2 lakhs proportionately. Suppose 80,000 shares are there, face value how much? 10 rupee. So you return 2.5 rupee per share. You return 2.5 rupee per share. So 80,000 into 2.5, that means how much it is? 2 lakh rupees. So in this way you can return excess funds to the members. Sir, what is the need of returning funds, sir? I don't need these funds. Today member came to me, member invested 10 rupees in my company, because why? Because why he invested that money? Why he invested that money in my company? Why not in bank? In bank they're getting 6.5% rate of return, and they came to our company expecting 10% we pay to them. But for us this 2 lakhs is idle. On idle funds we won't get any returns at all. Even if we deposit this 2 lakhs with a banker, even if we make fixed deposit, we get how much? 6.5%. And what is the investor expectation? 10%. So why unnecessary? Return to them. Clear? So in two ways reduction of capital comes into the picture. One is cancellation of unrepresented capital. Second one is return of excess funds. Let's see. A company limited by shares, a company limited by guarantee with share capital. So it is talking about only two companies. It is not talking about unlimited companies. Only two companies, limited by shares, limited by guarantee with the share capital, may reduce its share capital through. So what is the first condition? Special resolution. In the following ways. First one, extinguish, reduce liability on the unpaid share capital. Suppose face value 10 rupee, paid up value 8 rupee. What is the member maximum liability? What is the member's maximum liability? Unpaid value, that is 2 rupees. Right now company is not in a position to use this 2 rupees. Company doesn't require this 2 rupees. Why unnecessarily making members to hold partly paid up shares? Let's convert them into fully paid up. How? Reduce face value to 8. Original paid up value 8. Now what is happening? 0 is the unpaid value. What happened? Extinguishing members liability. Suppose if I reduce face value to 9, paid up value 8, 9 minus 8 how much? 1. So here what is happening? 2 is getting reduced to 1. Everyone getting my point? So extinguishing, that means making members liability 0, or reducing, that means reducing members liability. So in both the cases what I am doing? I am cancelling uncalled capital. So this first point is talking about uncalled capital. Let me repeat, uncalled capital. In second point, cancelling paid up capital either if it is lost or unrepresented by available assets, or if it is excess capital, then the company may pay it off and amend its memorandum accordingly. Suppose in my previous example, I told you face value 10 rupee, paid up value also 10 rupee, but I don't want 2.5 rupee per share. So in this case what happens? Paid up value will be 7.5, face value will continue as 10. Now if you observe, 2.5 rupees members liability, 2.5 rupees is the members liability. But if I reduce this 10 also to 7.5, 7.5 minus 7.5, it becomes 0. Yes or no? Everyone? But when I'm playing games with face value, I should make one alteration to one clause in MOA. What is that clause? Capital clause. Why? In capital clause you will find how many figures? 3 figures. Capital figure, number of shares figure, face value figure. So if you are reducing face value, it is compulsory to amend a memorandum. Without reducing face value, you cannot reduce members liability. Remember the point. You cannot extinguish members liability. If you want to reduce members liability, it is possible only with reducing face value. Clear? So by these two conditions we need to satisfy. What are those two conditions? Special resolution. Second one, alter MOA. In how many ways I can reduce capital? 3 ways. What are those 3 ways? Cancelling uncalled capital. Second one, cancelling unrepresented capital or lost capital in the form of P&L debit balances. And third one is returning excess funds to the members. Okay. Now if you observe in this situation, there is one problem. The problem is, imagine company is having 1 lakh shares, 8 rupee is the paid up value. Face value how much? 10 rupee. Paid up value how much? 8 rupee. Now what is the paid up capital? 8 lakhs. Outstanding liabilities, for example, 10 lakhs. Fixed assets, current assets put together 8 lakhs. P&L debit balance 8 lakhs. Sorry, 10 lakhs. Now total 18 lakhs. So if this company, imagine if this company went into liquidation, what will happen? Total available assets 8 lakhs. And what is the outstanding liability? 10 lakhs. So the difference 2 lakhs. Who should contribute 2 lakhs? Members. Yes or no? Members should contribute towards a deficit in the event of liquidation. So if you observe carefully, here unpaid value is there. How much it is? 2 rupee. 1 lakh shares into 2 rupees means 2 lakhs. So members should definitely contribute how much? This 2 lakhs for repayment to the outstanding creditors. But members, a day before going into liquidation, imagine they are trying to reduce face value from 10 to 8. Already paid up value how much? 8. 8 minus 8 how much? 0. So in this way they will escape from their liability. But is it allowed or not allowed? It should not be allowed, because if you do that, who gets affected? Creditors get affected. Who are creditors? Can they participate in day-to-day affairs of the management of the company? No. Can they participate in voting rights of the company? No. So they are simply outsiders. So giving loans to the company, again they are not entitled to participate in general meetings. They are not entitled to vote at general meetings. So if members are allowed to do such kind of things, definitely outstanding creditors will be at risk. Yes or no? So to protect them, first we need to check whether reduction is fair and transparent or not. So whether reduction is fair or not, for that an independent authority approval is required. Here independent authority is NCLT. Clear? So NCLT will give approval. Definitely for that what we have to do? We have to file a application. NCLT will not make any meditation, right? Company C Limited wants reduction, it seems. Come on, print the paper, give approval to the give approval to the company C Limited. Like that, company will not make such, NCLT will not make such things. So NCLT will give approval only when a company files application with a tribunal. Exceptions: buyback of shares, redemption of preference shares are considered as reduction of capital but doesn't require NCLT approval. The reason is, in case of redemption of preference shares, I create CRR. So reduction of capital will be eliminated. In buyback also I create a CRR. I will utilize CRR for issuing fully paid up bonus shares. Then tell me how reduction of capital effect comes into the picture. But here what I am doing, I am not playing games with reserves and surplus. I am playing games with reduction of, I am playing games with capital. And if you observe carefully, the difference between 61 and 66, in 61 I will play games with unissued shares. Yes or no? Diminution of the capital, decrease of the capital, I will reduce only the shares which I didn't offer to the public, I didn't offer to the members. But here I am playing games with subscribed shares. Everyone? So that's why decrease in share capital under section 61 doesn't require NCLT approval, whereas reduction of capital under section 66 requires NCLT approval. Clear? Everyone? Fine. Alteration of MOA, company must also update its memorandum. Yes, face value is getting reduced. That's why alteration of memorandum compulsory to reflect reduced share capital. Note, diminution means reducing unsubscribed or unissued authorized capital, which is different from capital reduction. So simply this is a difference between 61 and 66. Prohibition on capital reduction. If company has defaulted in repayment of deposits, in payment of interest on deposits, then company is prohibited from reduction of capital. Okay na? Bonus issue, deposits, debt instruments, employee statutory dues, and then deposits, sorry, bonus issue. In bonus issue, yes, that only. Deposits, debt securities, interest thereon. And next one, employee statutory dues. Any default prohibits company from issuing bonus shares. But under reduction of capital, only one default. What is that one default? Deposits, interest on deposits. Next one, once tribunal receives application, what tribunal will do? Tribunal will immediately give notice to few parties: CG, ROC, SEBI if listed company, creditors of the company, to check whether reduction is fair. It is not harmful to the creditors. It is not creating any harm to the creditors. If any of these parties raise objections within 3 months of notice by NCLT, then tribunal will consider them. If no objections are received within 3 months, it is assumed that there are no objections to the reduction of capital. Next, tribunal may approve reduction of share capital if it is satisfied that all creditor claims are discharged. So there is no harm on creditors. Creditors are safe. That means discharged or settled. Sir, that much liquidity we are not having, sir. At least provide some asset as a security. That means create a charge in favor of creditors. Finally, you have to obtain consent from them. And approval will be subject to the conditions as deemed fit by the tribunal. Tribunal may also impose additional conditions. Only upon satisfaction of additional conditions, tribunal will give permission. And one more important condition is auditor certificate. See, reduction of capital is all about internal accounting adjustment. If you observe internal reconstruction. In internal reconstruction, we pass some entries, writing of all miscellaneous assets, goodwill, yes or no, whether all these entries are recorded as per applicable accounting standard or not. So NCLT verifies that, but NCLT will not look into the books of accounts. NCLT expect a certificate from company auditor. Company auditor have to verify, company auditor has to verify, and company auditor has to issue a certificate stating that, sir, accounting treatment is complying with accounting standards. Then a certificate from company auditor confirming compliance must be filed with the tribunal. So then only tribunal will sanction, that means approve capital reduction. Can I? Next, publication of NCLT order. Publication means e-advertisement. Why? Who knows? Who knows? You might have concealed some creditors. Actually, in your books, total 200 creditors are there. And to NCLT, you gave a list of only some 50 creditors. Everyone getting my point? If you observe carefully, tribunal will notify the parties about application. To whom tribunal will notify? CG, ROC, SEBI, company creditors. How many creditors are there in company? How NCLT comes to know that matter? Only when company submits the list of creditors to NCLT only. Yes or no? Yes. Now the point is, through publication, the creditors whose names are not included in the list, they will come up and they will question NCLT. Sir, without our permission, company went for a reduction of capital, sir. Now what NCLT does? What NCLT will do? What will NCLT do? Very simple. It will lift the reduction of capital order. It will lift the reduction of capital order. Simply, when a company lifts corporate will, the real persons behind will gets punishment. Here also, once NCLT order is lifted, what happens? The original liability of members shall continue. Everyone, suppose in this situation, in this situation only, if you observe in this situation only, suppose instead of 10 lakhs, company submitted creditor claims only for 8 lakhs. And company is telling that existing assets are sufficient for discharging existing creditors, sir. Now through publication, what happens? Creditors worth 2 lakhs, they will come to know through the advertisement, and they will question company. They will question company as well as NCLT. Now what NCLT will do? Simply they will lift this reduction of the capital order. That means members liability. Previously, what is the members liability? 10 minus 8, 2 rupees. The 2 rupees per share will come into the picture. Is it clear? So company must publish tribunal order in a manner directed by tribunal, that is newspapers, two newspapers, English and vernacular, as well as company's website. Every time and any time, publication means two newspapers will definitely come. One is local newspaper having wide circulation, other one is English newspaper having wide circulation. This allows for representations and objections from the affected parties such as creditors, which will be forwarded to the NCLT. Next, once company get a order from NCLT, company must submit, that means company must file a certified copy of NCLT order and an approved minutes. Minute means what? Minutes of the general meeting. Approved minutes to the ROC within how many days? Within 30 days. 30 days of what? 30 days of certified copy of a tribunal, receipt of tribunal order. Getting my point? So company must submit certified copy of tribunal order within 30 days. Along with certified copy of tribunal order, approved minutes shall also be filed with ROC. And that minutes must specify total share capital after reduction, number of shares and their division, value of each share, paid up amount per share. Suppose in one instance I told you, 10 lakhs is my capital. Sorry, 8 lakhs is my capital and I don't want 2 lakhs. So 8 lakhs minus 2 lakhs, what is the net effect? 6 lakhs. Previously 80,000 shares, and what is the face value? 10 rupee. Paid up value also 10 rupee. After returning 2.5 rupee per share, now face value, paid up value will fall to 7.5 rupee. That means the division, number of shares, face value, paid up value, everything, that minutes shall contain that information. That minutes shall contain that information. No liability, next one, ROC will register the reduction and issue a certificate confirming the change. No liability on member. Past and present members shall not be liable for any additional payments on their shares. Additional payments. That means what? Over and above the face value, they are not at all liable. They are only liable for the difference between amount paid on the share or reduced amount deemed to be paid as per tribunal order. That means face value minus actual paid up value or NCLT ordered reduced face value, reduced paid up value, reduced face value or reduced paid up value, whatever it may be. See here, the original face value, original paid up value. Next one, revised face value minus revised paid up value. So that is the maximum amount they are liable for. Beyond that, present members, past members are not liable. Next, creditor's right to object, failure to object. If a creditor who had the right to object to the capital reduction did not object due to ignorance. Ignorance means what? Company didn't provide the details of creditors in the list which was filed with NCLT or was omitted from the creditors list simply. And the company defaults under section 6 of the IBC 2016. Company failed to repay or failed to pay money to the creditors. Then if company still exists, that means if company is still carrying business operations, every person who was a member of company at the time of registration of the tribunal order shall be liable to contribute towards that debt or claim. So what is the meaning of this point? What is the meaning of this point? NCLT confirms the reduction, right? NCLT by passing an order, it confirms the reduction of capital. Reduction of capital. Immediately company has to communicate the same with whom? ROC. As on communication date, who are the members? Identify those members and make them to contribute balance amount. That means, if capital reduction doesn't happen, if capital reduction didn't happen, what would be the liability of members who are members at that point of time? At which point of time? At which point of time? At the time of filing NCLT order with ROC. Are you getting my point? That means we are not making present members liable for past debts. We are making only past members. Contribution shall not exceed the amount that would have been liable if the company has been wound up immediately before the order date. That means instead of approving the capital reduction, let's imagine company got liquidated. What would be the maximum liability of the members? That means simply before reduction, what is the liability of members? Sir, face value 10 rupee, paid up value 8 rupee, and unpaid value is 2. That is the maximum liability. If deficit is 1 rupee, then pay 1 rupee. If deficit is 2 rupees, then pay 2 rupees. If deficit is 3 rupees, then also pay 2 rupees only. If company is wound up If company is wound up, a creditor can apply to the tribunal to be included in the list of contributories. The tribunal may settle the list of contributories, issue calls and enforce payments from them as in a normal winding up process. So simply, even though company got liquidated, so we will get that information. Which information? Persons who are members at the time of reduction of capital, and will make them liable by issuing, that means by making calls on shares, enforcing payments on those calls, and we collect the money and we pay that money to the, that means NCLT pay money to the creditor. Clear everyone? Liability of the officers. First of all, who is responsible for that mistake? Definitely officer. So that officer will get punishment under section 447. But here mistake means what? Let's see. Concealment of the creditor. Concealment means hiding. Suppose 200 creditors we are having, but we are displaying how many creditors? 50 creditors. Misrepresent the nature or amount of a creditor claim or a claim. Suppose that creditor is an actual creditor, but we are showing him as a contingent creditor. Sir, that liability is not actual liability, sir. That liability is a contingent liability. Or that creditor is a secured creditor, but that creditor is an unsecured creditor, but we are displaying him as a secured creditor. Let me repeat. He is actual creditor, but we are showing him as a contingent creditor. He is unsecured creditor, but we are showing him as a secured creditor. So misrepresent the nature or amount. Suppose 60 lakhs I am liable to the creditor, but I am showing as only 6 lakhs. So misrepresent either nature, misrepresent either amount. Last one is important. Aware of, abet such concealment or misrepresentation. This fellow is very silent fellow. Why silent fellow? He is not doing mistake, but when mistake is happening, he remained silent. He is remaining silent. So he is not making a statement. You can't do such things like that. He is not objecting the fraud. He is allowing the people to do the fraud. Now people doing the fraud plus people who are silent at the time of happening of fraud, both will get punishment. What punishment? 447. Here people means who? Authorized representative. Officers. Here people means officer. Can I proceed? Next, overriding provision. I told you section 68 has overriding effect over 66. Not only 68 but also 55. In both 55, 68, what is happening? Reduction of capital is happening. But still reduction of capital provisions will not apply. The reason is certain portion of profits are getting transferred to CRR. Can I? So with this, reduction of capital completed. In one attempt, reduction of capital was asked for 5 marks. Conditions for reduction of capital, maybe May attempt or I think November attempt. Next, restrictions on purchase of its own shares. Restrictions on purchase of its own shares. This is also similar to reduction of capital only. How? Let me tell you. In section 67, what happens? Same balance sheet, paid up share capital, for example 8 lakhs. Outstanding liabilities 10 lakhs. Fixed assets plus current assets put together 8 lakhs. Profit and loss account debit balance 10 lakhs. So total 18 lakhs. Now if you observe, who should bear this loss of 10 lakhs? Obviously members. If company goes into liquidation, definitely this loss who should bear? Members only should bear. A day before liquidation, imagine, or a month before liquidation, members are entering into an agreement with company C Limited. Members of C Limited entering into an agreement with C Limited. As you all know, separate legal entity, company is separated from its members. Yes or no? Now they are entering into an agreement. As per the agreement, members will surrender shares. Company take these share certificates, and company pay us just 8 lakhs only. Don't pay us more than that. Pay us only 8 lakhs. Now after this entry, after this payment, what would be the balance sheet of the company? C Limited. Paid up share capital same 8 lakhs. Outstanding liabilities 10 lakhs. Fixed assets, current assets, in that place, you will see investment in C Limited. Investment in C Limited 8 lakhs. P&L debit balance 10 lakhs. Balance sheet tallied. Yes or no? But I'm asking you, from where outside liabilities can be cleared? Where? From where? By selling these shares. Who purchased these shares? Already company is in loss, right? That means who is at risk? Creditors are said to be at risk. Creditors are said to be at risk. So if I allow this kind of purchases, what happens? If I allow this kind of purchase, what happens? Outsiders will be at risk. That's why there is a prohibition. The prohibition is company is prohibited from purchasing its own shares. Sir, buyback is there? No, sir. In buyback, company will purchase not with an intention to disclose as a investment, but with an intention to cancel them. And buyback, there is a restriction. Max to max every year, company can't buy its own shares exceeding 25% of the paid up equity share capital. Clear? So now tell me, a company limited by shares, company limited by guarantee with the share capital can buy its own shares or cannot buy its own shares? Cannot buy own shares unless a reduction of share capital is done as per the provisions of this act. That means section 68 here. Exceptions. Following companies are allowed to buy their own shares. So what are those companies? Private companies, IFSC public companies, Nidhi companies. But here we need to check that private companies in which there is no interest of others, there is no interest of, there is no effect on interest of outsiders also. You may get a doubt, sir, in a private company why public will come, sir? In private company public will not come, but if you observe, creditors are from public only, bankers are from public only. So that's why we need to check that no person interest is getting affected. For that we will ensure that no other corporate body, that means body corporate, has invested in the share capital of this private company. Let me repeat the point. In this private company balance sheet, you will find paid up share capital, right? For example, 8 lakhs. In this 8 lakhs, no body corporate should subscribe one share. Body corporate should not be a member in our private company. I'm not telling that this should not be a subsidiary. This should not be associate. I'm not telling that. For associate, what is the relationship? What is the percentage of relationship? 20%. For subsidiary, more than 50%. Here I am telling not even a single share. Not even a single share. In associate, you'll find 20. In subsidiary, you'll find more than 50. Everyone getting my point? If I tell like this, no other body corporate should be a holding or associate to this company. That means body corporate holding is allowed. It is restricted up to 19.99% like that. But here the point is very clear. Other body corporate should not invest in our private limited company. No body corporate, that means they should not invest in our company. Second thing, borrowings from banks, financial institutions put together, they should be less than twice of its paid up share capital or 50 crores, whichever is lower. Here one more point, it is not less than or equal to, it is less than. Less than two limits. What are those two limits? 2 times of paid up share capital or 50 crores, whichever is less. And there is no default in repayment of borrowings at the time of purchase. Suppose if my paid up share capital is 1 lakh, borrowing should not exceed how much? Borrowing should not exceed, that means, borrowing should be less than twice of paid up share capital. Less than twice of paid up share capital means less than 2 lakhs. If bank's borrowings is less than 2 lakhs, tell me, because of this purchase, will it have an adverse impact on the banks or no? 2 lakhs is a small amount. And moreover, you check this point, company is not at all defaulting. Company is not at all defaulting in repayment of these borrowings at the time of purchase of its shares. Next one, Nidhi company. As you all know, in Nidhi company, the main objective is giving loans, accepting deposits. You want loan, that's why you came to me. You subscribed share. I'm giving you loan. Once loan is repaid, you are surrendering shares to me. I'm returning money to you. So here there is no restriction on purchase of its own shares. Prohibition on indirect purchase of own shares. Prohibition on indirect purchase of own shares. Direct purchase means, company taking shares from you. Indirect purchase means what? Company will finance someone to take shares from you. Direct means company will take. Indirect means company will provide financial assistance to some third party and the third party will purchase shares from you. So direct, indirect not allowed. But if you observe carefully, in direct purchase the word company is used, whereas in indirect purchase the word public company is used. So here I am talking about which company? Only public company. Private company is already exempted, that's it. No public company, sorry, a public company cannot provide any financial assistance, example loan, guarantee, security to anyone for purchasing its own shares or shares in its holding company. So here, the restriction is not only, it's not only, it's self applicable, it is also applicable to holding company. So that means, I can't finance you to purchase my shares, I can't finance you to purchase my holding company shares. But there are three exceptions. One is lending business. Suppose myself SBI, you came to me, you took a personal loan of 10 lakhs. So you applied for loan, you are eligible, that's why I'm giving loan. So with that fund, whatever you want to do, you do. You want to throw that money in Bay of Bengal, you throw it. You want to purchase my company shares, you purchase it. It's none of my business, because in SBI total 40 crore account holders are there. Imagine 4 crore people borrowed funds from SBI. Is it possible for a bank to check each and every person what they are doing with the borrowed funds? Not at all possible. That's why here you have to check whether lending happens in the ordinary course of business or not. Suppose you are eligible for 20 lakhs, but I am giving you loan of 20 crores. How comes? 20 lakhs eligibility, but I am giving 20 crores means what? We entered into a private arrangement. According to that arrangement, you purchase my company shares. You purchase my company shares. In market, you created demand for 20 crores worth of shares. When demand goes up, supply constant, automatically what happens? Share will go up. Price of the share will go up. At increased price, you sell shares and give that money to me. It is nothing but artificial inflation. Yes or no? It's not a natural increase. It is a artificial increase. If I do like that, definitely who gets affected? Shareholders, investors gets affected. Don't do that things. So lending should be an ordinary course of business. If money is given solely for purchasing the bank shares, this is not considered as lending in the ordinary course of business. That means in application, person clearly mentioned, I want to purchase SBI shares, that's why I'm taking loan. Don't process that application. Next, employee share purchase scheme. My company employee wants to become member of the company, but for that he is not having sufficient funds. His salary, he can save only 5,000 per month. With that 5,000, he can purchase, for example, he can purchase only some 10 shares, but he want to purchase some 100 shares of the company. So at present, he is not having sufficient funds. Then do one thing, you finance your employee. I'm talking about which company? Public company only. You finance your employee. It's a good intention only. It is a good intention only. You just finance your employee. But here, employee, so okay, I'm here so I'm talking about this point. I'm talking about employee loan. Here employee excludes two persons. Who are they? Directors, KMP. They are sound people only. Director, KMP means sound people only. They can purchase company shares. Why? Again, financial assistance. So employees exclude directors, KMP. And that loan amount does not exceed employee's salary or wages. How many months salary or wages? 6 months employee salary or wages. Just look at the point, you have to read these 2 points combined. Loan amount does not exceed 6 months employee salary or wages. Loan is for a period of 6 months. Loan is for a period of 6 months means maximum 6 months salary you can provide as a financial assistance. Clarification point. Here, the loan is not for a period of 6 months. Loan is up to 6 months salary or wages. Second one, loan is to enable purchase of fully paid up shares. So with this amount, imagine with this amount employee subscribed partly paid up shares. Now will it come under exception or no? It comes under main rule violation, then punishment. Next one, employee share purchase scheme. Here what happens? Company can lend money through a special resolution for the purchase of shares for its employees or trustees holding shares for their benefit. So here finance will be done to whom? Finance will be done to the trustee. Why he is taking that loan? He is taking that loan to purchase company shares for the benefit of employees. Purchase of shares must be through a recognized stock exchange for listed company. That means it's not a private arrangement. If you want, you can purchase only from stock exchanges in case of listed company. In case of unlisted company, valuation must be done by a registered valuer. Why? Because in both the cases, if you observe, the price is independent price. Stock market price is definitely, it depends on market demand and supply forces. So price is an independent factor there. In case of unlisted company, shares will definitely will not trade on the stock exchanges. That's why here what we do? Valuation from registered valuer. We obtain registered valuer, we obtain valuation report from registered valuer. So here also the price will be an independent factor only. So no one will be affected. Next, the purchase or subscription value cannot exceed 5% of company's paid up capital and free reserves. There is a limit. There is a limit on the shares to be subscribed or shares to be purchased by the trustee of the scheme. What is the limit? 5% of paid up share capital plus free reserves. And company must disclose the details about the voting rights, including names of employees who did not exercise voting rights directly and the reasons. If you observe carefully here, who is holding shares? Trustee is holding shares. Employee is just a beneficiary. Now in the eyes of law or in the legal perception, holder of the shares is trustee. So trustee will exercise voting rights but not employee. Reason? Employee is a beneficiary. Employee is having beneficial rights, but trustee is having a legal rights. That's why employee cannot exercise voting rights. Clear? So one modification here important. The modification is loan amount shall not exceed 6 months and 6 months salary. 6 months salary. So even this also, the interpretation we have to take like this. Loan amount does not exceed employee salary wages and it should be paid within a period of 6 months means 6 months salary only maximum. That loan amount should match with 6 months salary. But I'll give you a clarification on this point. Clarification means what? I'll release a separate paper with respect to clarifications, like I told you, right? In sweat equity shares, one condition got missed. What is that condition? Existing class of shares condition got missed. Second one, premium on redemption of preference shares. There I'll provide another clarification. Third one, here I'll give one more clarification. So I'll release only one paper at the end of the batch. Next one, right to redemption. Of course, redeem preference shares right is not affected by this section. In case of redemption of preference shares, what happens? Company pay money to preference shareholders, company takes shares. But if you look at the general rule, what is the general rule? A public company cannot provide any financial assistance. What is the general rule? A company limited by shares cannot buy its own shares. But redemption is different. So simply, in case of conflict between two or more provisions, special overrides general. This is a general section. Company is prohibited from purchasing its own shares. Whereas redemption of preference shares, it is a specific section for preference shares. So always special rule overrides a general rule. Clear? Everyone. So in case of violation, company fine how much? 1 lakh to 25 lakhs. Officer in default up to 3 years imprisonment and fine 1 lakh to 25 lakhs. Fine between 1 lakh and 25 lakhs. That means up 1 lakh to 25 lakhs. Can I proceed? Buyback. Last but one concept. Buyback. Last but one concept. So here we are having two concepts. Buyback, debentures. Let's have 5 minutes break and then I'll proceed with buyback and debentures. So let's continue our discussion with next concept, that is buyback of shares. Section 68. First, why company will make buyback of shares? Reason behind buyback. Reputation. Okay, one reason, but not perfect reason. Next. Correct. For example, Reliance Industries Limited. Imagine 48% of paid up share capital is with promoters. 52% capital is with the public. So now with the capital held by promoters, they can't even influence ordinary resolution. Suppose we need ordinary resolution. Even 48% are in favor and 52% of public, if they are against, ordinary resolution is said to be dropped. So control already got diluted. Now to get back this control, company may announce buyback. So what company will do? Simply, here company will take some, imagine some 10 shares company will take. Now what is the result? Promoters holding 48 shares, public holding 42 shares. Total number of shares 90. In this, promoters got more than 50%. This is one way. A second way, suppose I am having idle funds. If I decide to return per share certain portion of money, it comes under reduction of capital 66. But here what I will do? I will return a complete amount of a share to the persons who are interested in this buyback. So I am having idle funds. Because of these idle funds, there will be no effect on company value at all. First of all, company value, it will not get affected. For example, you all know the formula for PE ratio, price earning ratio. Price earning ratio multiply by EPS, we get market value per share. Market value per share is equal to earning per share into PE ratio. Imagine PE ratio is 10 times 10. And EPS, the formula for EPS is net profit available to equity shareholders divided by number of equity shares. Correct? Now, actually I am having, for example, 1000 crores money. In this 1000 crores, I will utilize only 800 crores for carrying business operations. That means 200 crores funds are idle. So even if I return this 200 crores, my business operations will not get affected. Yes or no? Yes. That means the same net profit I will earn the next year even if I return this 200 crores money. 200 crores means nothing but imagine 20%. For example, company is having a 10 lakh shares. Returning 20% money to the members means 10 lakh minus 2 lakhs. That means what is the net result? 8 lakhs. So number of equity shares, previously it is 10 lakhs. Now it is getting reduced to 8 lakhs. EPS there will be no change. Why? I am returning the funds which are not required for me. With these funds I will not do business operations because for my business operations 800 crores is sufficient. So previously the net profit, imagine it is 1 crore. Now also imagine it is 1 crore. A denominator, number of equity shares fall, you can observe 10 lakhs previously before buyback. After buyback falling to 8 lakhs, you can observe it. But why sir, numerator there is no change? The reason is previously I earned this net profit using 800 crores. Future also I will earn 1 crore using this 800 crores. So if you observe EPS, previously EPS is 10 rupee. Right now EPS is 12.5. So previously, that means before buyback, 10 PE ratio, 10 into 10, 100 is the market value of the share. Whereas now PE ratio, same PE ratio into 12.5 is the EPS. Industry PE ratio 10 only. 10 into 12.5 EPS, share value go to 125. First of all, I am getting my money. That means suppose I am holding 10 shares. Imagine I am holding 10 shares. Previously, what is the market value? 100 rupees. 10 into 100 means 1000. Now I am getting 200 rupees return. And again my investment value is 1000 only. How sir? After 2 shares got buyback, I will be left with 8 shares. 8 shares into current market price will be 125. Why? 12.5 is my EPS. 12.5 into P ratio 10, that means 125. So there will be no change in market value of the shares held by me. Without change in market value, I am still getting 200 rupees in return. So simply because of buyback, what happens, EPS will go up. Earning per share will go up. That means return on equity gets improved. Sir, why previously it was not improved? Because I am having, sir, I am having idle funds. By returning these funds, my return on equity will be improved. My EPS will be improved. Because of this, new buyers will come to the market to purchase my shares. If demand exceeds supply, automatically price of share will go up. This is the logic. Every time TCS makes buyback. TCS makes buyback, previously, before COVID, I think every 2 years TCS used to make buyback. Every 2 years TCS is used to offer bonus shares. Okay, fine. So these are the reasons for buyback. Okay. Now for making buyback, we have to satisfy certain conditions. What are those conditions? Let's see. First one is sources. From what sources I can make buyback, sir? You can utilize two sources. Two. One is internal funds. One is internal funds that are available in the form of free reserves, securities premium. Second one is external funds, that is not available internally, but these funds I will get by issuing shares. But the point is, you cannot use proceeds from the earlier issue of same kind of shares. That means company is having ordinary shares, company is having differential rates. For buyback of differential rates, company can utilize ordinary shares. Company can issue ordinary shares. Proceeds of ordinary shares can be utilized for buyback of differential rates, or vice versa also possible. But for buyback of differential rates, issue of differential rates is not at all possible. It is like offer for sale of securities only. In offer for sale of securities, what happens generally? Company takes shares from the existing members and company will offer same shares to the public at a large. Yes or no? So that's why different class of shares should be involved. And next one, here specified securities means what? They are also equity shares, but those equity shares are given to the employees under either ESOP or under sweat equity. Clear? So buyback is possible for all equity shares including specified securities. What are the sources? Internal source or external source. But if company decides internal source, then they should create one reserve called CRR. Next, conditions for buyback. Compulsory. One condition compulsory. What is that condition? Company should be authorized by its AOA. Next one, special resolution. And here we need to make one small modification. This is not equity share capital, this is paid up share capital. Another modification required, another modification in the material, that is paid up share capital. To understand this, let me show you buyback percentages. Buyback percentages. Look at the point carefully. Look at this point. If amount involved in the buyback, amount to be invested in the buyback is less than or equal to 10% of paid up equity share capital plus free reserves plus securities premium, then board resolution is sufficient. Am I talking about number of shares or am I talking about investment in buyback? Investment in buyback. See, 10 years back at 10 rupees you subscribed one share. Now if I return 10 rupees, can you give one share? No. Why? Sir, 10 years company did business operations. No sir. Certain portion of profits are available in reserves. No sir. So buyback price should be greater than 10. Suppose buyback price is 30 rupees. Imagine buyback price is 30 rupees. So here I am talking about the 30 rupees. I am not talking about 10 rupees. Amount to be invested in buyback. In buyback, imagine I am getting 1 crore shares. Company is getting 1 crore shares. Face value 10 rupees. So total 10 crores face value shares I am getting. But if you observe what is the buyback price? 30. How much outflow is there for company? 1 crore shares into 30. That is how much? 30 crores. Once again I am repeating here resolution is talking about 30 crores. It's not 10 crores. So amount required for buyback, if it is up to 10% of paid up equity share capital plus free reserves plus securities premium, then board resolution is sufficient. Exceeding these limits, special resolution. But with a special resolution also, you cannot make buyback of 100%. Buyback is restricted to 25% of paid up share capital plus free reserves plus securities premium. What is the difference between these both, sir? Preference share capital is the difference to this both. Theoretically, but logically there is no difference at all. First of all, logically there is no difference. Theoretically the difference is equity share capital plus preference share capital is equal to paid up share capital. That's what at the time of drafting this material, for me both look similar, but when we are going theoretically as per the material, it should not be paid up equity share capital, it should be paid up share capital. I'm telling you, interpretation of statute, one chapter is there, right? What is the main objective of interpretation of statutes? To clear a gap between law reader and lawmaker. The gap that arises between law reader and lawmaker. Lawmaker with one intention, he will draft a law. But at the time of reading law, a different intention may appear. Now the different intention, we should cut it off, we should apply original intention. So actually original intention, logically there is no difference between paid up equity share capital, paid up share capital. But differences arises only when there is a preference share capital. But if I speak logically, with the preference share capital, keeping preference share capital ideally, if I want to make buyback of securities, why they listen to me? Again, I should take their approval also. So why they give approval to me? Sir, keeping us silent, you are redeeming them, you are buying back equity shares, we won't accept. So practicality is different, book is different. As per books, okay. So if you look at the points, up to 10% of paid up equity share capital plus pre-reserves plus securities premium, it's a board resolution. Exceeding these amounts but limiting to 25% of paid up share capital plus pre-reserves plus securities premium, special resolution is needed. Next, number of shares to be bought back in a year shall not exceed 25% of paid up equity share capital. And here I am talking about number of shares. Here I am talking about number of shares. Here I am talking about amount to be invested in the buyback. Clear? Everyone? Suppose in company 1 crore shares are there. Now how many shares I can make buyback in a single year? 25%. That means 225 lakhs only I can make buyback. Multiply buyback price, for example 30 is the buyback price. This amount should be less than or equal to 25% of paid up share capital plus pre-reserves plus securities premium, then special resolution. If it is less than or equal to 10%, board resolution is sufficient. But once again I am telling you, observe the difference. Here I am using the word equity, here I am using the word paid up share capital. Again here I am using the word paid up equity share capital. One is talking about shares, one is talking about amount to be invested in buyback. And post issue, post buyback, debt equity ratio should be 2:1. So here also debt to equity post buyback, the ratio of debt to, here also I need to make a small change, that is paid up share capital plus free reserves plus securities premium. So this point I already added morning itself, I added this point in that clarification document. So total 4 clarifications. One is in starting preliminary chapter section, actually section number of preliminary section number of associate companies section 2 clause 6, but typing error it came section 2 clause 46. This is one clarification. Second clarification, sweat equity shares, one condition. What is that one condition? Existing class of shares. And next the third one, just now I told you third one. So this is fourth one, this is paid up share capital, this is paid up share capital. Third one is employee salary. Employee loan shall not exceed 6 months of the salary. Okay, so once you get these materials, I'll tell you the corrections. So only 4 corrections to be done. It's not corrections, it's like clarifications. Next one, fully paid up shares. Only fully paid up bonus share, only fully paid up shares are eligible for buyback. If you observe carefully, this condition is common in section 55 also. That means in redemption of preference shares also we had this condition, only fully paid up shares can be redeemed. And this condition is also common in section 63. Only fully paid up shareholders, fully paid up shares holders are entitled to receive fully paid up bonus shares. Next one, SEBI regulations. Listed company must comply with SEBI regulations. Lock-in period, no buyback within 1 year from the closure of previous buyback. So that means the gap between buyback should be minimum of 1 year. And gap between buyback means earlier buyback closure date, subsequent buyback opening date. It's not between opening dates, it's not between closure dates, it's between previous buyback closure date and subsequent buyback opening date. Logic very simple. Going concern, what is the going concern? What is the meaning of going concern? For the next 1 year, can company carry business operations or not? So once buyback completed, for the next 1 year, if company is able to carry business operations, then no problem. Immediately they can also announce for a buyback. And you may get a doubt, sir, every year if company is making buyback of 25% of paid up equity share capital, at one point of time, capital may become 0, no sir? No. Why? Suppose today I'm having 100 shares. I bought back 25 shares. Now what is the closing value? Well, closing value 75. But you know, for buying these shares, if I have utilized the free reserves, I should have created CRR. With this CRR, what I will do? I will issue bonus shares worth 25 face value. Now again 75 plus 25, 100. So capital never becomes 0. Suppose if I select issue proceeds, then capital will be in increasing trend only. Clear? Next. Procedure before buyback. The notice of the meeting at which a special resolution is passed, proposed to be passed, shall be accompanied with an explanatory statement. That is common. You know, for all special businesses, explanatory statement is compulsory. In that explanatory statement, you have to provide these details. What are those details? All material facts, reason for buyback, shares involved in the buyback, amount to be invested in the buyback, and time limit for completion of buyback. Actually, buyback shall be completed within 12 months from passing the resolution. Look at the word resolution. It may be either board or it may be either special. When board, if it is less than or equal to 10% of paid up equity share capital plus free reserves plus securities premium. If it is exceeding that limit, then special resolution. But special resolution is also having a limit, that is up to 25% of paid up share capital plus free reserves plus securities premium. Clear? Next one, procedural steps. Procedural steps, clarification. Listen carefully. First, you have to prepare a document called letter of offer. Letter of offer comes two times. One is rights issue, other one is buyback. File letter of offer with ROC and dispatch letter of offer within 20 days of filing with ROC. Within 20 days of filing with ROC. Let me repeat the point. File letter of offer with ROC. You know, company wants to propose a buyback. Already company received special resolution. Now company want to announce buyback. So that letter of offer shall be dispatched to all the members. Within how many days it should be dispatched? Within 20 days. Actually, it should be dispatched immediately after filing with ROC. But it should not be later than 20 days. So today, for example, today 1st April, imagine. Today I am filing letter of offer with ROC. Now by 21st of the April, that means within 20 days, I should send the letter of offer to all members, eligible members. So correction here is, or clarification here is, first file letter of offer with ROC and dispatch letter of offer within 20 days of filing with ROC. Dispatch means with whom? To whom we should send this letter of offer. Dispatch letter of offer to members. Dispatch letter of offer to members. Within how many days? Within 20 days of filing with ROC. Understood? Clarification. Next, offer open for not less than 15 days but not exceeding 30 days. So what is offer period? Minimum 15, maximum 30. And if all members give consent, then offer period can be less than 15 days. If all members give consent, then offer period can be less than 15 days. Next one. Proportionate acceptance if shares offered exceed buyback quantity. Suppose we made an offer for 1 crore shares for buyback and company received applications for 2 crores. Now what I will do? For every 2 shares you applied for buyback, I will consider only 1 share. Proportionate. Next, verification shall be completed within 15 days of closure. So within 15 days of closure of within 15 days of closure of offer period, within 15 days of closure of offer period, verification shall be done. Who are eligible, who are not eligible. I told you, right? Shares should be fully paid up. Suppose a person holding partly paid up share, he also applied for buyback. Then buyback allowed or not allowed for that person? Not allowed. So verification shall be done within 15 days of closure of offer period, and payment to the shareholders within 7 days of verification. So net, if you observe carefully, 21 days. How much time limit is there? How many days time limit is there? 21 days. Within 21 days of closure of buyback offer period, I should repay that amount, or else I should communicate rejection. I should communicate rejection of offer within how many days? 21 days. Let me make the point very clear. So what is the time limit for completion of verifications? 15 days. 15 days from closure of offer period. And what is the time limit for making payments? 7 days after expiry of 15 days. So if not, communicate rejection of offer of letter. Communicate rejection of offer within 21 days. So communication of rejection of application. Communication of rejection of application shall be done within 21 days. 21 days of closure of the offer. Next one, payment to the shareholders. I told you, return unaccepted shares. That's it. Is it clear? So in a procedural steps, 2 points are missing. So what is the actual procedure? First, I need to prepare a letter of offer. I should file it with ROC. Then I should dispatch them to the eligible members within 20 days. Next one, I will receive applications from them. That offer period should be minimum 15 days, maximum 30 days. With the consent of all members, I can reduce that 15 days time limit. Next one, once offer period closed, within 15 days, I should complete verification part. Once verification part is over, within 7 days, I should repay money to the eligible applicants. If not, within 21 days, I should communicate about rejection, and I should return the unaccepted shares. Clear? So this particular fourth point, complete fourth point, I will give it separately. Next one, buyback from whom? Buyback is possible from either existing members or existing security holders. That means all existing employees to whom company issued shares under ESOP or sweat equity. Open market, employee stock options, sweat equity shares. Open market means stock market, they will come, they will purchase the shares whatever available. That's it. So existing shareholders, existing shareholders means what? Proportionate basis. Suppose everyone is holding 10 shares or multiples of 10 shares. Now what I will do? I will take 1 share out of every 10 shares. This is said to be on proportionate basis, or this is said to be on application basis, and this is like purely from employees. But company has to select one, and only from that one buyback should be completed. Company has to select only one, and come in from that one source only buyback should be completed. So tell me, what is the time limit for buyback, Within how many months I should complete buyback from resolution? 12 months. Clear? Next one, declaration of solvency. A declaration of solvency shall be filed with registrar and SEBI. SEBI is not for all companies. SEBI is only for listed companies. Declaration of solvency has to be on form SH9 and verified by an affidavit stating that board of directors has made full inquiry into the affairs of the company and have found that it is capable of meeting its liabilities and will not be rendered insolvent for a period of 12 months from the date of declaration. Once again, if you observe, 12 months time period is used. That means today if we are making buyback, next 12 months there will be no effect on continuity of business operations. Going concern is still alive. So we have made the inquiry into the affairs of the company. Our assets are sufficient to discharge liabilities. First of all, we will not liquidate ourselves. Even if liquidation happens, assets are sufficient to discharge liabilities. Like that, directors have to make inquiry, and 2 directors, one should be the managing director, should sign this declaration, and this declaration should be filed with 1 copy with ROC for all companies. Only for listed companies, another copy is with SEBI. Extinguishment of securities. Extinguishment means destruction. If securities are available in physical paper form, then destroy them. Demat form, reduce the count. After buyback, company must extinguish and destroy the buyback securities within 7 days. Cooling period on fresh issue. After a buyback, company cannot issue same kind of shares for 6 months. Exceptions: bonus shares, discharge of obligations. Example: conversion of warrants, stock options, sweat equity, preference shares. This is very important. This is very important. In one attempt, a question came for 5 marks stating that buyback cooling period A simple point I'm telling you. Buyback cooling period is 6 months. Issue of bought back shares. Issue of shares involved in buyback is 1 year. Comment. Cooling period means what? First of all, sir, bought back shares, you told that extinguished. No, sir. Yes, issued shares gets extinguished. But what happens? Let's see. My authorized share capital 1 lakh shares. Each face value 10 rupee. My issued share capital is 50,000 shares. Each share 10 rupee. Now I made a buyback of some 500 shares, or some 5,000 shares I made a buyback. Now what is the total? Total issued shares so far 45,000 is the issued shares. But if you observe, as per my MOA, I can issue how many shares? 1 lakh. And so far how many shares I issued? 45,000. That means 55,000 shares I can issue. But these 55,000 shares I cannot issue for how many months? 6 months, including rights. Including rights. For rights also I cannot issue. But we had exceptions. What are those exceptions? Bonus shares I can. Discharge of earlier obligations like conversion of warrants, stock options, sweat equity, preference shares. That means section 62 is not possible here. However, bonus shares possible, warrants possible, stock options, sweat equity, preference shares. Logic very simple ma. Under bonus shares, company will not get any money first of all. And these conversion options, conversion obligations, I'm not keeping these obligations today. Somewhere some 2 years ago or 5 years ago, I promised my debenture holders I will convert them, and today due date came. So just because of buyback cooling period, I cannot be prohibited from converting debentures into equity shares. So either existing obligations or bonus shares, both are allowed during the cooling period of 6 months. Rights issue, not possible. Identified persons, that means private placement, not possible. Everything and anything is not possible. Only bonus discharge of obligations possible. Now just look at the question, previous attempts question. Buyback cooling period should be 6 months. Issue of shares involved in the buyback, the cooling period is 1 year. Buyback cooling period means what? Once buyback is completed, fresh buyback can't be made up to 6 months. This is one. Second one, once buyback is completed, shares involved in the buyback can't be reissued or can't be issued within 12 months. So true or false? False. Exactly what they did, they interchanged the limits, time limits. Clear? So for this, reading entire buyback is not at all required. Just the 2 time limits you need to understand. And very simple to understand. Once buyback completed, for checking going concern, we have to wait for 1 year. And once buyback completed, shares involved in buyback can't be issued up to 6 months. Would your answer differ if company is planning to offer bonus shares? Yes, my answer is different. For bonus shares, for conversion of warrants, options, debentures, preference shares into equity, cooling period of 6 months will not apply. Clear? Everyone? Next one. For a company, every activity and all activities shall be recorded. Recorded in what? Recorded in register. Next one, filing of buyback return with ROC SEBI. Sir, already I filed one return. No, sir. It's not a return. It's a declaration of solvency. Now this is a return. So buyback completed. From these fellows, I made a buyback. Okay. So with whom I should file buyback return? ROC for all companies. For listed companies, SEBI. Within how many days? Within 30 days after completion of buyback. And a certificate, form number SH15, must be submitted confirming compliance with the provisions. That means buyback is as per provisions of Companies Act and rules made thereunder. That's it. Penalty for default. If company defaults, company fine 1 lakh to 3 lakhs. So officer in default fine 1 lakh to 3 lakhs. Transfer of certain sums to the CRR. Tell me when CRR comes. If I select buyback from internal funds or if I select buyback from external funds. Internal funds. That means if I utilize free reserves or securities premium for making buyback, I should create a CRR. It's an internal adjustment entry. So entry would be like this, free reserves account debit to CRR account. That's it. And how much amount I transfer to CRR? Only face value of the shares. A sum equal to nominal value of the shares must be transferred to CRR. Okay, no. Next one, prohibition on buyback. Prohibition on buyback. We had a prohibition on issue of equity shares with the differential rights, correct? Issue of equity shares with the differential rights, we had a prohibition category. If I had 3 years defaults or 5 years defaults, if I had subsisting defaults, buyback is prohibited. So in that I clearly told you 5 sources of finance. What are those 5 sources of finance? Equity, preference, deposits, debentures, term loans. You have to write all the 5 points here. Repayment of deposits, interest on deposits. But for debentures, he forgot to write interest on debentures. Any logic? Only forgot. He forgot, that's it. He forgot interest on debentures. Who? Lawmaker, that's it. So for this there is no logic at all. Lawmaker is also a natural person like me. I am also a natural person. That's why 2 errors happened. I think you can accept it, okay? You won't start any strikes at all, right? No ban of material, right? Material allowed, right? Okay? Yes, fine. So he forgot, no sir, you write. No, I should not write. Whatever is there in the law, we should read it, that's it. Fine, now come to the point. Repayment of deposits, interest on deposits. Redemption of debentures, redemption of preference shares, payment of dividends to any shareholder. That means, here equity dividend comes as well as preference dividend also comes. Next one, repayment of any term loan or interest thereon to any financial institution, banking company. That means 5 sources of finance is there here, except interest on debentures. So buyback is allowed if the default is rectified and 3 years have passed since it was cleared. There 5 years. After rectification, wait for 5 years. Here only 3 years. So, having these defaults, company is prohibited from making a buyback. Not only by itself, but also through its subsidiary company, but also through an investment company. Mutual fund companies comes under investment companies only. Okay, na? Sir, why not after year of rectification, sir? Because who knows, maybe internal adjustments, you might have arranged funds for redemption of these funds. You might have arranged funds for redemption of these obligations, deposits, preferentials. So immediately I won't allow you for buyback. Just wait for 3 years. Limitation Act provision is there, right? Time limitation act, 3 years from maturity. If I'm not paying or if you are not collecting from me, debt becomes time barred debt. So that logic might have been applied here. Can I proceed? Next, all these are monetary defaults. There is non-monetary default. That non-monetary default is, fails to comply with 92. What is 92? Annual return. 123, 127 is all about dividends. 129 is all about financial statements. So with these defaults also, buyback is prohibited. So buyback completed, ma. In total buyback, let's look into the limits one time, because in material 2 time limits are missing. So that's the reason. Let's look into the limits of buyback once. First one, validity of special resolution, validity of board resolution, 12 months. 12 months. Next one, buyback shall be completed. Buyback shall be completed or validity of SRBR, both are same. Validity of SRBR means what? Buyback should be completed within 12 months. Next one, buyback cooling. Buyback cooling, 12 months. Fresh buyback is possible only after completion of 12 months. Next one, declaration of solvency. The period I'm talking about, the period is 12 months. Period mentioned in declaration of solvency, which is signed by 2 directors, is 12 months. Next one, issue of bought back shares. Issue of bought back shares, cooling period is 6 months. Okay, na? Next one. Letter of offer. Dispatch of letter of offer. Within 20 days of filing with ROC. Next one, offer period 15 to 30 days. Minimum 15, maximum 30. Next one, verification. Verification should be completed within 15 days of closure of offer period. Payment should be done within 7 days of closure of verification. Next one, communication of rejection. Communication of rejection shall be done within 21 days. I think these are the time limits we have gone through. Execution 7 days. Why? Yes, extinguishment, correct. Extinguishment of shares. Extinguishment of bought back shares or specified securities 7 days. Next one, return of buyback. Return of buyback 30 days. 30 days. Company doing these things, okay. We are not doing these things, right? Why we should remember? Because 5 marks. Okay, na? Clear? Total limits, I hope. Validity of resolution 12 months. Buyback cooling 12 months. Declaration of solvency 12 months. Issue of bought back shares 6 months. Exception, bonus issue, conversion of existing obligations. Next one, dispatch letter of offer within 20 days of filing with ROC. Offer period minimum 15 days, maximum 30 days. With the consent of all members, that 15 days can be reduced. Next one, verification part 15 days of closure of offer period. Payment part within 7 days of closure of verification. Communication of rejection within 21 days. Next one, extinguishment of bought back securities 7 days of completion of buyback. Return of buyback within 30 days of completion of buyback. File return of buyback with ROC and SEBI for listed companies. Okay, na? Okay, buyback completed. So all online students make a note of these points. Separately, I will give you one paper document covering clarifications. Next one, debentures. Why company issue debentures? Because company need funds. Why not bank loans? Bank loans, we should satisfy n number of stupid conditions which bank impose. But in case of debentures, company's reputation will help to fix terms and conditions. If you go to bank will fix conditions, you need to satisfy all those conditions. But coming to issue of debentures, company reputation helps company to fix terms and conditions. Suppose banker fixed rate of interest 12%. Company is having reputation, company fixed 9% interest on debentures. Sir, public will go to bank, no sir. Bank loan rate of interest is 12%, whereas bank FD rate is 7% only. Bank saving bank account interest rate is 2.7% only. So definitely those who want more return, they will take more risk, they will come and they will subscribe our company securities. Sir, why not equity? Too much issue of equity shares leads to dilution of control. I don't want dilution of control, but I want funds. In that case, go with debentures. But there is a problem in debentures. The problem is you cannot issue irredeemable debentures. You can issue only redeemable debentures for a maximum period of 10 years. Of course, for infra companies, 30 years. Like preference shares, you can see 30 years. Here also 30 years. But maximum duration of debentures is 10 years. Let's see one by one. Debenture includes, this is an inclusive definition, debenture includes debenture stock, bonds, any other instrument of a company evidencing a debt, whether constituting a charge on the assets of the company or not. That means charge on the assets means what? If I am creating charge on the asset with respect to debentures, they are treated as secured debentures or else unsecured debentures. That means whether secured or unsecured are not a matter to me. If that instrument is evidencing a debt, I call it as a debenture. That means all debt securities are debentures. Can I proceed? Next one, exclusions from debentures. These instruments are not treated as debentures. That means to these instruments, section 71 of Companies Act, applicable or not applicable? Not applicable. Sir, what are those instruments? Instruments specified in chapter 3D of RBI Act, like commercial papers, short-term borrowings. For managing short-term borrowings, they can issue commercial papers. Commercial papers will not come under the definition of debentures. And any other instrument prescribed by CG in consultation with RBI. Suppose Nidhi company issuing a debt security, issuing a debt instrument. So Nidhi company issuing debt instrument will not be treated as debenture. Like that, tomorrow central government may come up with notification. Okay na? Okay na, Sima? Central government issuing a notification. That notification will have only two uses. One use, increasing revenue to the government. Increasing revenue to the government. Other one, decreasing revenue to the government. No. Increasing vote bank. Increasing vote bank. Clear? Recently, very recently, up to how much amount no need to pay tax? 12 lakhs. Sir, if government is doing like this, definitely it's a loss to the government. No, sir. Financial loss, but vote bank will increase. So now next elections, middle class families, what they will do? They will cast their vote to the existing ruling party only. Yes or no? So we have to understand in that way only. Visualization means all about these things only. So in income tax, whatever provision you are reading, you will find only two things. One is government hungerness. Second one is government vote bank. That's it. For CS students, yes, vote share is there. Voting is there, right? But we are how many in number? 10 lakhs only. Total eligible voters are 90 crores. In that we are not even 1%. 1% means 90 lakhs. We are 0.1%. Exclude CA foundation students. Maybe they are minors. Okay, that means we are not even 0.1%. So government will not think about us. Next. Features of debentures. Characteristics of debentures. A debenture represents smallest unit of a large loan amount. Share also represents smallest unit of share capital only. Share represents smallest unit of share capital. Debenture represents smallest unit of loan amount. Upon issuance, applicants receive certificates as a proof of money lent to the company. Or in case of share also, company issues share certificate. A debenture certificate is issued by company under its common seal or signed by two directors or one director and CS, similar to share certificate. Company pays periodic interest. This is not similar to equity. This is not similar to preference. In preference, fixed dividend. Here it is interest. Dividend is appropriation of profits. Interest charged to the capital. That means even in case of losses, we are liable to pay interest. Interest is prefixed, whereas equity dividend is not prefixed. It is determined by board of directors, approved by members. Section 71 subsection 2 of the Act, debentures do not carry voting rights. Correct. They are creditors, non-trade creditors. They are outsiders. How they get voting rights? Suppose if I issue debentures with voting rights, that issue is treated as void. Next, a debenture is considered as movable property. Section 44 is telling that every security is a movable property. Debenture is one of the securities, so it is also a movable property, transferable as per company's AOA. Debentures can be secured or unsecured. Looking at the definition, it is clear whether constituting a charge or not. That means charge created, secured debenture. Charge not created, unsecured debenture. Secured debentures have a charge on company assets in favor of debenture trustee. Actually, if you look at charge, you will find two parties. One is borrower, other one is lender. And this charge instrument shall be signed by both the parties, borrower and lender. Imagine if company is issuing debentures. Do you think only one person subscribe debentures? Only one person subscribe all debentures? If yes, no problem. But if 1000 persons are subscribing debentures, now is it possible to these 1000 persons signing this charge instrument one by one? Sir, 1000, okay, one day if we spend, we can take signatures, sir. Imagine 1 million, not possible. That's why representing these people, one person will come and sign this charge instrument. Who is that one person? Debenture trustee. Next one. So charge will be created in favor of debenture trustee. As per the terms of issue, debentures may be redeemed in full at the end of their term or installments. Okay. The terms of issue may allow conversion of debentures into equity at maturity, though we call them as convertible debentures. Debenture certificate shall be issued within 56. That's what. Suppose in case of transfer, tell me within how many days company should deliver debenture certificate? 1 month. Because for transfer, we use the word security. Whereas for allotment, we used share separately, we used debenture separately. Okay, now. Everyone. Next. So what is the time limit for issue of debenture certificates? 6 months of allotment. Sir, incorporation, sir, not possible. Incorporation not possible. At the time of incorporation, we only issue shares to the subscribers of MOA. We can't issue debentures. Subsequent to incorporation, conducting a general meeting or conducting board meeting, they may pass a resolution for issue of debentures. That is different factor. So in that case also allotment word comes, incorporation word never comes. Next one, unless restricted by law, court, tribunal, any other authority. Suppose transferee is not financially capable person, or transferee is a disqualified person, or transferee is an aligned enemy. In all these cases, what court will do? Court restricts transfer. And even if you remember section 58, refusal of registration of transfer. So matter went to the tribunal. Tribunal suspended the rights of a transferee. So don't issue certificates in that case. Next one, section 71. This is all about basics, section 71. See, if they want to ask 2 marks question, they can ask you questions like this. Can a company issue debentures with voting rights? No. Can a company issue secured or unsecured debentures? Both company can issue. Next, issue and redemption. A company may issue debentures with an option to convert them into shares fully or partially at the time of redemption. That means partly convertible debentures or fully convertible debentures. Issue of convertible debentures requires a yes sir. When? At the time of conversion, at the time of issue? At the time of issue. Debentures do not carry voting rights. Okay. Secured debentures. Now these debentures cannot exceed for it, cannot be issued with a term exceeding 10 years, maximum 10 years. Whereas for infra projects companies, infra finance companies, infra debt fund NBFCs, for them 30 years. Infra projects company means this is a direct company which is engaged in infrastructure like GMR, L&T, all these Navayuga constructions, all these are infrastructure projects companies. And companies financing these companies, any finance company which is financing this company, we call them as infra finance companies or infra debt fund NBFCs. For them also, if these companies are issuing debentures, they can fix a tenure up to 30 years. Not only these 3 companies, future central government may prescribe few companies. They can also issue debentures with a tenure of 30 years. So MCA, Reserve Bank of India, National Housing Bank. Companies permitted by regulatory authorities such as Ministry or Department of CG, RBI, National Housing Bank, or any other statutory authority. For them also, the tenure, maximum tenure is 30 years. A charge is created on company assets for secured debentures. Correct, charge will be created on properties only. Next one, trustee appointment. So before making public offer, or before making an offer to the members exceeding 500, you can see here exceeding 500. In both the cases, if you are going to public at a large or if you are going to existing members exceeding 500, then debenture trustee is compulsory. And you need to name the debenture trustee details in the offer document. Limits on borrowings. Limits on borrowings. I hope you remember this section. What is this section? Borrowing powers of the directors. So existing debt plus proposed debt. Together 100% of paid up share capital plus free reserves plus securities premium. Then for this proposed debt, if this proposed debt is non-convertible debenture, in that case board resolution is sufficient. Otherwise, that means if it is a CD, that means convertible debt, or adding proposed debt, if we are crossing 100% limit, then SR is required. Getting the limits, NCD within the limits, BR. CDs or NCDs exceeding the limit, SR. If borrowings of debentures exceed companies paid up share capital, free reserve, securities premium, then SR is required. Whereas if borrowings do not exceed the above limits, board resolution is sufficient. But here we need to remember the point. What is the point? Non-convertible debenture. Sir, word is missing. No, sir. Here I specifically mentioned issue of convertible debenture require. Yes, sir. That means here I am talking about what kind of debentures? I am talking about non-convertible debentures only. Logic important here. Theory, logic, both are correct, but I am giving you clarification. Sixth point is all about NCD. Why? For CD, already a separate point is there. Next one, seventh point, debenture trustee. When I need debenture trustee, when I'm offering shares to the public at a large or to the members exceeding 500. Then appoint one or more trustees. Count not important. 1 or 2 or 3 are not important. Issue a prospectus for the public and issue a prospectus for public offer. A written consent from proposed debenture trustee must be obtained before appointment. That is compulsory. Even if you see inclusion of expert statement requires a written consent. Inclusion of debenture trustee details requires a written consent. Inclusion of nominee details in OPC requires a written consent. Debenture trust deed shall be executed in Form SH12 to protect the interest of debenture holders within 3 months of the closure of issue of offer. Within 3 months, deed shall be executed. Next one, disqualifications. Following people are not eligible to become trustee. Simply, all these following people are dependent people. See, trustee should be independent person, but if you observe these situations, all these people are becoming dependents. How? Let's see. Beneficially holding shares. Before explaining this point, in one attempt, in two attempts, I think 2013, 2021, from these points 6 marks questions came. So how they will ask questions? They will give some list and they will ask you whether they are qualified or disqualified. So who is disqualified? We have to check. First one is beneficial holding shares. Beneficiary holding shares. I'm not talking about legal ownership. I'm talking about only beneficial ownership. That means C Limited company is there. Here Mr. M is a holder of shares. He's a shareholder. And he is holding shares on behalf of N. M is not holding shares for himself. M is holding shares for N. Now the shares held by M, who is the beneficiary? N. M is not having any beneficial interest. Only N is having a beneficial interest. Now in this case, who is qualified? Who is disqualified? M is qualified to act as a trustee because he had no beneficial interest. And N is disqualified because he is having a beneficial interest. Reasons are very simple. Equity shareholders gathered at one place, they need to take a decision about themselves, which will affect debenture holders. So benefit, they are talking about their benefit. But if this benefit is implemented, debenture shareholders will be at risk. They are planning to sell a property, and from that property process, they want to distribute those returns among themselves. But if it is done, whose interest is getting affected? Debenture shareholders. Now if you appoint N as a debenture trustee, do you think he will communicate this matter with the debenture holders? He will communicate this matter with the debenture holders, or he will not communicate? He will not communicate. Why? His interest is there. Yes or no? It's very simple, ma. In your childhood, you took 20 rupees money without your mother permission, and you are caught by a little brother or little sister. Now actually that person should communicate, that person should tell about you, about your robbery, everything he should tell. But why that little kid is not telling? Because you are offering some money to that person. If that kid tells to mom, what happens? What you will tell? Already that fellow also took some 10 rupees money. Now both will be caught, yes or no? So here also if you observe, if this beneficially holding persons, if this beneficiary, if I appoint him as a debenture trustee, he won't make a decision in favor of trustee. He think about his interest only. Clear? Everyone? Next, promoter, director, KMP, officer, employee, all these people are internal people. Why they will take a decision which will help debenture holders? They always think about themselves only. So all these people are dependents, not only in our company but also holding subsidiary, associate. Simply I call it as cash company. Cash means what? C stands for our company, A means associate, S means subsidiary, H means holding. A relative of these above people. Relative of the above people means relative of the director, promoter, KMP, officer, like that. Next one, beneficiary entitled to receive payments from the company. That means we call him as a creditor. Next one, anyone indebted to the company, we call him as a debtor. Creditor is also disqualified, debtor is also disqualified. Why? On debtor, company can exercise undue influence. Sir, you are doing fraud, sir, I will tell to debenture holders. What company will tell? Come on, give me my money. Yes or no? Or else I will show you. Sir, creditor will be independent. No, sir. Creditor will be independent. But the point is, if you tell that matter to debenture holders, they will ask money. We will pay money to them. We will not pay money to you. Why? Entire money will be paid to debenture holders. Now you are left with 0. But if you keep silence, we will pay you 2 times. Now obviously creditor also will keep silence. So creditor disqualified, debtor disqualified. Debtor of CASH plus SH. CASH means C company, A associate, S subsidiary, H holding, SH means subsidiary of holding. Next, anyone who has furnished a guarantee for the principal debt secured by debentures or interest thereon. So this one I call him as surety. Suppose company is there, you are debenture holders, and I give surety. Surety means what? Tomorrow if company fails to pay, I'll pay you. That's what guarantee I gave to you. Imagine if I am appointed as a debenture trustee in the company. So what are all the things happening in the company? I will know the things. If I communicate these things to you, you will immediately hold company to pay funds. If company fails to pay funds, you will ask surety. Who is surety? Again, surety is me only. That means if I make any communication of internal irregularities with you, you will catch me only to collect those funds from me, because company definitely will make a default. So tell me now, surety, will he act independently or dependently? Dependently. Getting it? So simply beneficial shareholder disqualified. Officers are disqualified. In officers you can see promoters, directors, KMP, employees, etc. Next one, debtor disqualified, creditor disqualified, surety disqualified, relatives of the officers also disqualified. Next one, anyone having a pecuniary relationship with the company amounting to 2% or more of company's turnover or total income, or 50 lakhs or more during the 2 immediately preceding financial years or the current financial year. Suppose company is Asian Paints company and I am a distributor, I am a dealer with respect to Tamil Nadu. So whenever I order stock, I deposit money and I will get stock. That means there is no creditor debtor relationship. I am neither creditor to the company nor debtor. Why? At the time of dispatch of product, I will pay the money. So not creditor, not debtor, not an officer, not a employee. Next one, not a beneficial shareholder. But still I am disqualified. Why? Because if I favor debenture holders, if I create, if I do any favor to the debenture holders, company may terminate my dealership with respect to Tamil Nadu. Company may appoint some other person as a dealer for Tamil Nadu. So to protect my business, what I will do, I'll keep debenture holders in a safe zone, unsafe zone, unsafe zone. So that's why a person having a pecuniary relationship, that means financial relationship with company in the current year as well as 2 preceding financial years, that means total 3 years, 2 previous, 1 current. So in these 3 years, if I had any relationship with company, I am disqualified. Okay na? Suppose every 3 months, okay, every month I recharge my Jio SIM, I recharge every month, I recharge 2000 rupees. Now company Jio wants to appoint me as a debenture trustee. So am I qualified or disqualified? Qualified. Why? Company turnover 2000 crores and my recharge amount to 2000. Financial relationship is there, but it is not material financial relationship. To find materiality, we had a limits 2%, 50 lakhs. 2000 into 12 months means 24,000 only. Okay na? Suppose if I do favor, if I am in favor with debenture holders, can Mukesh sir call me like this, I am going to cancel your Jio subscription. Okay, cancel. I'll take BSNL. Yes or no? Or Airtel. So here there is no material pecuniary relationship. Fine. Next one, filling casual vacancy. The board may fill any casual vacancy in the trustee office. Suppose by due to subsequent disqualifications or due to the death, what happens? Debenture trustee office, there is a vacancy. Now who can fill this vacancy? Board may fill this vacancy. But if this vacancy is caused by resignation, then appointment of trustee by board requires approval of majority debenture holders. Because in case of resignation, the matter is very severe. The matter is very severe. Why? Company is not responding to trustee, or trustee is not getting up to date information. That's why trustee might have resigned. Some undue influence, some under pressure, some pressure is there. That's why he resigned. So new trustee requires whose approval along with board approval? Debenture holders approval. A trustee can be removed with 3/4 approval of debenture holders. Debenture trustee must protect the interests of debenture holders and can convene meetings to address grievances or breaches on receiving a request from debenture holders holding at least 1/10 of the value. So what is the meaning of this point? This is nothing but convening debenture holders meeting. Sir, why sir? Debenture holders are outsiders. They don't know about internal matters, but their interest is there. Their interest is involved in the company. Company is carrying business operations not only with own funds but also loan funds. Loan funds belongs to debenture holders. So to know what is happening inside, if any material things are happening, so they must be communicated. For that, debenture trustee, whenever required, trustee should call for a meeting, and to that meeting who comes? Debenture holders comes. Okay, now next one. Any terms exempting trustee liability for breach of trust is void unless approved by 3/4 of debenture holders. Simply, debenture trustee should act as a man of ordinary prudence. As a man of ordinary prudence. That means whatever things are happening in the company, he should check whether it is affecting debenture holders or not. So tell me, now debenture trustee, should he act negligent or should he act as a man of ordinary prudent? Man of ordinary prudent. Now, in debenture trustee deed, company is telling, my dear trustee, even though you won't execute any functions, any duties, we exempt you from punishment. Non-compliance, no problem, you will get exemption, you will not get punishment. Like that, any term is there in the trust deed, the term becomes void. So any term exempting trustee from the liability for breach of trust, the terms becomes void. If 3/4 of debentures agree to it, then it is valid, because for them it is okay. Yes or no? For them it is okay. A company must pay interest and redeem debentures according to the terms. If company assets are insufficient to discharge debenture liabilities, then trustee can file a petition to the tribunal to impose restrictions on future liabilities, further or future liabilities. Right now financial position is good, but if company keep on borrow the funds, later company cannot redeem existing debentures. In that case, what trustee will do? Trustee will ask NCLT to impose restrictions. If company fails to redeem debentures at maturity or pay interest on due dates, the tribunal can order immediate redemption or immediate payment. A contract to take and pay for debentures can be enforced only through a decree for specific performance. That means you told 10% debentures, redemption after 5 years. That means what? Every year they are entitled to 10% interest. First thing. Yes or no? Second thing, after 5 years they are eligible for redemption. So this is like a specific performance. So you made a promise, that's why I entered into a contract. Whatever promise you made, you fulfill that promise. So that we call it as specific performance. So you need to pay interest on timely basis. You need to redeem debentures on timely basis. Central government may prescribe procedures for securing how to secure. That means how to create a charge in favor of debenture trustee, the form of trust deed, inspection of all these documents, quantum of DRR. So who is having power to prescribe all these things? Central government. In rules they prescribe these matters. Okay, now last point, debenture redemption reserve. Suppose you are getting a stipend of 15,000 from your boss. Imagine every month 15,000, and you had a plan to purchase iPhone 18 or iPhone 17. Next year definitely will be in articles, right now 16 series is running. So you want to purchase iPhone 17 which cost for example 70,000, and you are getting a stipend of 15,000, and your target is to purchase this phone within 10 months. Now what you will do? Every month 7,000 you will save. So after 10 months total saving would be 70,000. With this money you can easily purchase iPhone. Similarly, you issue debentures for 10 years. After 10 years, you need to redeem debentures. So certain portion of profits, whatever returns company is getting, here for you 15,000 is profit for company. So whatever amount they are getting, profits they are getting, certain portion of profits shall be reserved for the purpose of redeeming debentures, and that reserve is known as DRR. See, there is a difference between CRR, DRR. CRR we create a post buyback, post redemption, whereas DRR we create a before redemption and for the purpose of redemption. Clearer? For all India financial institutions regulated by RBI, DRR is exempted whether they issue debentures under through prospectus or through private placement. For banking companies also DRR is exempted. Exempted means what? They are exempted under Companies Act 2013, maybe under RBI Act, maybe under special acts. DRR is there, who knows? Under Companies Act exempted, that's it. They are not special companies. They may got regulations from some other acts, that's why under Companies Act exempted. Next, listed companies. For listed companies other than above two companies, other than all India financial institutions, other than banking companies, only listed companies are exempted except these two categories. That means for these two categories DRR is applicable. Listed companies means L&T, next one Bharati Airtel, like that, Bharati Airtel, Vodafone Idea, like that. Okay, exempted except the following category. Next one, for unlisted companies other than above categories, for unlisted company, for publicly placed debenture, you have to create a DRR. DRR how much? 10% of outstanding debentures. And whereas for privately placed debentures, DRR is equal to 10% of outstanding debenture except again these two companies. That means these two companies create DRR only for the for the debentures which were offered through prospectus. The interpretation is like this. So these companies, NBFCs, housing finance companies, create DRR which is equal to 10% in case of public placed debentures. Why? Because these both NBFCs, housing finance companies, are again there here, here unlisted companies. Unlisted companies, in unlisted companies we are having a category stating that DRR is equal to 10% of outstanding debenture except these two. So for these two companies, for these two unlisted companies, simply DRR is not required for privately placed debenture. DRR is required for publicly offered securities. Just remember the limit. What is the limit? 10%. Next one, savings. You will do savings, right? 7,000 rupees. 7,000 rupees every month, like that. 10 months it would be 70,000. Where you keep this money? Definitely in your bank account only, because in your bank account every month 15,000 comes. So you will expend only 8,000. That means 7,000 is savings. This 7,000 is available in bank. Or else if you are getting 15,000 cash, then you may keep a pot, and in that pot you may deposit that money. Yes or no? Childhood memories. But coming to companies, so pot, bank facility not available for them. Only for them the options available is make deposits or purchase unencumbered securities. Unencumbered means free from charge. That means taking these securities, again creating some pledge on it, again we taking money, sir, doing for business. What is the use of it? So you have to keep that money aside. And interesting part, in this case, interesting part is we create DRR 10%, but we invest 15% in the following securities. Saving is 10%, but investment is 15%. Why? I don't know. Previously saving is 25%, investment is 15%. But now DRR is 10%, investment is 15%. That means 5 rupees extra. Listed companies in case of publicly placed debentures, unlisted companies in case of publicly and privately placed debentures, amount equal to 15% of debentures maturing during the financial year ending on 31st March of the next year. That means 31st March of next year means 2026 shall be invested or deposited in any of the following methods of the deposits or investments, namely scheduled bank deposits, unencumbered securities, again unencumbered securities. Next one, these investments cannot be used for securing loans. That's why we call them as unencumbered securities. These investments must be only used for redemption of debentures. Correct purpose? Redemption of debentures. Investment should not fall below 15% of the amount of maturing debentures. For partly convertible debentures, DRR shall be created for the non-convertible portion. Why not for convertible portion? For convertible portion we issue shares. Redemption is not compulsory. So reserve investment requirements will not come. So with this we completed one smallest chapter of the our syllabus, share capital. Another tiny chapter is there. The tiny chapter is management and administration. If we complete the tiny chapter, all chapters are big chapters. So in this lecture, I will continue my discussion with question bank of share capital and debentures. Starting with illustrations. First one, can a company have only preference share capital? No, because of two reasons. One is, if you look at the definition, preference share capital carries preferential rights compared to equity shareholders. And second one, no company can issue irredeemable preference shares. So at one point of time, preference share capital becomes 0. Yes or no? So preference share capital, is it a permanent capital or temporary capital? Maximum tenure is 20 years. Yes or no? So it may be noted that while a company may have only equity share, but it cannot have only preference shares. This is because preference shareholders have certain preferential rights over equity shareholders. Thus, in the absence of equity share capital, there can't be preference share capital. That means even though namesake you issue preference shares, it is not preference share capital, it is equity share capital. Clear? Next one. Where a shareholder paid the first two calls after a great delay and neglected to pay the third call, the directors being annoyed called upon him to pay whole amount due. In your opinion, is it a valid call? Why? Section 49, calls should be on what basis? Distinct basis or uniform basis? On this illustration only, September 24 attempt, 5 marks question came. So max to max, from examples, illustrations, and the practical questions that are covered in study material, from those questions only you can expect a question paper. Getting my point? So a call can't be made on some of the members only unless they constitute a separate class of shareholders. Hence, such a call shall be invalid. Moonstar Machineries Limited is authorized by its AOA to accept whole or any part of the amount of remaining unpaid calls from any member, even no part of amount has been called up. Almost 1.5 line dialogue, but this is all about calls in advance. See, remaining unpaid even if no part of the amount has been called up. So we didn't made any call, but we are accepting that money. That money is nothing but calls in advance. Anand, the shareholder, deposits in advance the remaining amount due on his partly paid up shares without any calls being made by the company. Advise company about validity of accepting money in advance. So can company accept calls in advance? I told you, depends on AOA of the company. It depends on AOA. In the absence of AOA authorization, company is not allowed to accept calls in advance. In view of authorization given by the articles, Moonstar Machinery is permitted to accept advance amount. Even if you look at the question also, see, authorized by its articles to accept calls in advance. So in the question they clearly mentioned AOA authorization is there. Suppose if this dialogue is not there, then you have to write assumption. If AOA, if company is authorized by its AOA, then it can accept calls in advance, or else not. So in other words, this is a valid transaction. What shall be the length of the period specified by the notice of offer for further issue for giving acceptance? Period specified by notice of offer. That means in the letter of offer, what would be the length of period for giving acceptance against further issue? Minimum 15 days, maximum. As per rules, this minimum 15 days can be reduced to, in case of private companies, with 95% consent, 95%, sorry, 90% of the members consent, yes, they can reduce that shorter period also. Remember? IFSC also, right? Notice of the offer of further shares shall specify the time period within which offer must be accepted. The time period should not be less than 15 days or such lesser number of days as may be prescribed, but not exceeding from the date of offer. So rule 12A that provides the time period within which offer shall be made for acceptance shall not be less than 7 days. So reading section 62 along with rule 12A, the minimum duration is 7 days, maximum duration is. So can a company keep offer period 32 days? Can a company keep offer period 5 days? No. As per rules and as per acts, minimum 7, maximum 30. So those companies, where you get 90% consent from the members, there you can reduce it. But for all other companies, statutory minimum period is 7, statutory maximum period is 30. Clear? Next, practical questions. VRS company is holding 45% of total equity share capital in SV Company Limited. The board of directors of SV Company Limited decided to raise share capital by issuing further equity shares. Further issue means which section? Section 62. The board of directors resolved not to offer any shares. What? Not to offer any shares to VRS company on the ground that it was already holding a high percentage of total number of shares already issued in SV Company Limited. Okay. Articles of Association provides that new shares be offered to the existing members of the company. On 1st March 2019, new shares were offered to all the shareholders except VRS Company Limited. Referring to the provisions of Companies Act 2013, examine the validity of the decision of Board of Directors of SV Company Limited not offering further shares to VRS Company Limited. Legal or illegal? Legal, I mean allowed or not allowed? Before answering this question, my personal request to the Board of Directors is to attend max class. Because they are looking at the number of shares, they are not looking at the percentage of holding. In case of further issue of shares, of course, existing members shares holding, the holding number of shares will increase, but shareholding percentage remains constant. Yes or no? Suppose I am holding 1 lakh shares. Company announced rights issue 1:1 ratio. 1:1 ratio. That means for every 1 share I am holding, I can subscribe additional share. So 1 lakh right now, including rights, I will get how many shares total? 2 lakh shares. Number of shares getting increased. But total percentage, if you observe, total share capital, in that my holding will remain constant. So my personal request to the directors is to attend mathematics classes. Don't write in examination. So in examination, what is the point, ma? Valid or not valid? Not valid. In the given case, board of directors propose the rights offered to the existing shareholders except VRS company on the ground that it is already holding high percentage of the shares. The offer and the contention by board of directors is invalid as VRS company limited is equally eligible to participate in the rights offer along with other existing shareholders. Clear? Everyone. Section 62, subsection 1, clause A. Next, directors of Mars India Limited. On Mars also we are having India. Mars India Limited desired to alter capital clause of MOA of their company. Advise them under the provisions of Companies Act 2013 about the ways in which said clause may be altered. The ways in which said clause will be altered. That means they are asking you types of alteration. Either you can increase capital or decrease capital. Consolidate shares, split shares, conversion of shares into stock, reconversion of stock into shares. But 2 points important. In case of consolidation, if there is any change in voting power, if consolidation resulting in change in voting powers, then prior approval of tribunal is required. And in case of split, in what ratio you are splitting a share? In the same ratio, paid up value should also be splitted. Okay, na. And types of alteration, okay, but what is the procedure for alteration? Prerequisites for alteration of capital. I told you 3 points. Yeah, AOA authorization, OR, alteration of capital, OR is sufficient. And then communication with ROC according to section 64. Section 64 of the Companies Act. Okay, na. Everyone. Alteration of MOA requires yes, sir. But compulsory change of name, alteration of capital clause, OR is sufficient. And with increased capital, if you are offering shares to the outsiders, then we take SR. For what? For issuing shares to the outsiders. For issuing shares to the employees also, we take a SR. Alteration of capital, there will be no impact on members. But still we take OR. The reason is capital clause you will find in MOA. MOA is an agreement between company and members. Agreement can be modified subject to the approval of parties. Mutual consent required or not required? Required. On behalf of company, directors will make a request. Members will give approval. Clear? Next. Ramesh, who is a resident of New Delhi, sent a transfer deed for registration of transfer of shares to the company at the address registered office in Mumbai. He did not receive the share certificate even after expiry of 4 months. What is the time limit for issue of share certificate by the company? 1 month. In case of transfer or transmission, what is the time limit? 1 month. Correct? Everyone. 4 months from the date of dispatch of transfer deed. He lodged a criminal complaint in the court at New Delhi. Decide under provisions of Companies Act 2013 whether court at New Delhi competent to take action on the said matter or not. Yes or no? No ra. Arre, what about CJI? What about CJI? CJI means not Chief Justice of India. I told you section 12 importance of registered office. C stands for communication. J stands for jurisdiction. I stands for forgot. Huh? I told you right importance of registered office. Because of 3 cases registered office is important. All addresses, all letters are addressed to registered office communication purpose. All disputes are subject to jurisdiction where registered office is situated. I stands for inspection or investigation. Now coming to the jurisdiction, tell me we can file our complaints with which jurisdiction? With the jurisdiction where company is having registered office. Registered office is situated in and where he filed complaint. Allowed or not allowed? Getting my point. For answering this section 12 you have to remember. And moreover, he should file complaint within how many days? What is the type of company here? Private or public limited? Whether they mentioned it or not. Whether it is a private limited or public limited. Not mentioned. Then you have to write, within 60 days of delivery of documents in case of private company. Within 90 days of delivery of documents in case of public company. You have to write all those points also. If company fails to deliver share certificate, then company shall be punishable with fine 25,000 to 5 lakhs. Every officer 10,000 to 1 lakh. Just look at section 56. So you just strike off these punishment provisions, ma. Just strike off these punishment provisions. If company fails to deliver share certificate, then punishment to company is punishment to company and officer in default is equal to 50,000 rupees. Everyone, just make this correction. Further, the aggrieved person can file an appeal in a court falling within the jurisdiction of registered office of the company. In the given case, company and officers in default will be liable to bear above consequences. Further, Ramesh has filed a petition in New Delhi High Court, which is outside the jurisdiction of registered office of the company. Hence, Delhi Court cannot take any action in this regard. Can I proceed? Also, you can go with NCLT, no problem. Appeal to NCLT is also available. But here, the basis for this question is whether Delhi Court is competent to take action on this matter. Answer is no, because Delhi Court is not falling within the jurisdiction of company's registered office. Next, question number 4. Due to insufficient profits, Silver Robotics Limited is unable to redeem its existing preference shares amounting to 10 lakhs. 10,000 preference shares of 100 each, though as per the terms of issue they need to be redeemed within the next 2 months. It did not, however, default in payment of dividend as and when it became due. What is the remedy available to the company in respect of outstanding preference shares as per the Companies Act 2013? Now what they are asking you? If actual redemption is not possible, then proceed with? If actual redemption is not possible, then proceed with? Answer my question. Is this first time you are reading this question, this concept, this context? Due to insufficient profits, Silver Robotics Limited is unable to redeem its preference shares. If actual redemption of preference shares is not possible, then what is the next step? Liquidate the company, close the company, burn the company. What is the next step? Liquidate. Okay, fine. Question over. Next question. Further issue of preference shares. Tell me. Just tell me. What time you take and tell me. Further issue of preference shares. I think some 4-5 times I repeated. If actual redemption is not possible, then proceed with deemed redemption. Don't know where your brain is there. Is it working or not working? Many times I told you, if actual redemption is not possible, then proceed with deemed redemption. The question is very clear. Unable to redeem its existing preference shares amounting 10 lakhs. As per the terms of the issue, they need to be redeemed within the next 2 months. If not, however, there is a default in payment of dividend. I clearly told you, in case of default in existing preference shareholders, in case of default with existing preference shareholders, can a company issue new preference shares? Possible or not possible? What are the conditions for issue of preference shares? No subsisting default in payment of dividend, in repayment of capital. Told you. And when actual redemption is not possible, then proceed with deemed redemption. Now also I told you 2 times. For deemed redemption, what is the procedure? Without existing members approval, directly they will go with NCLT and they will die. They will commit suicide there. Consent of holders of 3/4 in value of such preference shares and approval of tribunal on a petition. It's not special resolution. Special resolution is something passed by equity shareholders only. I repeated that point 2 to 3 times. 3 conditions to be satisfied for deemed redemption. Consent of 3/4 of the value preference shares. NCLT approval. NCLT may give approval only when dissenting shareholders are repaid. What happened? What is happening? You forgot or you didn't understood? Ma, whether you forgot it or you didn't understood that concept. I need answer. Anything you tell, you didn't understood or you didn't remember? I'm not getting it. You understood or not understood? And it is hereby declared that the issue of further redeemable preference shares or redemption of preference shares under this section shall not be deemed to be an increase or reduction in the share capital of the company. So in the above, company can initiate steps for issue of further redeemable preference shares equal to amount to due, that is 10 lakhs. Also told you, new shares will cover value not only old preference shares but also outstanding dividends. For this purpose, it shall obtain the consent of the holders of 3/4 in value of such preference shares and also seek approval of the tribunal by making a petition. In case there are certain preference shareholders who have not accorded their consent. That means what? Dissenting shareholders. The tribunal may order the company to redeem immediately such preference shares. Accordingly, Silver Robotics Limited must be ready with sufficient funds for the redemption of preference shares held by those who have not consented. On the issue of such further redeemable preference shares by company, unredeemed preference shares shall be deemed to have been redeemed. Next one. Olaf Limited is a subsidiary of PQR Limited. Decides to give a loan of 4 lakhs to Human Resource Manager Mr. Surya Nayan. What is the loan amount? 4 lakhs. Who is not a KMP. Drawing salary of 40,000 per month. So first of all, this is a public limited company. Which company? Public limited company. Financing employee. How much finance they provided? 4 lakhs. What is the remuneration of the employee? 40,000. To buy 500 partly paid up equity shares of 1000 rupees each in Olaf Limited. Examine the validity of company decision under provisions of Companies Act 2013. So what is this question? No, on which provision this question came? Restrictions on purchase of its own shares. So no public company can finance directly or indirectly to purchase its shares. But we had 3 exceptions. What are those 3 exceptions? Banking company. Next, employee share purchase scheme. Last one, financing employee, loan to employee. Loan to employee, 3 conditions to be covered, then only it comes under exception. What are those 3 conditions? Salary employee excludes KMP director. Salary max to max 6 months salary. And with that loan amount, he should purchase fully paid up, partly paid up. Now observe carefully, what is his remuneration? 40,000. 6 months of 40,000 means, but how much is the finance amount? Default 1. Next, with that money, what he purchased, fully paid up or partly paid up? That means second default also there. Second default also there. Any one default is there, then not covered under exceptions. In the given case, company is a subsidiary of public company, gives a loan amount for 4 lakhs to an employee to purchase shares of its own company. Since amount of loan exceeds 6 months salary, the company has violated the provisions of section 67 and it is invalid. Moreover, loan given to employee can be used only to subscribe fully paid shares, not for partly paid shares. I also told you the consequences, why we should not provide finance, because with the finance amount, they may inflate share prices. It should not be done. So that's why financing someone to purchase its shares or its holding company shares, allowed or not allowed or not allowed. But we are having 3 exceptions. Banking company, ordinary course of business allowed. Employee share purchase scheme, having a trustee by passing special resolution. Next, loans for the, trust for benefit of employees. One is SR, other one is trustee for the trust for the benefit of employees. Maximum they can subscribe how much, what type of share capital, partly paid up or fully paid up? Fully paid up. And there is a limit, 5% of paid up share capital plus free reserves. Listed companies will acquire shares from stock exchanges. Unlisted company will acquire shares at a price fixed by the registered valuer. So that is all about section 67 exceptions. Next, question 6. Shilpi Developers India Limited owed to Sunil 10,000. On becoming this debt payable, the company offered Sunil 100 shares of 100 each in full settlement of the debt. The said shares were allotted to Sunil as fully paid up in lieu of his debt. Examine the validity of this allotment in the light of the provisions of Companies Act. In examination, if you read this question, definitely you won't get answer, because here looking at the provision, you may understand that question belongs to 62. But here, the concept is all about issue of shares, further issue of shares. To whom we are issuing shares? To Sunil. Who is Sunil? Is he a member? Is he an employee? Is he a creditor? Creditor means outsider. Whenever company is issuing shares to the outsiders, special resolution plus valuation report is required. Getting my point? But that special resolution is not required in 2 cases. In case of convertible debentures, convertible preferentials, convertible loans. And second one, when there is an order from government. Order from whom? Order from central government, stating that to convert loans obtained from government, to convert debentures issued to the government into equity. Remember. So here SR, passed or not passed? Not specified. In the present case, company's allotment to be classified as shares issued for consideration other than cash, converting debt into equity, must be approved by the members by a special resolution. Original terms, if you observe carefully, owed 10,000 rupees. On becoming debt payable, company offered him. That means, company is not converting debt into equity. The debt is not having a terms and conditions like, on maturity date, the debt will be converted into equity. Like that, there is no such clause. So definitely it comes under exception. It comes under general rule, sir. It comes under general rule. Under general rule, special resolution plus valuation report is required. Further, valuation of shares must be done by the registered valuer subject to the compliance with applicable provisions of chapter 3. Chapter 3 means prospectus and allotment of securities, any other conditions as may be prescribed. Suppose in the question, would your answer differ if Shilpa Developers India Limited issued convertible debenture to Sunil previously? Then our answer is different, because for conversion no need to take any SR. Reason, at the time of issue of convertible debentures we have obtained a SR. Clear? What are the provisions of the Companies Act 2013 relating to the appointment of debenture trustee? When appointment of trustee is required? Whenever company is going with public offer, whenever company is going to public with public offer, or whenever company is offering debentures exceeding 500 members, trustee is required. And trust deed shall be executed within 3 months of closure of the issue. Correct? A shareholder who has no beneficial interest, qualified or disqualified? Shareholder, no beneficial interest, qualified. Creditor whom company owes 499 only. 499 only. In disqualifications, we didn't see any amount. We didn't see any limit. That means even 1 rupee debt is there, disqualified. Even a debtor also, 1 rupee debtors are disqualified only. Getting my point? A person is entitled to receive remuneration as a debenture trustee and he is entitled to the monies from the company. Qualified or disqualified? Qualified. Qualified. Ma debenture trustee will receive remuneration. I told you, creditor is disqualified. But if he is entitled to any other amounts like remuneration as a debenture trustee, then no disqualification. Just look at the provision one more time. Provision, allotment, debenture trustee, just look at the provision one more time. Beneficially entitled to, observe carefully, beneficially entitled to receive payments from the company. That means all creditors are disqualified except, we are talking about disqualifications. In disqualifications, if exception is there, means qualification. Exception to disqualification is nothing but qualification, except as remuneration payable to debenture trustee. Next one. Next, last question. A person who has given guarantee for repayment of amount of debentures issued by the company. Qualified or disqualified? Come on, tell me, qualified or disqualified? Disqualified. Surety disqualified. Beneficially hold shares. Promoter, director, KMP, officer, employee of cash. Next one, creditor of the company. Debtor to 5 companies. Cash plus SH. What is SH? Subsidiary of holding. Surety disqualified. Pecuniary relationship disqualified. Relative of promoters, KMP, director, employees also disqualified. Is it clear? I told you in disqualifications only 2 points you have to remember in a particular way. For a debtor, 5 companies. For KMP, director, relative, for KMP, promoter, director, officer, employee, 4 companies. All remaining disqualifications, only our company. If you still can't remember, it's better to quit CA course. Today, now we are having only one subject. After completion of my subject, daily 2 subjects. They will start 2 subjects. Then when you find time for revision. Yesterday topic, if you are unable to retain till today, how can you remember till examination? So better quit CA. Next, question 8. Mr. Nilesh has transferred 1000 equity shares of Perfect Vision Private Limited to his sister Miss Mukta. The company did not register transfer of shares and also did not send a notice of refusal to Mr. Nilesh or Miss Mukta within prescribed period. What is the prescribed period for sending notice of refusal? 30 days. Discuss as per provisions of Companies Act whether aggrieved party has any right against the company. Yes, can file a appeal with tribunal. Can file a appeal with tribunal. Within how many days? Look at the company name. Private Limited. In case of no notice of refusal, within 60 days of delivery of documents for registration of transfer. Submission of documents for registration of transfer. 60 days of such refusal. This is for public company. Yes or no? Within 90 days of delivery of the instrument or transfer or transmission. This is for public company. In this case, as company has not sent even a notice of refusal, Ms. Mukta being transferee may appeal before tribunal within 60 days from the date of which instrument of transfer is to the company. So conclusion is from private company point of view or public company point of view? Private company point of view. Can I proceed? Question from RTP's, MTP's question papers. Dolls Toys Limited is having a net worth of 310 crores, paid up share capital 200 crores, free reserve securities premium 110 crores and turnover of 300 crores. Dolls Toys Limited wants to accept deposits from public other than its members. Keep this question pending, man. Next chapter I will discuss with you. In next chapter I will discuss with you. Question 2. SAB Health Products Limited issued equity shares worth 5 crores. The company made a call to all its subscribers to pay a sum of 30 for each share held by them. Mr. GH, a subscriber to the shares of a company holding 10,000 shares, paid all the money due on the shares held by him in advance. Later, Mr. GH claimed interest on the monies advanced by him, also dividend in respect of the advance money paid. Is his claim justified? Why? On calls in advance, he will get only interest. Whether he get dividend or not, it depends on company's AOA. If AOA is silent, he get dividends on complete face value, not paid up plus calls in advance. It's complete face value. Another shareholder, Mr. LK, holding 15,000 shares, did not pay first call. So directors called upon him to pay the entire call amount due by him in respect of the shares held by him. Referring to the provisions of Companies Act 2013 and rules made thereunder, examine whether directors of SAB Health Products Limited permitted to do so. Tell me, can he fix one call for one member, another call for another member? Call amount should be uniform basis. Call amount should be on uniform basis. So allowed or not allowed? Not allowed. MTP May 24 question, but same question got repeated in September 24 attempt in question paper. This is MTP question for May 24, but same question came in September 24 examination. Next one, Trisha Data Security Limited, listed on stock exchange. Your life is with Trisha only. Question unimportant. Trisha important. Auntie ra. Auntie. Think about, no, don't think about anything. Think about questions. Trisha Data Security Limited was incorporated in 1st August 2019 with a paid up share capital of 200 crores. Within small time of 1 year, it has earned a huge profits and has topped the charts for its high employee friendly environment. Company wants to issue sweat equity shares to its employee. Friend of CEO of company told that they cannot issue sweat equity as 2 years have not elapsed since time company has commenced its business. CEO of company has approached you to advise them about the essential conditions to be fulfilled to the issue of sweat equity shares since company is just a few months old. You remember 2 times I dictated this question when I'm explaining that sweat equity concept, because there is an amendment. Before amendment, no company can issue sweat equity shares up to 1 year of incorporation. But right now the time limit there or not there? Not there. So just write down the conditions for issue of sweat equity and then see the analysis and conclusion. Contention of CEO friend that company cannot issue sweat equity shares up to 2 years is invalid. So Data Limited, a listed company, can proceed to issue sweat equity shares in accordance with provisions of section 54 of the Companies Act 2013. And there is no such minimum time limit of 2 years in operations as specified under section 54. Can I proceed? Walnut Limited. Walnut Limited has an authorized share capital of 2 lakh shares, 100 rupee per share, and an amount of 2 crores in its securities premium account. So what is the capital amount, ma? 2 lakhs into 100 means 2 crores plus security premium 2 crores. Board of Directors seeks your advice about the application of share premium amount for its business purposes. That means this first 1.5 line is waste actually. So what is the requirement? Utilization of securities premium account. So tell me, for what purposes we can utilize securities premium? Bonus, preliminary, expenses, premium on redemption, purchase of its own shares means buyback. If company is followed, if company is required to comply accounting standards in preparation of financial statements, then bonus shares, writing of expenses and purchase of its own shares, nothing but buyback. Can I proceed? Next one. Sri Limited is engaged in manufacture of consumer goods and has got a good brand value. Over the years, it has built a good reputation and its balance sheet as at 31st March 2020 shows the following position. Capital how much? Authorized capital 2.5 crore. Issued capital how much? Issued, subscribed, paid up how much? 1 crore. Free reserves 3 crores. Board of Directors proposed to declare a bonus issue of 1 share for every 2 shares. That means 1 crore issued capital, right? 1 crore into, what is the ratio? 1 by 2. For every 2 shares you are holding, company will give 1 share. So into 1 by 2 means 50 lakhs. Tell me whether my authorized capital permits to issue 50 lakhs bonus shares. Yes. Why? Authorized capital 2.5. Issued how much? Only 1. Unissued is how much? 1.5. So I can utilize 50 lakhs. And looking at the reserves, how much reserves I'm having? 3 crores. How much amount I need? 50 lakhs. Possible or not possible? Possible. So they can also go with 3:1 also. 3:1. For every 1 share, they can go with 3 shares. Possible or not possible? Why? From reserves point of view, possible, ra. But authorized share capital, not possible. Why? 1 crore. 1 crore into 3 means how much? 3 crores. 3 crores bonus issue. For issue of 3 crores bonus issue, just add it. 1 crore plus 3 crores, total 4 crores. Whereas my authorized share capital is 2.5. 3 is to 1 not permitted. Even 2 is to 1 also not permitted. Why? 2 is to 1 means for every 1 crore shares, 2 crore shares will be issued. 1 crore existing issued capital plus 2 crore bonus issue, total put together 3 crores. But authorized share capital is 2.5 crores. So max to max, what ratio is possible is for every 2 shares you are holding, company may issue 3 shares as bonus. For every 2 shares held by the member, 3 shares can be given as a bonus. You can also calculate, 1 crore is existing capital into 3 by 2 is equal to 1.5 crore. Existing capital 1 crore, bonus issue 1.5, both together 2.5. My authorized share capital is 2.5 crore permissible. So like that also they can ask you the question. So the company will need reserves of 50 lakhs which is available with the company, and hence company can proceed to issue bonus shares in accordance with the above provisions. Can I proceed? XYZ Tech Solutions Limited is a growing technology company that has seen significant contribution from its employees and directors in the development of groundbreaking software product. To reward these key contributors, the board passed issuing a sweat equity shares to certain employees and directors. XYZ Tech Solutions Limited already has issued ordinary equity shares but has never issued sweat equity shares before. The company has a paid up equity share capital of 20 crores and company has proposed to issue sweat equity shares worth 4 crores of face value. What is the face value? 4 crores. What is the existing capital? 20 crores. In a year, to what extent they can issue sweat equity shares? 15% per annum. 15% or 5 crores, whichever is higher. 15% of 20 crores, how much? 3 crores. Array, 20 crores into 15%, how much? 3 crores only. 3 crores or 5 crores, whichever is higher means? Getting my calculation. And what is the proposal? 4. Again, we need to check overall limit. What is the overall limit? 25%. 25% of 20 crores means 5 crores. So tell me whether this 4 crores within the limit. Yes. Now, what are the two limits I should satisfy? Paid up share capital into, paid up equity share capital into 15%. This is per annum. Throughout the company lifetime limit, paid up equity share capital into 25%. So here in first limit, we had another limit, 5 crores, whichever is higher. As per first limit, you can go up to 5 crores. 5 crores. Yes or no? And as per second limit also, 20 crores into 25% means 5 crores. So overall 5 crores possible. Individually also 5 crores possible. What is the requirement? 4 crores is the requirement. Can they do? Can they do? Yes. So thus company can issue sweat equity shares to the tune of 5 crores. However, company cannot issue such shares more than 25% of paid up equity share capital, that is 5 crores. Hence, company can issue sweat equity shares of 4 crores. Understood? And the provision part you will find conditions for issue of sweat equity shares. MNO Limited are finalizing its financial statements and found that value of one of the properties has increased. Company came across certain other transactions also and got confused as to what should be included as free reserves. Free reserves. Company has approached you to define them, the meaning of the term free reserves for the dividend distribution as per provisions of the Companies Act 2013. They want to know which is considered as free reserve. Tell me, is securities premium a free reserve? Is revaluation reserve a free reserve? DRR free reserve? CRR free reserve? Because purpose of creating these reserves is different. Free reserve means the reserves free from conditions. Conditions attached or not attached? No conditions are attached for utilization. You can use that free reserves for anything including payment of dividends. So here they are asking about the definition of free reserves. Amount representing unrealized gains, notional gains, revaluation assets, simply revaluation reserves. Will it form part of free reserve? No. Any change in carrying amount of an asset or liability recognized in equity, including surplus in profit and loss account, on measurement of the asset or liability at fair value shall not be treated as free reserve. This is also revaluation of the assets only. In accounts you'll get a concept regarding closing balances of debtors creditors in case of foreign branch. Suppose, for example, company C Limited, TCS Limited rendered services to one American company, USA company. At the time of rendering these services, the contract value is $1 million and dollar rate is, for example, 80 rupees. So 1 million into 80 rupees means 8 crores. Company recorded debtor for 8 crores. But as on 31st March 2025, what happened? Dollar value from 80 it went to 85. Now what is the balance receivable from the debtor? Is it 8 crores or 8.5 crore? 8.5. So we are revaluing the debtor. So 50 lakhs we are increasing it and we transfer this amount to foreign currency reserve, foreign currency transaction reserve, like that. So these reserve, is it available in the form of cash or not available in the form of cash, sir? Not available in the form of cash. Once you get amount, it becomes realized amounts, yes or no? Unrealized amounts, if they are revalued, because of revaluation of assets, any reserves, any surplus you are getting, is it in realized form or unrealized form? Unrealized form. Unrealized form is not eligible for dividends. So in accounts, you get a concept called foreign branches. In foreign branches, you will do problems like this. At the time of rendering these services, company will record debtor for 8 crores. But as on 31st March, if the dollar value is going up and debtor balance we are revaluing to 8.5, so difference amount we will credit to foreign currency transaction reserve. FCTR is ineligible for dividends. That means, is it a free reserve or not a free reserve? Not a free reserve. Suppose by the time they are making payment, if dollar value goes to 90, then how much amount we get? 9 crores we get. That means how much we are realizing? We are realizing 1 crore. Now this 1 crore you can use it for dividends, no problem to me. As long as it is unrealized, I cannot use it for payment of dividends. That means, is it a free reserve or not a free reserve? Not a free reserve. Everyone. Next one. Cross Limited is a company incorporated under erstwhile the Companies Act 1956. While XYZ Private Limited is a company registered under Companies Act 2013, XYZ Private Limited has issued 1 lakh convertible preference shares of 100 each and 10 lakh equity shares of 10 each fully paid up. Cross Limited is holding all preference shares and 1 lakh equity shares of XYZ Private Limited. Examine whether the provisions of Companies Act applicable to Cross Limited. Examine whether XYZ Private Limited is a public company as per Companies Act 2013. Ma, you understood this question? No, what about this question? What is all about this question? First, they want to check whether it is a deemed public company or not. Second thing, company was incorporated under old law. Whether new Companies Act is applicable to old company or not. Just look at the question one more time. I'm reading not for my purpose. I'm already a chartered accountant. Every month my clients will pay fees. At the end of this batch, yes, sir will pay me remuneration. There is no loss to me. If you didn't understand, I'm ready to tell you 90th time also. If you are not remembering the concepts, I'm ready to revise it. But if you are not opening your mouth, no loss to me, no loss to institute owner, no loss to ICI. When I'm reading the question, follow me carefully. That's it. Question bank, actually I can give it for homework. Just look at the question one more time. Cross Limited is a company incorporated under Old Companies Act. Now question is whether provisions of Companies Act 2013 applicable to Cross Limited. Next one, XYZ Private Limited is a company registered under Companies Act 2013. XYZ Private Limited has issued 1 lakh convertible preference shares and 10 lakhs equity shares of 10 each fully paid up. Public company is holding all preference shares. What is the preference share capital? 1 lakh convertible. Yes, preference share capital 1 lakh. And what is the has issued 1 lakh convertible preference shares of 100 each. The calculation is different actually. 1 lakh into 100 we have to consider. It's here it is not rupees ma. Here it is not rupees. 1 lakh convertible preference shares of 100 each. That means what is the total preference share capital? 1 crore. Getting my point? And what is the equity share capital of the company? 10 lakhs equity shares of 10 each. That is also 1 crore. Now, Cross Limited, C is holding 1 crore preference share capital as well as 10 lakhs equity share capital. In which company? XYZ Private Limited. If I am not wrong, this question will definitely come in the examination. This question will come in the examination. In the upcoming examination, they will definitely ask this question for sure. Now, Public Limited, what is the total capital they are holding in XYZ Private Limited? Total 1.1 crore. What is the total paid up capital of the company? 2 crores. Now, can you call XYZ Private Limited is a subsidiary to C Limited? Can you call XYZ Private Limited is a subsidiary to C Limited? Answer is no. Array, just look at the definition of subsidiary. In which other company exercises more than half of the voting power. From preference shares you get voting power. Then preference shares carrying right to vote. Convertible preference shares carrying right to vote then may be considered only after conversion. After conversion. Here for us what is important point? Convert voting power. In the voting power, if they are having majority voting power, then this becomes subsidiary, that becomes a holding company. If it is a public company, if that company is a public company and our company is a private company, then our company becomes a deemed public company. Look at the provision. Cross Limited holds more than one half of the total voting power. Equity shares plus preference shares. Therefore, XYZ Private Limited is a subsidiary of Cross Limited. Further, in terms of provisions of Section 2 Clause 71, XYZ Private Limited being subsidiary of Cross Limited shall also be deemed to be a public company. Definitely, this question will not come in examination. So, why, sir? Reason is, just wait. I'll tell you the reason also. Companies Act PDF. Let me open Companies Act PDF. What is the definition of a subsidiary company? Section number, Section 2 Clause. Forgot. 87. No confusion at all. Just look at the point. Subsidiary company in relation to another company, that is to say means a company in which holding company controls composition of the directors. More than one half of the total voting power. Number 5 is there. What is that number 5? Previously, total share capital word is there. In the place of total share capital, what they brought? Total voting power. Now this question, is it as per previous, before amendment or after amendment? Before amendment. Before amendment. But that question came recently. That's why, chances of getting this question in examination is very less. The reason is, this is question with respect to before amendment. There we consider total share capital, including convertible preference share capital. Right now, that concept is not there. That's why this question will not come. That is my opinion. Suppose if this question comes in the examination, you already know the answer, right? You write the answer. If it didn't come, no need to write. Understood? Next one. Explain the following as per provisions of Companies Act 2013. Abridged form of annual return. Keep this pending. Signing of annual return. This question is from next chapter. Management and administration. Wrong classification happened. Next one. Offer of buyback of its own shares. Offer of buyback of its own shares by a company shall not be made within a period of 6 months from the date of closure of preceding buyback, if any, and cooling period to make further issue of shares shall be per a period of 1 year from the completion of buyback, subject to certain exceptions. True or false? Why? Fresh offer of buyback can be made only after 12 months and further issue cannot be made up to 6 months. Simply the limits interchanged. So keeping in the view of above provisions, statement the offer of buyback of its own shares by a company shall not be made within a period of 6 months from the date of closure of preceding offer of buyback, and cooling period to make further issue of same kind of shares including allotment of shares for 1 year is not valid. Simply they interchanged the limits. You understood? So share capital and debentures question bank completed.